are you investing in energy for portfolios? And I believe you also have a stock picker for us in the energy sector.
That's right. Yep. Yeah. So I'll get right to it. When we look at, positioning coming into the year, obviously having some short-term liquidity is important. I really like precious metals. I've talked about, other sectors such as railroads, et cetera. But when I look at energy, I think you have to have some energy at a minimum for a hedge. But I think it's important to be positioned in the energy sector. So when I look at something like ENP, a company like EOG Resources, great balance sheet. Obviously, the fact that energy's dipped down a bit, I think it's a company that we have in our sights, and if there's continues to be a correction, it's a position that I would add. Very good balance sheet, good cash flow, and it's something that should be in portfolios, as you look over the long term and certainly over the course of this year.
All right, EOG Resources up right now in the pre-market. Energy, the big winner of 2022. Patrick Frizzetti, thank you so much for the insight. Happy Friday. All right, that's going to do it for us here on Worldwide Exchange. Squawk Box coming up next.
Good morning, and once again, stocks relatively calm, but that could change later when we get the December employment report. We'll tell you what to expect after that strong ADP report. The House adjourned again without electing a speaker, the voting process lasting longer than any speaker vote since before the Civil War. We'll tell you where negotiations stand. There may be some movement. And Tesla shares falling sharply following news that the company is slashing prices of its cars in China. It's Friday, January 6, 2023, and Squawk Box begins right now.
Good morning, everybody. Welcome to Squawk Box here on CNBC. We are live from the NASDAQ market site in Times Square. I'm Becky Quick along with Joe Kernan and Andrew Ross Sorkin. Welcome back.
Thank you. It's nice to see you.
It's Friday, and I think we're all ready for Friday at this point. Let's take a look at U.S. equity futures at this hour. You'll see that right now, things are barely moving. Dow futures up by about 8 or 9 points. The S&P futures down by about 2. The NASDAQ down by about 28. Of course, we've got the jobs report coming up. That's what traders are waiting to see. If you've been watching Treasury yields right now, you're going to see that at this point, it looks like the 10-year is sitting just at about 3.733%. The 2-year's at 4.479. And again, yesterday it was a down day. We'll see what happens today. Down by more than 1% across the board.
Meantime, in Washington, fight ain't over yet. The House of Representatives now voted 11 times with no movement towards a winner in the speaker race. But reports saying that Congressman Kevin McCarthy and some of his opponents appear to be nearing a deal. Sources now telling the Journal that negotiations centered on committee appointments for the Freedom Congress and changes to how exactly that Congress would operate, including the ability to amend legislation and how and when lawmakers would vote on spending bills. Now, McCarthy struck a hopeful tone after the 11th vote failed.
No, I'm not putting any timeline. I just think we've got some progress going on. We've got members talking. I think we've got a little movement, so we'll see.
House plans to return to the chamber at noon today, so we'll see what happens. Meantime, Representative Matt Gaetz is now the leader of the so-called Never Kevin group, nominated former President Donald Trump for the position of House Speaker.
I rise to nominate Donald Trump for the position of Speaker of the House. And for all of the vitriol that we hear from the media and at times the left, there were great moments of bipartisanship under the Trump presidency.
Interestingly, and this was a lesson for me, I did not know this before, I don't know if you guys did, the Constitution does not require that the Speaker be an elected member of the House, although every Speaker thus far has been one. 6:30 this morning, policy expert Dan Clifton is going to join us to tell us why today's negotiation might be McCarthy's last chance at the speakership.
Well, that's why I asked Jay Clayton. And Lee Zeldin's name has been thrown back and forth for the last month.
Yeah, but I really appreciated that was like a real thing.
Right, even the parliamentarian.
Yeah. It's and look, I don't think that you're going to find someone who's not an elected member of the House who's actually
it won't
in this
happen.
position, but it's an option. The other thing that I think is interesting, we talked about this briefly yesterday when we had the two members of the Problem Solvers Caucus on. Mm-hmm. Is there a point where McCarthy has given so much away to these people who still won't vote for him that he starts to lose some of the more moderate members who are there? And that
people have raised that, yeah. Well, we're down to one person can now ask during it, and that's what he's been holding out on. One person can ask to unseat the speaker. Right. So how are you ever going to get
anything done?
Right. Well, that's not.
Is this just the wrong person to begin with? Once you get to that point, if you're at that point, does that mean that the whole thing is?
Andy Biggs, the leader of the opposition, got 30 votes in November. McCarthy's been stuck at 91% of the Republican caucus for these 11 votes. 91%. Now, the Democrats are included too, so it wouldn't be 91%. But have you ever heard of a body where you get 91% and that's not enough to where you assume the leadership position? I've always thought he probably would prevail. And these guys, because it's going to get to, there'll be four. Matt Gaetz will never vote for him. I don't know whether I think Perry might at some point.
I think Boebert would. I think there's 4 or 5.
4 or 5 that never will. A lot of Republicans, one guy's going for a medical appointment. He's not going to be there today. There's other people that have family matters. So suddenly the whole dynamic changes on what number would get you there. But we're at a point where he's given so many concessions that if you don't do it now, it's very clear. No, it's just very clear that you have a personal problem with Kevin McCarthy. And and that, I don't know if people are finally going to be comfortable owning that, to where they're just being so stubborn. It has nothing to do with policy. It's totally about them. And at that point, I think they start looking bad. And maybe that's where
look, I think if you're doing this and you're saying, I want committee chairmanship positions and I want X, Y, and Z,
and you get all
9% of the caucus, 9% of the caucus holding the other 91%.
Yeah.
That's hostage. And those people saying, wait a second, why should you cave to these people? I'm not going to.
People can't get paid. People can't. Nothing's happening.
There's situations of extreme measures in California with the weather, and if there's the need for federal funding, they can't get anything passed. I mean, there are real consequences to these things.
But the market got weak because things are too good in the job market.
Which means the Fed is going to continue.
Which means the Fed is going to continue, which we heard will be. We'll see what this number today. We're a little bit worried that too many people might be employed. A little bit worried about that. Things might be, people might be making more money. We're a little worried about that. We may have to sell some stocks and stick our heads in the sand because things are too good in this country right now. The Fed will take care of that. New overnight, it's January 6th too, which is a weird day now, is it not?
Happy
It's your birthday.
Well,
Happy
it was,
birthday.
I hope someday that this January 6th is known for that, rather than what all of us think of now when we say January. It used to be the Epiphany, when the three wise men come, they bring gifts and all this stuff. It was an important, in Christianity, it was an important day. It's totally been supplanted by this, something that some people say was worse than September 11th, which I don't think it's worse, but it's just weird. So maybe someday. But if you think, Sorkin, that the universe doesn't have a sense of humor,
Right.
Was that my birthday present?
I was looking at Kate McKinnon. Has her birthday today.
Kate McKinnon.
I was just looking at the
Sidney Sorkin, close.
2 days ago. I was just looking through the list of other famed folks. Julie Chen's birthday is today. Adding.
I'm right. I think I'm right there with her almost. I mean, can you find anything better than that? I mean, come on. No one. No, there are some good ones. I think Norman Reedus.
Norman Reedus has a birthday today.
Henry Kravis.
Is Henry Kravis' birthday today?
I've got another one too. Eric Trump.
Rowan Atkinson. Remember?
Who's Rowan Atkins? Is that
Mr. Bean.
Mr. Bean, the actor.
I remembered. I've looked before. There are some. Eric Trump. New overnight, Samsung Electronics warning that its quarterly profit tumbled by 69% to an 8-year low in a preliminary earnings statement. Sorkin, Bed Bath & Beyond, man.
I know. What are we going to do?
Bed Bath & Beyond.
I don't want to buy it out of bank.
They're not going to. I mean, we can still go, right? They're not going to close it just because it's.
They'll close some of them. Maybe our favorite ones.
Are the one where we. Samsung said that revenue likely fell 9% year over year. The full results are due January 31st. Samsung said it saw particular weakness in its memory and smartphone businesses, but that stock closed higher in South Korean trading.
Shares of World Wrestling Entertainment jumping after former CEO Vince McMahon returned to the company and said that he supports launching a review of strategic alternatives. McMahon has majority voting power through his ownership of WWE's Class B stock. He told the company that he is electing himself and 2 former directors to the board and intends to become executive chairman. McMahon abruptly stepped down as CEO back in July of 2022, following disclosures by the Wall Street Journal of multiple payouts to women who had alleged sexual misconduct and infidelity. A special committee concluded its investigation into McMahon in November and disbanded. In an SEC filing, the company said that the payments, though made by McMahon personally, should have been booked as WWE expenses because they benefited the company. That stock right now up by about 9%.
Meantime, Tesla is now making the steepest price cut so far on its Model 3 and Model Y cars sold in China. This after deliveries plunged there in December. The prices for Tesla's 2 most popular electric car models made at the Shanghai factory, they're going to be reduced by roughly 6 to 13%. The Model 3 starts at $32,700. That's more than 30% cheaper than the same car price in the U.S. That move coming amid stepped up competition in China. Rival BYD, whose cars are generally cheaper, delivered 911,000 cars last year, almost 3 times that of 2021. That compares to just 710,000 China deliveries for Tesla. Coming up, we got a lot more coming up on Squawk Box this morning. The countdown to the jobs report, it is officially on. Mark, I don't know, mark your calendar, set your clock, whatever you're going to do. It's going to be here in about an hour, 2.5 hours. We're going to tell you what to expect from today's employment numbers and what it could mean for this month's Fed meeting. And later, FTC Chair Lena Khan is going to join us first in a CNBC interview to talk about that big news proposal that she just made yesterday that would limit the use of non-compete clauses by employers across the country. It could have a huge impact on business. You're watching Squawk Box, and this is CNBC. It's Jobs Friday. Polled forecasters expecting the economy added 200,000 jobs in December. It would be less than November, but likely still strong enough for the Fed to stick with that aggressive tightening policy to fight inflation. This is just the latest monthly jobs data before the Fed meets January 31st and February 1st. Joining us right now to talk about today's jobs report and the implications for the Fed. Roger Ferguson's with us, former vice chair, of course, of the Federal Reserve and a CNBC contributor. We've been talking about these jobs numbers. I don't know what you're expecting on the jobs numbers, but I'm more interested, of course, in sort of how you think Jay Powell and the gang are thinking about this. I think that we may have just lost Mr. Ferguson for a brief moment. We're going to try to get him back.
Look, one of the big issues for the jobs report this time around is going to be focusing on the wage component,
right.
how much average hourly earnings are up, because that's been a huge issue. ADP that we
right.
saw earlier
yes,
this week, that was a big deal too, that they kind of broke it down and showed that people who are staying in the same jobs are going to see wage gains or have seen wage gains of 7.5%, but it's more than 15% for people who are jumping jobs. And that shows a really strong jobs market. And that's the
right.
thing the Fed's worried about.
George, let's not bury the lead. What is this non-compete thing?
We are going to be talking to Lena Khan,
Yeah.
runs the FTC.
Yeah.
She came out with a huge decision yesterday.
I have a friend.
You have a friend who has a non-compete?
Who has a contract.
With a non-compete.
Yes. And he tells me it could be he, could be she, can't go to a competing network.
They're in the TV business?
They're in the TV business.
I see.
Because in their contract,
right. It says they can't go anywhere.
They can't go anywhere. Right. Are you telling me?
I am telling you.
Are you telling me that this person could now?
Possibly.
I don't know if it's for people who have contracts that have been negotiated separately. I think it's the more of what they're going after is if you go to a hair
Are you going to
salon,
find out?
Yeah, he's going to find out. But if you
we're
go
going to find
a hair
out.
salon,
Is it? You know what? This is never going to. It's not going to
unless you have a
stand up.
contract
Well,
for
so here's the
forever.
thing. There's going to be a 6.
It's not going to stand up.
It might. So there's going to be a 60-day comment period, and we'll talk to Lena Khan about it. And then, of course, she can implement the rule. Then I imagine you're 100% right. I mean, Chamber of Commerce and others have already said that you're going to come out and I imagine go to court to try to block.
There's a good reason to have this. Has it been around 100 years or something?
So
it's abused in some circumstances. I can say there's
it's abused with rank and file people who don't have companies.
Right, and I think that's what the true intent of it is. You could argue that some of these contracts that companies are paying effectively for the right to stop you from doing other work, but in a lot of these jobs, they're not paying you for that right at all.
They're not paying you much at all, and you go in and it's a hair salon.
So
and they say you got to sign this before you work here, and then you can't work anywhere in a 25-mile radius.
We'll see.
I said, tell Ari just to calm down. There's nothing.
I mean, you should tell your friend to tell Ari.
No, that's what that's what I meant.
Right.
Tell my friend to tell. Okay.
Roger Ferguson, he's been loyal to CNBC.
Bonus baby.
He's loyal to CNBC, and I'm glad to see him right here.
In a minute.
He's going to be,
second.
He's going to be leveraging this new arrangement. He'll be on every TV network. Roger Ferguson, we were just asking what you think Jay Powell, or sort of how the gang thinks about this number, and really almost politically, politically, I don't know if the question's about political palatability, but how much unemployment has to rise effectively in the U.S. before the Fed is satisfied?
Well, first, thanks and happy birthday to Mr. Kernan. Look, I think the way the Fed looks at this number is it's one of many numbers, and the general trend has been labor markets that are still very tight. We saw that in the JOLTS number, where in fact the number of voluntary quits has gone up. We saw that the number of openings declined only modestly. Initial claims showed the same thing. So I think this number is going to be seen as part of a pattern of ongoing strength in the labor market demand side in particular. That's going to create some troubles for them. Like everyone else, they're going to be looking at the wage number. The last number in November was somewhat disappointing for those who are hoping for cooling. And finally, to your last question of how much unemployment is necessary, well, in their most recent projections, they suggested the unemployment rate by the end of this year would be somewhere, I think it was 4.6%, which means roughly about 1 million unemployed people. And so that's, I think, what they're projecting as being consistent with getting inflation closer to their target.
So, but there's a lot of room to move between where we are right now and that number.
Oh, absolutely. One of the reasons that they are going to continue to raise rates is that they know they're going to have to work to get things there. The demand side of the labor market is really very, very strong.
Right.
And that means raising rates by, I think, another 75 basis points. And some of them are talking about possibly another 100 basis points.
So I imagine you get lots of phone calls from equity investors and other people that are in the market. And there's so many people who have such an optimism or such a hope that somehow they're not going to do this. And we've gone through these periods where the market's gone up with an expectation that they're not going to do it. And then there's sort of this realization that they are. What do you tell them?
I tell them exactly that.
Why do you think that view even exists, if given the kind of comments that you often make?
Right. Well, first, I think it's the triumph of optimism over reality. I think the reason the review exists is that most people in markets now have not been dealing with a period of inflation where the Fed was single-mindedly focused on that part of its mandate. So I think many people in markets right now have grown up thinking, if there's this a little softness in the market, the Fed's going to react to that because they're concerned about financial instability. And I think they're just missing that.
Be able to do this.
Right.
So, the vertical, but this is certainly one way that a lot of people with medium to larger accounts do. But Tom, this is a great tool for doing just what we talked about.
Yeah, and that probability at that 85 strike in February is about 68% that'll be out of the money or above that that particular area.
2/3 of that magic number.
Right, which is your break even on it.
Right.
So you're buying it at a discount. And even if you don't get to buy it, you get to keep that option premium. Right. This might be one of those recurring strategies. If you're comfortable owning shares at a specific price, you can do it over and over again if it does not go below that 90 strike at expiration. All right, Kev, that's going to do it for you and I today here on Fast Market. But stick around right here on the network. Next Gen Investing's coming up next. Have a great day.
It's a 13-hour flight. That's not a weekend trip.
15 minutes to wait for.
I'm gonna take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see you. Ah, they're getting so smart.
Choose the app that fits your investing style.
Feel that? That's the beat of global markets, the rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity. Blockchain making transactions safer and faster. New markets born where they weren't before. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the income investing course and a whole lot more.
Feel that? That's the beat of global markets, the rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity. Blockchain making transactions safer and faster. New markets born where they weren't before. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
So what are you working on?
I'm searching for info on options trading, and look, it feels like I'm just wasting time.
Wasted time is wasted opportunity.
Exactly.
That's why TD Ameritrade designed a first-of-its-kind personalized education center. See, you just...
Oh, this is easy.
Yeah, and that's...
Oh, just what I need. Courses on options trading, webcasts, tutorials.
Yeah, their award-winning content is tailored to fit your investing goals and interests, and it learns with you. So as you become smarter, so do its recommendations.
So it's like my streaming service.
Oh, exactly. Well, except now you're binge learning.
Ooh, I like that.
Thank you. I just came up with that.
You're funny.
Learn fast with the TD Ameritrade Education Center. Call 866-300-9417 or visit tdameritrade.com/learn. Get started today, and for a limited time, get up to $800 when you open and fund an account. That's 866-300-9417 or tdameritrade.com/learn.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay. I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit your online broker today to learn more.
Here's a look at 100 winners and losers.
banking app.
Good morning, everybody. Welcome back to Squawk Box. We are live from the NASDAQ market site in Times Square. And so far this morning, you're looking at a mixed picture. Dow futures are up by about 35 points. S&P futures are up by just over a point, but the NASDAQ indicated off by about 20 points. Of course, we're waiting to see what happens with the job markets. Right now, we also want to tell you about a call coming out of Citigroup today. They say that they're cutting U.S. equities to underweight because they think the market earnings expectations still look too optimistic. If you look at the predictions that they have by Citi economists for a second half recession that they are predicting. So they think that at this point, they're underweight not only U.S. equities, but also underweight Japan equities because their local strategist there is cautious as well.
The House will be at it again, back at it today. Its quest to vote for a speaker to finally get a speaker. Lawmakers are set to return to the chamber at noon. Representative Kevin McCarthy, losing 11 straight votes, is reportedly negotiating with those members who oppose him. Joining us now is Dan Clifton. He's the head of policy research for Strategic Securities. Okay, at this point, I don't know. I still think McCarthy is going to be speaker, and I've always thought that. A lot of other people have thought all along it wasn't going to be him. If you get 91% again and again and again, who's going to get 100% if it's not him?
Well, Joe, first, good morning and Happy New Year. I think that we're coming to a real inflection point here after this week's events. McCarthy's team have been negotiating with a number of the objectors to see if they can reach some sort of deal. It feels like we're coming to a point where everybody's going to have to make a decision. And we don't see the opposition to McCarthy as monolithic. We see them broken up into three core groups. Let's face it, there's at least four members who are never going to vote for Kevin McCarthy. It's personal nature. But there are two other parts of that group that are probably gettable. And one of them is very focused on budget reform. So they're trying to create a better process so that there's not 4,000-page omnibuses delivered to Congress and told you have 3 days to vote on this, which happened in December. They're trying to create a better process. And you can see if there's a room for negotiation on something like that. I think that's what they're trying to get to. But even if you get an agreement today from those members, that's probably going to move about 10. He would 10 votes. That means he's still about 5 votes short. And that means that he's going to have some other type of negotiation. So we're going to have a good read if he's going to be able to make progress, probably at some point today, given the nature of the negotiations that happened overnight. And then if not, the party has to start thinking about whether they have to move on into a different direction. But to your point, and I think you're absolutely right on this, and that is that he's got 200 plus votes. Nobody else is even close to that right now. And he is really the one that has the most support in the caucus. And as long as that's true, he will still be the favorite to kind of come into this and be able to work out some sort of deal and negotiation. The conservatives have to figure out whether they're ready to cut a deal or not.
Right. How much I really want to weigh in. I mean, I'm wondering whether anyone else would satisfy some of these guys. There are some, from Batman, there are some men and women that just like to watch the world burn.
Joe, I absolutely agree. And if you look at some of the reforms that are being proposed, one member could recall the Speaker of the House. If that's the case, you're going to have endless votes to try and remove McCarthy or whoever's Speaker, rather than getting the actual work done for Congress. Another is how many conservatives are going to be on the Rules Committee. Again, I'm not opposed or I'm not advocating for anything, but I would argue if you have 3 or 4 of the opposition on the Rules Committee, it will be very hard to bring legislation to the floor. So I'm of the view that some of this is designed to shut down the House for the next 2 years, and that's okay in most instances. But when you have to raise the debt ceiling in midsummer, there's real work to. That's the full faith and credit of the United States.
Yeah, I've said the same thing.
to sell the 87 and buy the 80. By selling the 87 call and buying, hold down my control key and buy the 89. So again, we're selling a call spread that's further out of the money, but it's much closer this time. It's not the 90.92, it's going to be the 87.89. So we're sharing that 87 strike. The long call spread, remember, had the 87 strike. So does the short call spread. Now, when we put these two together, let's analyze that and take a quick look. All right, well, this is definitely a bit different. But what's similar about these two strategies? Well, they're range bound. They both like to see the stock move up within a specific range. And if it goes above that, they incur a small loss or a defined loss. And if it moves lower, a defined loss. But if it moves towards that 87 area, or in the case of the butterfly, that would be its maximum gain. Now, the maximum gain here would be $183. If it were to move below 85 on expiration or above 89, the max loss would be 16, right? So you can see, again, here's a comparison of two strategies that would like to see the stock move into a range, but quite a bit different in terms of max loss and max gain. Remember, these are complex strategies. Each of them has 4 options. So you always want to pay attention to any transaction costs. And of course, remember, these kinds of strategies could have some management responsibilities. If the stock ends up between the strikes on expiration, there could be obviously some management due to an exercise that could result in a stock position. Keep in mind, these all have short options, which can be assigned anytime. You obviously want to keep that in mind as well. All right, that's going to do it for our comparison of two similar range-bound strategies, but quite a bit different in their risk profiles. All right, now stay with us, because coming up next, we're going to build an example trade and look at selling an out-of-the-money put spread with Ben Watson. We'll have that after this short break.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watchlist, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Welcome back to Your First Trade. I'm Scott Connor. Now, let's talk about putting together an example trade that, of course, we'll put in our paper money portfolio. And today we're going to be moving towards putting together an example trade that involves selling an out-of-the-money put spread. Now, we're going to be using FDX, that's Federal Express, for our underlying symbol. They do have earnings after the market close on Tuesday. So we'll, again, make that consideration when constructing and going through the steps of building an example trade, as we always do here on Your First Trade. Now, before we get to actually constructing that example trade, let's bring in Ben Watson. He's the Senior Manager of Trading Education, TD Ameritrade. And Ben, welcome to Your First Trade. Pleasure having you back. And before we get into our example trade and building it, I thought maybe we could get gain some perspective by having you analyze the chart of FDX going into this earnings announcement, Ben.
Yeah, well, Scott, FedEx is one of those companies that's used sometimes as a bellwether for business activity and the health of the economy even. But over really the course of the last year and a little bit beyond, this is a stock that has been in a bit of a downtrend. However, the intermediate time frame, the last couple of months or so, following the last earnings announcement, we saw a gap down. It's been a little bit of an intermediate term uptrend. Now, over on the right-hand side of the chart, a little bit of a short downward trend, but that's been building what we call an ascending triangle. So we've got an inclining lower diagonal support level, a horizontal resistance level up around that 183.50 mark or so. But you also notice that the 50-period simple moving average has started to turn back and move higher. That's sitting right about the 166 mark at the moment. And in fact, if we get a bounce, the price of the stock tested that today on that gap down sell-off, but came up off of those lows ahead of the earnings announcement. So the potential is there for a bounce, maybe back up to that horizontal resistance that we talked about at the 183.5 area. But if it does go the other direction, you've got support at 166, right at that 50-period simple moving average, and then down at 161. And what's interesting about that 161 level is if we look at the longer-term chart, that 3-year weekly chart, and we go all the way over to the left, that was the most immediate previous resistance level pre-pandemic before the stock took a big move to the downside and then rallied strongly back up into that mid-2021 timeframe. So really kind of an interesting area that the price of the stock is in. You can also see that it's been in a series of bear flag moves to the downside, which show those short-term rallies, but continuing that downtrend. So we'll see what happens this next time as it moves towards that resistance level up around that 183.5. Scott?
Got it, Ben. All right. So yeah, looking at that chart, obviously a big drop in that last earnings announcement, but stock did try to recover a little bit. Now remember, mid or early October is when the S&P 500 hit its low. So it looks like just after that, FDX kind of came back with the market. A little bit of a downtrend here coming into this earnings announcement, but could you just repeat one more quick time where you mentioned a couple support levels there. Could you just mention those real quick and then we'll wrap up?
You bet. Yeah, 166, which is right at the 50-period simple moving average, and then 161.
All right, so that's how chart analysts are looking at this stock right now. Okay, Ben, thanks again for helping us get some longer-term perspective on this stock. All right, take care. See you soon on your first trade. All right, let's go into the trade tab on Thinkorswim. I've entered FDX in the symbol box. Now remember, the first steps, we always start with time, price, and volatility. What does a trader think about those three parameters? Time. Well, since the earnings announcement is coming out this week, we'll use the options that expire this week. So our time is going to be between now and Friday, 4 days. So I'll open up those options. Price. What does a trader think the stock might do? Now, again, we looked at the charts, but again, remember, chart analysis, just like anything else, is subject to interpretation. And there's no guarantees from those. But again, it's always good getting some broad perspective. Now, what we're going to do here in this example is, let's say a trader was thinking the stock would do okay after its earnings were announced and that perhaps they'd be in line and the stock wouldn't really move beyond what was potentially expected. Now, what does that potentially expected number move? Well, follow along with me. I'm looking at the MMM, the market maker move. That's about just a little over $11. Now, remember, this is a calculated theoretical number that comes from the current value of calls and puts and volatility levels to kind of calculate that expected move. And now we don't know if that's up or down, just to get an idea of how much the stock might move. So if the stock is at 168, that would take it down to, let's see, 158, 156, 155, somewhere in that range. So if a trader was thinking that the stock would do okay after earnings, maybe go down a little bit, but not beyond what the expected move is, well, maybe selling a put spread might align with that particular outlook. So let's put together selling a 155, 152 put spread. So I'll start off by selling the 155 put, hold down my control key, buy the 152.5 put. This is trading about 37. Now, I saw it trading a little bit higher during the day. I'm going to raise this to 45 just to make our math a little bit easier. We'll leave it as a day order, hit confirm and send. Now let's check out our max loss and max gain on this one. For this example trade, max profit would be, if filled at that limit, 45 cents times 100. That's the multiplier. That would be $45 minus any transaction costs. Max loss, $205. $2.50 minus 45, that leaves 205. So I'm gonna go ahead and send that one out. Remember, we're selling a short put spread, so we have a short put here, the 155 strike, and short options can be assigned anytime. Keep in mind, if the stock does move down to those levels, there's a higher likelihood of that assignment. And also, if the stock ends up between the strikes, of course, there'll be some management because that could result in a stock position. All right, and we also have two options, and keep in mind transactions. All right, that's going to do it for our example trade to kick off the week. Don't forget, we're back tomorrow at 4:30 Eastern Time. Look forward to seeing you then.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit your online broker today to learn more.
Since before, they'll tell you where negotiations stand. Plus, a focus on big tech, layoffs, and ad spending in 2023. What investors should be watching as the second hour of Squawk Box begins right now.
Good morning and welcome back to Squawk Box right here on CNBC. We're live at the NASDAQ market site in Times Square. Manager Ross Sorkin, along with Becky Quick and Joe Kernan. Take a look at U.S. equity futures. I've still got 2.5 hours set before the market set to open, and frankly, an hour and a half before we get the jobs report, which could move all of this around. But right now, the Dow looks like it would open up close to 30 points, about 29 points higher. NASDAQ down about 32 points, and the S&P 500 off just about a point. We'll show you Treasury yields right now. Again, a lot of this may move depending on what those numbers look like and how people read that in terms of what the Fed may or may not want to do about it. 10-year note, 3.727 right now. The 2-year at 4.473. Roger Ferguson saying they're going to keep their foot on the neck of the economy. Oil right now, WTI crude 73.47.
spend and retail is something to consider when that is still of this company's overall business. Consider that nationwide holiday e-commerce sales only rose about 3.5% this year versus the 8.6% last year. That's per Adobe. So we're already seeing consumer spend start to weaken here, which has been, of course, an ongoing theme. However, though, AWS is expected to continue to bleed a little bit as well, as big corporate clients are forced now to have their own expenditures, perhaps instead of outsourcing. Earlier this week, we actually got a note that UBS did downgrade both Amazon as well as Microsoft's Azure, saying it's the worst tone they've heard in years. And I think that speaks to Amazon's 2022. They saw their worst year since the dot-com bubble burst. They also are now well off. They've shed about $1 trillion since their peak in July of 2021, which was naturally the week that Andy Jassy took over. Now, I'm hearing all this speculation that we're going to get Jeff Bezos back. I think that's ridiculous. One man cannot take on the global economy, but it is unfortunate timing that we've seen about $1 trillion lost in value since Andy Jassy took over.
Jenny, the move in Salesforce, cutting 7,000 people, that was 10% of their labor force. This number, 18,000, though it's more, and for the people affected, it's certainly not minimal, but it's 0.01% of their sales force. And Jenny, 2 words for you if you think that Jeff Bezos not possibly coming back to Amazon. Bob Iger at Disney. CEOs come back when the things are hitting the fan, as they say. And I think with the news from Microsoft yesterday and the basically the warning about cloud, this is getting to a desperate spot.
I think this is a tough spot to be in. I also, another name that comes to mind is Howard Schultz. I mean, I do think this is not completely out of the question. I just think it's too much to put on one man that he could perhaps take on global headwinds. I mean, I'm not saying Amazon doesn't have its own specific issues, but I just think the broader trends show that retail right now, cloud, areas of broad weakness, is Jeff Bezos going to be the answer to that? I think that we just perhaps have to endure the fact that Amazon is not growing as massively as it once was.
Yeah, definitely. And I think this is a good company for the overall barometer and health of the economy. When you look at the retail side of their business, the cloud services that they're the leader in, they continue to deteriorate as far as growth in that segment goes. But we'll have to continue to watch this. And thanks to Jenny Horn, markets correspondent here on the network, breaking down the Amazon story here for us today. But now let's bring in Nathan Peterson, Director of Derivatives at the Schwab Center for Financial Research. Nathan, we're going over these numbers. Jobless claims go the wrong way, that the Fed doesn't want to see ADP numbers better than expected. We've got the non-farm jobs payroll jobs tomorrow, which is supposed to be around 200K. Is this going to be a thorn in the side of the Fed over the next several months, or should we see a break at least at some point?
Yeah, good morning, guys. Yeah, good question, Tom. I think, that is one of the big questions out there for the market to consider. Look, here's the way that I think about it in terms of what it's not so good for the bulls right now where we stand. Number one, let's say that the Fed stopped raising interest rates right now. Let's just say that that's it. They said, we're done. We're not going to lower, but we're not going to raise. We're still feeling the effects of what they did last year, and the question is going to be, how bad does that hit basically the economy and then subsequently earnings? We've seen the manufacturing data globally below that 50 level in contractionary territory. So that's one. Number two, I think the saving grace for the bulls we'd love to see, we've got 3 important inflation data points coming out over the next 3 weeks, CPI, PPI, PCE over the next 3 weeks. If we can get that to come in substantially below estimates, and we have seen within the IHS manufacturing, for example, at the beginning of this week, the prices paid component did come in. It is softening. It is moving in the right direction. That could show up within these inflation data points that we get in the coming weeks. That would be the bullish case. The other thing I think about, to your point, Tom, is about employment. So here we are. Look at those. Those are some strong numbers. I looked at the Bloomberg probabilities yesterday. It was 31% chance of a 50 basis point move in February. That moved up to 45% today, which tells you what the bond market thinks about that, or what those collective expectations, which are taking in the expectations from the bond market, see there. But what if inflation, it does come down, but then unemployment remains around 3.5, 3.6, and the job market doesn't cooperate? Do we assume that the Fed is just naturally going to throw employment out of their dual mandate and then just focus on inflation? So we've got a lot to deal with, and we've got a 17 PE on the S&P 500, which doesn't give us a lot of cushion.
Yeah, and that rhetoric that we're starting to hear from a lot of corporations. But, just to expand on that a little bit, Nathan, when you look at this, the Fed's, message to the market, we had some Fed speak today from Esther George, who's actually retiring, no longer a voter. Bostic came out. I mean, they're basically pounding the table that their terminal rate's going to be above 5%, but the market's not pricing that in. Is that an issue for equities at this point, or are they going to be wrong?
Yeah, it is an issue, and it has been an issue. The markets are so accustomed to the Fed being accommodative, and they're trying to call that peak hawkishness, and the Fed has just stood their ground, even back in the December meeting as well. They still kind of bumped up their estimates just a little bit, and they're maintaining their ground, and they're saying, hey, do what you want, markets. Go ahead, sell off or go higher. We're focused on inflation. We're focused on prices. We'll say it again. We'll reiterate it again. And so it seems like the markets continue to look for that next meeting. It's like that carrot in front of the donkey that, hey, the next meeting, that's when they're going to show us that they're easing. That's when we're going to get the Fed that we used to know and love. And yet the Fed's not doing that. It is an issue.
Yeah.
Tom, I've got another problem that I'm going to pose to you guys.
Okay.
Ready?
Yeah.
ADP and jobless claims got most of the headlines today, right? Because of their direct impact on inflation. But did you see the trade deficit?
Trade deficit number fell.
The trade deficit came crashing down. Guess what that's going to add to? GDP.
Right.
That's going to bring up next quarter's GDP estimates. And do you think in a weakened economy you want a rising GDP? So there's more troubles on the horizon because of that trade deficit number.
Yeah, and if you equate this to the equity market, Kev, I kind of wanted to hit on this before we have to take a quick break. If you see the upgrades and downgrades, I know a lot of analysts are out early in the year trying to change maybe some of their biases to companies, but we had downgrades and CrowdStrike, which we're going to talk about later on, Shopify, JW Nordstrom, Gap Stores, American Express, Capital One. Those are barometers that stick in my head that we're getting downgrades.
Those are recession fears.
Right.
Coming right to the top. So because everyone's, what does a recession do? It slows economic activity overall.
Yeah.
Swipers, right?
Yeah.
Overall economic activity, if it slows, that's going to affect the consumer, their ability to buy goods, and their number of swipes on the cards.
Right. And Nathan, do you figure that we're going to start seeing more and more of this as, I think those expectations for earnings are still elevated at this point. I don't know if they're too high. That's not mine to say until we actually get results. But do you believe that, that the market's too optimistic right now because the Fed's telling a different story?
Yeah, it is. It's an issue, and it's technology. You mentioned those downgrades. Look at Microsoft's downgrade yesterday, and Azure, and the slowing growth. I mean, Microsoft was, the golden child. Basically, that they were out of the big mega cap techs really holding up along with Apple. Look at Apple, 52-week low. So what the market's telling you, what the price action is telling you, is they expect earnings to be bad in tech. They expect tech to be basically either posting soft results or then warning coming up based on the price action. If you look at the NASDAQ as well, we talk about the S&P 500 being about 300 points away from that October low back at 3,500. The NASDAQ, guys, is about 100 points or a couple hundred points here. We're approaching a support level is around 10,250. But if you go to that low that was on the same day that the S&P hit 3,500, that was 1088 at the open. We're starting to creep down there. What's my point? Well, the price action is telling you what the sentiment around growth and earnings is within tech. And then I think if and when, I'm going to say if, I don't know when, we do break that low, that's not going to be good for sentiment. That's going to probably spill over into the overall markets if you see the NASDAQ trading at new 52-week lows.
Yeah, and, typically into a recession, Kevin, we're taking the brunt of it because the NASDAQ rallied so high into 2021, at the end of 2021 when it finally snapped. But, there's the valuations and the PE multiples on some of these companies in the neck still aren't probably where they should be. And Nathan mentioned 17 times, for looking for the S&P 500, that's still elevated and people are calling for a recession.
And if the earnings part of PE comes down, Tom, that number keeps going up and it'll stay elevated until the price part of PE adjusts. So we're not painting a very good picture here, Tom, obviously, but the good news is, if there's any good news, we've already discounted a lot of it, right? It's not it's not at a 19 PE, so it's coming down. The fear is, though, the risk is fourth quarter earnings. If these start missing handily because of that slowdown that Jamie Dimon and all the bank CEOs warned of, then this PE ratio number could start going up for the wrong reason because of the E going down.
Right. This next earnings season's going to be a wild one. It starts next Friday. All right, guys, let's take a quick break here. But after that break, we're going to discuss Oracle, which outperformed the overall market and tech sector just last year, but got another upgrade this morning. Fast Market's coming right back.
When traders tell us how to make Thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade. It's a 13-hour flight. That's not a weekend trip.
15 minutes.
Oh, wow, I'm going to take off. Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Thanks.
We'll see you. They're getting so smart.
Choose the app that fits your investing style.
Welcome back to Fast Market here on the TD Ameritrade Network. Next stock we're going to discuss here is going to be Oracle. Let's bring in George Tillis, Senior Markets Correspondent here on the network, to help us give us a background here on this stock. George, it outperformed last year, only down about 7%. It's bounced off the $60 level just probably 3 months ago, back above 83 level at this point. What's Oracle doing right here, George, that the rest of the tech sector can't seem to get straight here at this point?
Yeah, this is an interesting situation. I think there's a theme going on. If you look at companies like Oracle, Hewlett Packard Enterprises, IBM, all three of these names are legacy technology and value-based technology companies with generous cash flow, free cash flow, as well as operating cash, as well as growth. In the case of Oracle, which is actually expected to increase on a forward basis. I think the company, if you look at last quarter's results, they demonstrated pretty stout growth when it comes down to enterprise resource cloud as well as their infrastructure cloud business. But I think the traditional enterprise resource business or management business, database management, and there's also artificial intelligence that they're actually moving into, are a few catalysts for the company on a forward basis, which according to Jefferies, which upgraded the stock to a price target of 105 from 90, they actually see earnings estimates rather conservative for the company. Now, the expectations for sales are somewhere between 17 and 19%. Now, and that's not all organic. Most of that is coming from the Cerner acquisition, the $28 billion health database management company that Oracle purchased last year. But the earnings expectations for the next quarter are somewhere between $1.17 and $1.21. That is matching the high end of last quarter's results at $1.21. So the guidance the company provided after they reported in December was rather conservative. And I think, Kevin was talking about multiple compressions earlier. If you look at companies that are seeing significant price declines as the last few months, these are companies that haven't actually adjusted their earnings down. I think Oracle has. And I think this is one of the reasons why Jefferies finds the stock rather compelling right now.
George, This stock is a great story because how quickly they went from on-premise to cloud-based. And some of it was through acquisitions. You mentioned Cerner that they did this past June. Also, NetSuite in 2016 really accelerated that movement. And this is a company that was dead in the water for a couple of years. And now when other companies have been overvalued, it's growing based on cloud-based. So I understand this is a legacy player that seems like a dinosaur, but they've reinvented themselves, George. This is a good story here.
It is. I mean, if you think about all the acquisitions the company's made, they did that because they didn't find organic growth available to them. Now there's return on investment. It seems to be, at the very least, based on price performance from the market, that these acquisitions are now manifesting into positive EBITDA growth for the company. Because like you said, Kevin, the company's not growing all that much organically. It's got inorganic growth through acquisitions. But I think right now the company seems to be well positioned, especially, as you mentioned, both the hybrid cloud on-premise and, of course, off-premise cloud-based business, both in database management and infrastructure, as well as their traditional enterprise resource management software, which is really their bread and butter based business. So overall, the company seems well positioned, not only from its growth profile, but also its balance sheet and its operating cash position, which continues to prove, and that actually manifests into improving net income margin, which is close to 20%, which is actually pretty good, compared to other tech companies in the large cap space.
Yeah, and they actually increased operating margins last quarter also. You haven't seen that theme across the board in the tech space, but this legacy infrastructure IT name continues to do well. All right, thanks to George Tilla, Senior Markets Correspondent here, helping us break down Oracle. But Nathan, I'm going to bring you back in here. As I mentioned, the stock's outperformed a little bit, getting some positive response today, but now negative. It seems like this 85 level, if you look at it on a chart over the last year, seems to be some resistance here at this point, even though we got the upgrade today.
Yeah, you're right. I mean, if you look at the chart, that's basically where it, gapped up post its last earnings last month, and then, sold right into it. So, yeah, that looks like a key level. But, hey, Tom, a lot of tech companies are envious of, they'd love to have Oracle's chart. It's basically flat from 1 year ago today, which is pretty impressive when you consider what's going on within technology over that same time frame. And I think the reason is obviously, George hit on a lot of good points. They do have some of that growth that's out there, but this is where money goes to hide. If you're looking for tech exposure, you got a 15 forward PE. So you got a sub-market multiple. You got that rich cash flow, and then you got a 1.5% dividend yield. So that's, the money flow based on the price action is basically showing you where investors are placing their votes. So when you look at a chart like this, that they don't have earnings coming out till March. And I think, look, guys, as you look at option strategies, if you're thinking today, if I'm going to put on a bullish or a bearish option strategy, you better have a view of the overall market and what you think it's going to do. I mean, that should at least be one of those check boxes within your analysis. So, if you think there's going to be continued weakness in technology, you want to take that into consideration. But I was, acknowledging the upgrade that we have from Jefferies today, acknowledging the relative strength within the price action on the chart. And let's say you do have a bullish thesis on Oracle based on some of those premises there. One of the strategies you could utilize that isn't too capital intensive is a long call calendar. So what I was looking at is something like selling the January 27, at the time it wasn't at the money, at the 85 strike. That is kind of like that resistance level that you identified, Tom. And then buying the February 24th long call. So that generates your long call calendar. And, when I look at a strategy like this, you can determine your level of bullishness based on the strike price that you select. So I basically went at the money. And the reason I did that is kind of twofold. Number one, I'm a little bit concerned about tech here over the next several weeks as we move into earnings season or generally the overall market. Correlation can move to 1 if we do get continued sell-offs. And why am I concerned? Let me back that up. It's the NASDAQ kind of selling off, and I was suggesting that it's getting towards those lows that it saw back in October. what would be the leading candidates for that? Well, it's the likes of your Apples, your Teslas, your CrowdStrikes, your Datadogs, new 52-week low today. You're seeing these key names that are hitting new 52-week lows that then are pulling the major down, which, it's just not good technically. So with a strategy like this, with those expirations, I was also going with the at the money because, guys, this, if you look at a time decay curve and you look at the last 30 days until expiration, it's the at the money contracts that accelerate the fastest in terms of time decay. So I wanted to make sure you get positive theta out of this strategy. I wanted to make sure there was a positive delta just in case the stock does continue to move above that 85 strike. And let's say we get to that expiration at Jan 27 and you're at, the stock is above your 85 strike. Well, you could potentially roll it into a bull call spread. That's one way to adjust the strategy.
Yeah, let's break this this example trade down here for us here, Nathan. Buying the February 24th weekly 85 strike call, that's 50 days till expiration. Selling the January 27th weeklies 85 strike calls, that's about 22 days till expiration. Paying roughly about $1.08 debit for that. That's your risk, $108 per spread. But Kev, you got a nice wide range here, 82 on the downside and about 88.50 on the upside, where you have a range where you can still remain profitable. Nathan mentioned the ability to roll that short option as you get closer to expiration over the next 3 weeks if the market's open, liquidity is provided. But you're not paying a lot for this call calendar here, Kev, and it's flexible. As Nathan said, he put it at the 85 strike. That seems to be an area of resistance. You want it to go to that area, but you've got a range. But if you're more bearish, you can pick another strike based on that. But you're buying a lower implied volatility on an aggregate basis than you are selling, and you're avoiding that next earnings event.
Here's the positives of this strategy that Nathan just gave us. It is a relatively low debit. Why? The short side of this, Tom, is 3 weeks out. Right. So he's gone a longer dated, which hurts you in the theta department because theta picks up as you get closer to expiration. That short option is still 3 weeks away, but that number will only rise as you get closer to expiration. If you get near 85 at or near, it'll probably, I don't guarantee this, but it'll probably be worth more money if it works towards 85 and stays there. And because it's all the way out till February and then January 27th short, you don't have to defend it quite as much.
Yeah, and that's another reason why it's so inexpensive is because you're selling a 3 week out option against your long option also. And I was just looking at the near term rolls on an at the money call on a week to week basis. Those can trade 60, 65, 75 cents. So those credits that you can potentially get if you do adjust this just on a week to week basis chips away a lot.
It's a 4 weeker, even though you're out as far as you are, it's still a 4 weeker.
Yeah, a good look at a longer duration type of trade where you're not selling such a near-term option, still giving yourself 3 weeks on that to see if it settles down. All right, thanks to Nathan Peterson here for joining us, breaking down the markets and the example trade here in Oracle. But coming up after the break, Kevin and I are going to be joined by Andy Swan from Likefolio for a discussion on Roku, which just announced their own branded TVs. Maybe get some more subscribers there. Stick around. Fast Market's coming right back.
Watchlist can help you keep track of securities you're interested in. To add a watch list to the left sidebar, select the plus sign, then watch list. When the default list appears, select the name box, then create watch list. Enter a watch list name. To begin adding securities, enter a ticker symbol in the symbol box, then select enter. Continue adding all the symbols you want in your watch list, then select save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then add to watch list. From the Scan tab, right-click a security and then add to watch list. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back to Fast Market here on the TD Ameritrade Network. I'm Tom White, joined by my co-host Kevin Hinks, but let's bring in our next guest for our cash tag segment. It's going to be Andy Swan, the co-founder of Likefolio. Welcome back to the show, Andy.
Hey, thank you. Happy New Year.
Yeah, Happy New Year to you too. So we're talking Roku's stock dumped over 80% last year, but they just announced some new TVs that are going to be their own brand. And they came out today and said that they added, that their active accounts exceeded 70 million this past quarter. That's about a 16% jump from the same level in 2021. Are you guys seeing data supporting the growth that we're seeing here?
Yeah, I think people love the Roku platform. They even like some of the ad technology that Roku brings to the table. What investors don't like, and I have to say I'm with them, is all of this distraction that Roku seems to have brought on itself. At first it was creating original content, trying to be the next Netflix or HBO, and then now they're going to make their own TVs when the reality is they're already in, over 1/3 of TVs sold in the United States, and those relationships, I think if they focused on the tech, could continue to grow. And, they've also got their toes dipping into this smart home segment, which, if you think about it, is a security camera for your home, and they kind of compete with Ring and Google Nest and all of those. So it just seems like this company feels desperate to find its next leg up instead of focusing on what it is truly great at, and that is the platform, that is, the ad tech that they can deliver. And so at this point, we're not sure where Roku goes next. It's always kind of the next thing. But what we are sure of is that they're starting to lose the consumer in some way to exactly what we had hoped would not happen as followers of Roku, and that is everybody talks about, but what about Amazon? But what about Apple? The big guys, the big monsters in the room, and for Roku, it looks like it's coming true. We're seeing Apple TV demand growth on the Amazon Fire side. A small pullback, but nothing like we're seeing in Roku. And I think it's just, an absolute condemnation of the way that Roku has handled the last couple of years, spreading themselves so thin that they forgot exactly what kind of company they were.
Andy, this is a best of times, worst of times story here for Roku. As you know, $490 during the pandemic, down to $38. Now, some of that's justified. It was the valuations were insane when it was up there, but now the valuations are actually on the low side in this number. But Andy, I want to touch on what you were talking about here with making their own TVs. I traded GE, as you know, for 21 years standing in that pit. So I know everything Jack Welch said for 21 years. One of his theories was make your back office someone else's front office, which means if someone's making TVs really well, why compete with them? Let them do that and then buy the TVs. Why are they trying to get into the hardware business when this company seems to want to be a streamer, Andy?
Yeah, it does. And I think the big question is, Yeah, I mean, why are they getting into home security system or video? Why are they getting into producing TVs? I think that leads you to the next question is, does the executive team not have, faith in the growth potential of their core competency, which is even more concerning than the things that they're doing on the peripheral. So I think the natural answer to that question is that the company does not believe that its core platform technology is enough to justify the growth goals that they have. And so they're kind of flailing out there trying to find the next big thing to own a vertical, which is really difficult to own. And I don't know, if you guys have been into a Target or a Best Buy lately, but these TVs are really cheap. They can't be making much money on these.
Right.
You can get a 70-inch TV, I think, for $500 or $600 now that hangs on your wall. I'm not sure where they think the big margins are going to be in producing these pieces of glass that hang on your wall. To me, it's all about what's coming through the pipe, and Roku is best of business in figuring that out for you and enabling that. Stick in that lane, be the one partner everybody has to have, I think would be the better solution, but not the route they're going.
Yeah, and Andy, on that note, creating their own TVs, while it might take away, maybe the access that they have to the consumer moving forward, but at the same time, the OEMs that they had partnered with, doesn't this create some friction for them and some possible headwinds if you look at this? But at the same time, the data says that they're still growing, and this is supposed to be an aggregator. This is what I always thought. It's always an aggregator at this point, and it should be. It's the new cable, right? Everybody wanted to cut the cord, and Roku was one of the first ways to actually aggregate all these, streaming services that we have. Is that what they should stick to, or is your data reflective of that at all?
Yeah, I think so. I think there's some desperation at Roku probably because ad spend is falling, and they had bet a lot, of their company on being able to deliver ads. But I think that comes back, and if you could just become the default aggregator, become the default ad server for people and for companies and for your partners, I think long-term that's probably the better play than going out and competing with the very people that you rely on, whether it's on the content side or the equipment and hardware side. I think Roku would be better served knowing their role and becoming and staying very, very good at it, because this is an amazing company that started, not that long ago from nothing. So to even be where they are today is an unbelievable accomplishment. I just think they may have gotten caught up in Wall Street's growth expectations a little too much and are flailing as a result.
Yeah, and they don't have earnings for a while, but we're on multi-year lows on this stock going into this. If you guys did have an earnings score on this, what would it look like?
Pretty bearish, negative 54, which is significantly bearish in our world. We think that the risk remains to the downside for the stock even after the massive sell-off that Kevin alluded to.
All right, great stuff as always. Great data as always. Andy, appreciate it. Happy New Year. Thanks for being on today.
Thank you.
All right, that's Andy Swan, co-founder of Lightfolio, breaking down the data.
If you wanted to buy 100 shares of Roku, it would cost you $4,200, right?
Capital outlay, yeah.
Right. So if you do something in the diagonal family, or stock replacement as we call it, you can do this. I've got all the way out till March, 71 days, Tom, out till March, buying the 40 call, selling next week's January 13th 46 call, right? And I'm spending about $6.81, $6.80. So basically for 19% of the price of the stock, you could put on a fairly aggressive upside play. Obviously, you can do this directionally bearish as well. But if you're looking to buy this over the next 2.5 months, this is one way to do it for a fraction of what you'd buy the stock.
Yeah, and less capital intensive, right?
Yes.
You're defining your risk on it. Now,
$4,200 versus $680.
It does cut down your duration because you're using the option market, so you have to take that into consideration
You could
also.
extend that too. You could go out further, but it'll cost you more money.
Exactly. So let's break this example trade down that we're looking at here. Buying the March 40 strike call, slightly in the money, selling the January 13th weeklies that expire in 8 days. The 46 strike call, it's a $6 wide call diagonal to the upside. You're paying roughly a $6.80 debit for that. That's about $680 in risk on this particular position. Kev, your break even is about 41.5 on this, but you do have that ability to roll that short option on a week-to-week basis, collecting credits. If the market's open, liquidity is provided. You have some assignment risk on that short 46 call over the next 8 days. But this, you're defining your risk on this, Kevin. You're giving yourself an opportunity. Even if it stays here, you'll have that ability to potentially roll or adjust that short strike.
Think about 71 days out. If you were to roll every week, that sounds like around 9 or 10 rolls you could do.
Right.
So greatly chipping away at that 680 debit.
Yeah.
And lowering, remember, when you lower the net debit, you lower the break even.
Yeah, and you're paying more. You're paying about 80 cents more than the width of the diagonal, Kev. So that means if this stock were to somehow spike up above $65, $70 per share, you would have some risk on the upside a little bit too, that 80 cents, that extra 80 cents in risk. But that happens if the market's open. Maybe you'd like to, maybe adjust or roll or close this, depending on the situation and the timing on it.
This is a trade that if I was looking at this and watching and it got up near $45, $46, $47, you would extend duration, right? Buy in that call and move that strike higher up and just stay with the long deltas there.
Right. And to your point, if you're more bearish on this, buying a put diagonal, maybe using
same
the
exact thing, just flip it.
Right, just flip it where you're buying, maybe that 40 put and then selling maybe a 35 or a 34 strike
and
put.
And if you want more duration, if you think it might take till June, you could do the June. Just remember, it's going to cost you more in that net debit.
Yep, and base it on your duration. I like that earlier what Nathan said. You have to have an assumption before you get into a position. Have an assumption on where you think a stock may be going, up or down, or remain the same before you get into that position.
Very few of these stocks, Tom, can dodge a global sell-off. Right? Amazon had news that had the stock up pre-market. Now it's down because why? Because of the data that came out and the stock reaction.
Right. Good look at it. An example trade in there. Great data once again from Folio. All right, Kev, let's take a quick break here. But after that break, we're going to take a look at moves in CrowdStrike, which has added to its dismal 2022 performance with a downgrade today as the cybersecurity stock remains under pressure. Fast Market will be right back after this short break.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on tdameritradenetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Welcome back to Fast Market here on the TD Ameritrade Network. Before we take a look at CrowdStrike after the downgrade this morning, let's bring in Ben Lichtenstein, Senior Futures Contributor here on the network to help us break down markets. Ben, we're just off of session lows here as weakness continues to start the year.
Yeah, we're under pressure here, Tom, but still kind of limited in terms of taking out key areas that were established down below. The S&Ps, the SPX down to 3802, still holding up above the lows from earlier this week. Got the NASDAQ down to 10,742. That's off the mid-Dece high. Just to kind of put this into perspective, we were up around 12,166, if you remember. So just kind of pointing out some of the weakness we've seen as we've come off. And, Tom, I think you could chalk it up to some of the numbers we got this morning, the jobs reports, the weekly jobless claims, the Challenger job cut report, and the ADP all coming in stronger than expected and showing basically that labor conditions here in the U.S. remain very strong, and ultimately that opens up the door for the Fed to continue this hawkish tone and approach towards combating inflation. Now, the move lower in the indices actually sent the dollar higher. I'm not sure if you saw, but back up and through the 105 handle. Last I looked up to 105.06, and that's weighing on some of the commodities like gold and crude. So gold's actually, crude's a little bit higher now off the lows that we saw earlier, but definitely weighing on gold here. And the dollar almost 200 ticks off the lows that we saw just earlier this week. So seeing some movement here, but it's all relatively contained for the most part. Even that dollar back to 104, we're hanging out in the middle of the range that we established last year, 94 up to 114.
Yeah, Ben, if you look at that dollar, hitting month highs earlier in the session above 105, we continue to see that moving higher as it has. Maybe it looked like it bottomed out just below 104. Does that create more headwinds for equities moving forward?
Well, I think if we continue to the upside, right now this is still just, I think, a blip on the radar in terms of the bigger picture. And again, that chart just kind of spoke to my point, how we were at 94 to begin last year. We topped out around 115, 114, and now we're hanging out right around 104. So in the middle of that range. And that kind of speaks to what you would see if you pull up the 10-year yields, for example, not necessarily right in the middle of the range like the dollar's pinned it or pegged to that 104 level, but 10-year yields, there you can see we're talking off 4.3, above 2.6, hanging out around 3.7 for the most part in the middle of the range. So for me, when I look at markets right now at these levels, it looks like, well, not only do we have well-defined upper and lower extremes to keep an eye on in terms of parameters if we do get a high conviction move, a breakout one way or the other, but it looks like they're just, again, relatively contained and waiting for that next catalyst. So far, it wasn't the Fed minutes, wasn't any other data that we received this week yet. Maybe the jobs report tomorrow will do that. But again, it seems like investors and traders are kind of settled in for the long haul here.
Yeah. Hey, real quick, Ben, on crude oil, got some inventory data last night and this morning out of the EIA. It nearly hit $75 a barrel, but we're under pressure again. Still positive territory. But what's your take here on the charts on oil?
I was watching crude, and we've come off significantly. Actually, today down to 72.46. Now we're rallying back here up to 73.92 right now. We're up about 1.5%. But I did notice, to your point there, we did see some inventories activity today. We saw that dollar spike up here, so I think that weighed on crude a little bit earlier this morning. But I also noticed, Tom, a natural gas large draw in the inventories there. That's actually sent, the price went down to $3.65. So we have been watching energy products in general come off. RBOB, gasoline, price at the pump. Some of this is demand related, Tom. Some of this I think is weather related as well. Cooler temperatures than normal. Warmer temperatures, I should say, than normal across most of the U.S.
Yeah, and natural gas hit a 52-week low earlier in the session. So that's one to keep an eye on. Warmer temperatures than expected, especially across Europe. All right, thanks to Ben Lichtenstein, host of the Future Show here on the network. Kev, we heard from the markets from Ben, some of the asset classes, but we're talking cybersecurity now. We're talking CrowdStrike. And this seems to be one of those names where every time I read an analyst note on it, it seems like we're positive on cybersecurity. The hacks are coming. There's going to be more of them. We need cybersecurity in our lives moving forward. And CrowdStrike, if you look at their numbers, they've got really good numbers. Average revenue, recurring revenue, grew 54% last quarter to $2.34 billion. These are pretty solid numbers, but then the CEO gives weak guidance last quarter also.
Well, CrowdStrike is an interesting company because it's a cybersecurity leader that everything you read about, they have competitive advantages over other cybersecurity companies. And the problem, Tom, and a lot of this is valuation. With everything, it's sold off from in the high 200s down to where it is now, Tom, and it's still got a big negative PE. So the valuations and the new environment we find ourselves in with higher interest rates and fear of recession is hurting all these companies, especially their stocks. Now, the more you read about, I'm not a cybersecurity expert, needless to say, but this Falcon, their product, it's crazy efficient. And the more it does, it stops trillions of things a week, it says. And the more it does, every time it does, it gets more efficient and more and stronger because it uses AI to do it.
Yeah, machine learning.
Yeah. So this is state of the art, but that didn't stop the stock. And its peak, Tom, how about this? It was 100 times forward earnings. Now it's come down significantly there, but the valuation is still a problem, Tom.
Yeah, and Jefferies upgraded or downgraded it today, put a price target of 120 from 175. They got a hold on it, but one thing that stuck out to me, Kevin, in the note was while he continues to view CrowdStrike positive, it's a growth name.
And there it is. That's
growth name.
I mean, not a good PE, growing, not a lot of earnings income yet. You know, it's just that's what the market's attacking right now.
Right. So I wanted to look at that, Kev. If you look at the chart on it, it's hitting 2.5-year lows during today's session. Implied volatility spiking up a little bit, but it's still at the lower 1/3 end of its recent 52-week range. So I wanted to look at a strategy because a lot of people look at this and go, oh, it's 2.5-year lows. Other analysts like this stock, right? This is just one analyst coming out and saying, hey, I don't like the stock here. I'm going to downgrade it. Well, you missed most of the move anyway.
That's low-hanging fruit, right? You don't like something growing. Eventually, there's going to be a day, Tom, where growth comes back into favor. I don't know when that'll be and from what level, but eventually people are going to like growth again, maybe when interest rates stop going up.
Right. Okay, so let's look at a strategy here. And it's capital intensive, right? It's selling a cash secured put here where we're just going to go out to the February monthly cycle. And if you think that, hey, maybe it's bottomed out, maybe it's going to consolidate, maybe it goes higher, this may be a strategy that might work in that type of environment. So we'll look at the February 90 strike put. So you got 43 days till expiration in just selling that put. So you have to have capital, right? You're collecting about $4.85. And you look at the risk profile here, that's the most you can make on this, right? $485 per spread. But that takes your break even down to $85.15, where you'd be actually purchasing the shares on this type of strategy. Now, your risk on it, about $8,500 on it if the stock were to go to zero. So you've got to keep that in mind. But Kevin, what's your take here on people that maybe want to get into a stock, but then maybe want to give themselves some cushion or just want to collect some option premium?
Cash secured put is an interesting way to do that. Why? People, the knee-jerk reaction is, well, if I sell the 90 put, I buy it at $90. But you sell it for $485, and that's added on. So like you said, you buy it for $85.15, not $90. So there's advantages to do this. It's a popular strategy for people that can afford it. Tom, you got to be afford to be able to do this.
Right.
So, another way to do it is the put vertical, but this is certainly one way that a lot of people with medium to larger accounts do. But Tom, this is a great tool for doing just what we talked about.
Yeah, and that probability at that 85 strike in February, it's about 68% that'll be out of the money or above that that particular area.
2/3 is that magic number.
Right, which is your break even on it. Right. So you're buying it at a discount. And even if you don't get to buy it, you get to keep that option premium. Right. This might be one of those recurring strategies. If you're comfortable owning a shares at a specific price, you can do it over and over again if it does not go below that 90 strike at expiration. All right, Kev, that's going to do it for you and I today here on Fast Market. But stick around right here on the network. Next Gen Investing's coming up next. Have a great day.
It's a 13-hour flight. That's not a weekend trip.
15 minutes.
Oh, wow, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position?
You two are all set. Have a great flight.
Hey, thanks.
We'll see ya. They're getting so smart.
Choose the app that fits your investing style.
Feel that? That's the beat of global markets, the rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity. Blockchain making transactions safer and faster. New markets born where they weren't before. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the income investing course and a whole lot more.
Feel that? That's the beat of global markets, the rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity. Blockchain making transactions safer and faster. New markets born where they weren't before. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
So what are you working on?
I'm searching for info on options trading, and look, it feels like I'm just wasting time.
Wasted time is wasted opportunity.
Exactly.
That's why TD Ameritrade designed a first-of-its-kind personalized education center. See, you just...
Oh, this is easy.
Yeah, and that's...
Oh, just what I need. Courses on options trading, webcasts, tutorials.
Yeah, their award-winning content is tailored to fit your investing goals and interests, and it learns with you. So as you become smarter, so do its recommendations.
So it's like my streaming service.
Oh, exactly. Well, except now you're binge learning.
Ooh, I like that.
Thank you. I just came up with that.
You're funny.
Learn fast with the TD Ameritrade Education Center. Call 866-300-9417 or visit tdameritrade.com/learn. Get started today, and for a limited time, get up to $800 when you open and fund an account. That's 866-300-9417 or tdameritrade.com/learn.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay. I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit your online broker today to learn more.
Sell. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Good morning, everyone. Thanks for starting your day with us here on the TD Ameritrade Network. It's time to talk futures. I'm Ben Lichtenstein, and we've got a great show planned for you this Jobs Friday. Let's get started right away, just like we do every single day. A quick check-in on where things stand as we head into the cash open and some of the overnight price activity we're seeing, first and foremost, Asian markets. And not a lot of conviction for the most part, one way or the other. You can see some mixed activity here in terms of where things closed as far as Asia, checking in on European markets, the DAX, the FTSE, again, kind of mixed, just not a lot of conviction here as we're in a bit of a holding pattern, I think, waiting for that jobs report here today in the U.S. And, well, as European markets head into the late day trade, you can see DAX lower slightly, that is, the FTSE fractionally higher. And that's a very similar situation in terms of what we're seeing here in the U.S. You can see 2 of the 4 majors are higher, 2 are lower. You've got the ES and the NASDAQ coming under pressure here, but just fractionally, again, inching below that unchanged levels. We head into the cash open, nothing to get too worked up about, checking in on some of the other top traded products in terms of where things stand, because the dollar's been bid this week, coming off that 103 handle, back up and through to near mid 105. We're talking overnight, it got up to, what was it, 105.41. Looking at gold right now, it's holding its own considering some of the strength we've seen in the dollar at 1840. You've got crude, which has been holding above 70, but after selling off earlier this week, kind of losing some of that momentum lower. And then look at what's going on here with the VIX. It's parked, simply put. We're going to pull some charts in just a couple minutes, but first let's get into what's behind some of the price activity you're looking at there and how the focus for investors and traders this morning, labor conditions here in the U.S. after the stronger than expected ADP, Challenger, and jobless claims data this week. It's all eyes on the monthly figures this morning. The non-farm payroll is expected to show 200,000 jobs added last month. Now, that's going to come in, if it does, below the prior 263,000, but still signaling a very strong labor market here in the U.S. The unemployment rate, you can see, expected to remain flat at 3.7%. We'll be keeping a close eye on, well, private manufacturing payrolls, but also the wage components, participation, and, well, let's take a look at wages. Average hourly earnings expected to uptick to 0.6% from 0.4. We're going to be looking at, well, the participation rate, which came in at 62.1% prior. So again, multiple components associated with this number. And, you know, as I look at this, I think about how a strong number here today would be supportive of a soft landing or avoid the recession altogether, possibly narrative, but also supportive of the Fed will have to raise higher and possibly more aggressively narrative now. As a result, you can see why markets are a bit on edge as we head into this one now, even more so than normal, it seems like. Okay, now speaking of how the Fed will react to this ultimately and that upcoming Fed meeting in February, we heard from Federal Reserve Bank of St. Louis President Bullard yesterday, who said that inflation is likely ease slower than markets expect. Rates need to remain higher for longer to keep pressure on prices. And while inflation's moderating, it's still too high. Atlanta Fed President Raphael Bostic said basically officials remain determined to beat inflation, and it's the biggest headwind to the U.S. economy. And it's not just here in the U.S. that inflation remains a headwind. It's a global issue, right? We found that to be true into the beginning of the year, the end of last year, and especially overnight we saw that with the EU, the CPI data for last month released. Earlier in the week, we saw the EU PPI ease some on that month-over-month number, but still 27% up for the producer side of things year over year. There you can see the consumer side of things. It's also eased while the core actually inched up. Taking a look on a month-over-month basis up to 0.6, well above last month, well above prior, and year over year still at stubbornly elevated levels of 5.2%. They were looking at the 5% and prior levels at 5% as well. Okay, so that's a good look at where things stand as we await the jobs report here this morning and what's on the minds of traders and investors as we await the opening bell. Let's get into the price activity we're seeing into the open here this morning. I wanted to look at some of the selling we saw yesterday and what we're looking at overnight, and then kind of put it into perspective in terms of where things stand on the bigger picture. So let's begin with the more granular, and then we'll work our way into that longer term time frame. You can see some of the selling off the highs from the overnight session yesterday. We were up around 38.85, sold off into the cash open, if you remember, kind of chopped for the most part sideways yesterday and closed near the lows. Now I do want to point out throughout the overnight session here, that's that light 2/3, the right side of your screen here. Not a lot of conviction one way or the other. I pointed out when we looked at the four majors at the top of the show, the mixed activity we're seeing and how 2 of the 4 are positive, 2 of the 4 are negative. Actually, all 4 are negative right now, but kind of hovering around unchanged, right? But here, take a look at all 4 of them collectively because a very similar pattern. You can see the chop trade throughout the dark shaded areas here on your screen. That's yesterday's day session trade. And then again, the limited conviction in the overnight session. We've been range bound overnight, simply put. And well, it's not just overnight, right? Here you can see where we are in terms of this week's trade and price activity this week relative to last week's highs and lows. And look, very much range bound as well. Not a lot of conviction one way or the other. Let's take another step back and look at the hourly candles and where things stand this month so far relative to the D's high and low. And you can see we're range bound, contained, holding near the lower third or quarter of that range from last month, 4180 down to, we'll call it 3800, but still holding above, again, those lows from last month. So again, somewhat limited in terms of real conviction one way or the other. Checking in on where things stand in the S&Ps relative to the 50 and the 200-day moving average, the yellow line, the longer dated, the 50 is the blue. Now, this is a pretty good representation of what we're seeing in terms of all 4 majors because the S&Ps are below the 50-day moving average, right? All 4 of the majors, the S&Ps, NASDAQ, Dow, Russell, below that 50-day moving average. You can see how the S&Ps are below the 200-day moving average. And in fact, the only one of the 4 that's above the 200 still is the Dow. And I mentioned how everything's relatively contained, right? Look, the VIX, a pretty good reflection of that. It's hanging out around 22, 23. It's been comfortable in the middle of the range that we established last month. So as I look at this price activity and all the events we've seen, the focus that investors and traders have had on inflation, the Fed, the minutes, and everything that's been going on the last couple of weeks into the end of the year, and as we begin the new year, we're really just kind of waiting for that next big catalyst to provide the big move. And again, price activity has been contained, as you can see. Okay, let's bring in Kevin Hinks. He's joining us this morning, senior equities contributor on the TD Ameritrade Network, to help us break it down. Kevin, I started off the show talking jobs. It seems to be at the top of the list for everyone this morning.
Good morning, Ben. You know, looking at your watch list before 7:30 Chicago time, 8:30 Eastern is important, but it's insignificant, right? It means nothing until that number comes out. What yields are doing, what indices are doing, what the Dow is doing.
It all could change.
All that, right. The real start to the trading day is 7:30 Chicago time, 8:30 Eastern when we get these numbers. And here's the problem, Ben. Here's the problem that I see. You've got expectations for non-farm payrolls to come from 263,000 last month down to 200. You've got expectations for wages, our average hourly wages, to come from 0.6 to 0.4 and 5.1% to 5%. Well, Ben, every number this week in terms of the labor market is coming stronger than expected. So these expectations, exactly, Ben. Doesn't mean it'll happen, but The
and as
data
you say
is
that,
screaming at you that this is going to be a warmer number than we think.
we were talking about on Wednesday, I think it was, how some of those expectations were getting pared back a little bit to like around 150 possibly.
Right.
So it seems like they're holding now
Not
around
saying
200.
it can't happen, Ben,
Understood.
but boy, everything else is screaming
Pointing in
that
that
this
direction.
is going to be a stronger number.
So you say the real reaction will come at 7:30, but oftentimes, Kevin, you remind us that you get this kind of knee-jerk reaction to these
Right.
numbers. So it takes a little while for the dust to settle, and the first move, not necessarily the right move.
Right. And think about it, Ben. The high-profile companies that we see every day in the headlines and on these shows, they're experiencing layoffs.
Yeah.
But
Amazon
who's hiring?
yesterday.
Leisure and hospitality, the smaller companies that don't get a lot of media representation and a lot of high-profile news. Those are the companies still hiring, Ben, and that's why the numbers are showing sticky and frustratingly high along the way. So it's interesting what the real economy is doing, what the headline economy is doing.
You know, that makes me think of something important. It's not just the number, the non-farm payrolls number, but also the wages component today. And there's a lot of states that are increasing their minimum wage requirements right now. So we are going to see some of those wages, maybe not in this report, but in the coming reports, we'll start to see that increase. But I've been hearing about how that's really more directed towards the low-income earners, and that may not necessarily have such an impact in terms of the bigger picture and a big uptick necessarily in terms of that wages component, but definitely the wage is something to watch here.
Absolutely. The wages are always something because, Ben, the wages lead us into next week's CPI report that we're getting Thursday the 12th. So there's another look. Remember, those 4 looks at inflation during a month. CPI, PPI, obviously, but wages, and then PCE and income and outlays. So we're going to get 2 of them in the next 6 days.
Talk to us about some of the Fed speakers this week. A few coming our way today as well, but somewhat of a hawkish tone from them, it seemed like.
You mentioned Raphael Bostic. He's speaking twice today, Ben. Lisa Cook, Thomas Barkin, all speaking today. Ben, you know, the Fed is rarely as consistent and as in line as they are right now, all talking about the fight for inflation is longer term. Raphael Bostic, his comments yesterday that you just reported on, he's talking about higher. And Ben, I keep saying this and I keep beating this drum. This omnibus bill at the end of the year, $1.7 trillion, that getting into the overall economy is going to keep inflation sticky. Where does inflation plateau, Ben? That could be the problem. That's got to have all these Fed officials concerned right now.
Well, that's again the situation at hand here. They need to be stay on their toes, obviously, and pivot as necessary. They've been speaking to that point as well here. Kevin, let's move on. Let's talk a little bit about Southwest. This is one of the big stories throughout the holidays. The weather, the impact that it had on travelers ultimately, and it sounds like it's going to have an impact on their bottom line now. They're revising their forecast.
In the last 10 days of the year, Ben, they canceled 16,700 flights. No, that's not seats. That's flights, Ben. That's going to cost them about between 725 and 825 million pre-tax, 400 to 425 million in revenue for the quarter. So what are they doing? Kitchen sink quarter, Ben. Lower all the estimates, bring everything down. They've already got bad news surrounding them. Why not get it all out? I think that's what Southwest is doing. They're clearing the decks here, Ben, with just get every bit of bad news out, because the overall perspective on Southwest right now, Ben, is horrible. Why not just get all the bad news out?
Kevin, I'm looking at the stock here. It looks like it's coming off a little bit here this morning ahead of the open. Is this the right thing for them to do? I mean, just kind of get it out of the way?
Well, number one, it's the responsible thing to do to pre-announce if you see a change in the earnings estimates. That's the responsible thing to do, and do it safely ahead of the earnings report. So that's responsible. So if they see that, they have an
obligation.
Exactly, to report it. So them doing that is fine. But getting all this news out, getting it being as transparent as possible, that's what they need to do. If you're a flyer, if you're a traveler, Ben, I would expect big deals and sales and low fares coming out of Southwest in the next quarter.
Okay, we talked briefly about the initial reaction to today's number not necessarily being the right reaction. It's going to take a little while for the dust to settle, for some of the initial or first response to that number to kind of filter into the market. Talk to us a little bit about what to watch for here, not only in terms of the indices, treasuries, the US dollar, which has been rallying this week, and some of the other products that we should be keeping an eye on here in response to the data.
pay attention to the leisure and hospitality numbers within the jobs data. That's the one that's been sticky. That's the low profile names that we talk about. Labor force participation rate, Ben, is another big one. And let's see if we get any move in the unemployment rate. That would make Jerome Powell happy. It may not make Americans happy, but it'll make Jerome Powell happy. Ben, one last thing. Inflation is a global problem right now. The U.S. solving their inflation problem is a big part of it, but it's only one part, right? So watch the dollar as that hawkish contest entails. Right now, you've got the dollar up big this morning, up pretty solidly. So watch how that plays out during the day. Like I said, Ben, it's always the dollar.
We will. In fact, that's what we're going to be talking about next. Kevin Hinks, check him out throughout the day here on the TD Ameritrade Network, helping us break down and get ahead of the jobs report here today. But coming up, the dollar on the move higher again this morning. We'll talk to Mark Chandler from Bannockburn Global Forex about what's got the greenback near 105.50 into the jobs report. More futures after this.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy, a measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com to all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Welcome back to the Future Show here on the TD Ameritrade Network. Before the break, we were talking top stories, we were talking jobs, and Kevin Hinks reminded us that we should watch the dollar today. We have been. And let me show you why, because it's been rallying, a strong move up off that test of 103 this week. You can see a well-defined trend environment. We're talking left, bottom left to top right corner, price activity. And you can also see some pretty well-defined migration of value. I'm going to just kind of draw some oval areas here. As you can see, we had value forming around the 104.30 area, and then we spiked back up, a vertical move. We went sideways right around 105, and it looks like into the overnight session, we're trying to get vertical again, some small areas of consolidation that have formed on the way up. But these are the larger areas that I'm kind of looking at here. And as I see value moving higher, not only do I look at this bottom left corner to top right corner type price activity, but again, we look for migration of value, and it has been moving higher on the more granular 1 minute time frame. But look what's been happening on the hourly. You can see a series of lower highs coming into play off that high that we saw last year up around 114.75. That was back in end of September, beginning of October. We saw some lower highs coming into play, a big vertical move to the downside through 109, 108 into the middle of November. And here you can see that move that we just looked at, 103 up to the 105 levels, counter trend to what we've been seeing in terms of the hourly time frame and the move off the highs that we saw last year, again, just shy of 115. But checking in on where things stand in terms of the bigger picture, this is what I think is important here. It's interesting because we were talking earlier about the indices being relatively contained, right? And I mean, hanging out around 39, 38 for the most part in the middle of the range that we saw the highs in August, the lows in October. We're talking 43 down to 35 for the indices, the ES. Well, look at the dollar last year from 94 up to 115. And look where we are right now, 104, 105, hanging out right in the middle of that range. Now, the big move up here this week comes the yen has been lower. If lower today, I think it's 4 days in a row or something like that against the dollar. So currencies have been inching lower again as of recent, but you can see how this is somewhat counter trend to what we've seen off those highs from last year. But a lot of focus here on the U.S. dollar, the indices, and these products that we're talking this morning. Let's bring in Mark Chandler, Chief Market Strategist at Bannockburn Global Forex. He's with us here to help talk financial markets. Mark, welcome. Good to have you back, and Happy New Year. We just looked at the move up in the dollar this week. This morning, you wrote about how the U.S. is stretched ahead of the employment report while the yuan jumps on hopes of new property initiatives.
Yeah, thanks, Ben. Happy New Year. And I think that, in a sense, what we're seeing is the tension, and this is what I've been wrestling with, is I do think the dollar topped out last year, September, October period. But the decline in the dollar, and by decline in the fourth quarter, the dollar, I should say the G10 currencies, except for the Canadian dollar, all rallied more than 5% against the greenback. And so the momentum indicators seem to me to be stretched. That is to say, the dollar is oversold. And so what we've seen in the last few days, I think, is some position adjusting, encouraged by hawkishness of the Federal Reserve still. And I suspect that the odds of a 50 basis point hike when the FOMC meeting concludes on February 1st is greater than the market's pricing in right now. The market says it's only about a 1 in 3 chance. And I think it's probably better than a 2/3 chance that the Fed goes 50 basis points. Ultimately, the economy is growing too fast and the jobs market is still too tight for the Federal Reserve to have confidence that inflation, which probably has peaked, is going to fall fast enough for their tastes.
You know, it seemed that was kind of the message in the minutes, right? Was the market's getting a little bit ahead of itself here, and the Fed was trying to remind them that they're determined in terms of getting inflation down to this 2% level, and it's going to take some work still.
Well, yeah, I think that this is the tension. I think that, you know, a lot of the op-ed writers and journalists talk about this some kind of division in the Fed. I don't see the Fed being very divided. I think that everybody's on board. What I think the big divide is the market is still pricing in a cut at the end of this year. And what I'm looking at there is the spread between the September Fed funds futures and the December contract. Today, we're just around 25 basis points. That is, the December yield is about 25 basis points lower than the September yield.
Mark, I wanted to get your thoughts on, we're kind of hyper-focused on the U.S. jobs data, but I think it's important not to lose sight of the bigger picture here in the U.S., in Asia as well, China. We had the reopening trade or expectations headed into, but there's a lot of uncertainty right now about how open they're actually being about some of the numbers. And even this morning we talked or saw how Japan, the wages slumped. What's playing out in terms of Asia, and where should our focus be there?
Yeah, so two things. I think you're right. Focus on the two focuses, Japan and China. Japan surprised us, not just myself, but really the global community when they changed the band for the 10-year JGB. And this has disrupted what I think has been a fairly tight link between the U.S. 10-year yield and the yen. I expect that to come back. I think that's the real anchor there. So as we get higher U.S. rates, 10-year yield still trading higher, I think that can help lift dollar yen. Key level I'm watching there is about 135, and then above there, maybe 137.5, 138. I think that the Bank of Japan is one of the few G10 central banks that meet this month, and I would not expect them to do anything. And I think that, we've been so caught up with the widening of the 10-year yield curve control band that many people have lost sight of what the BOJ is actually doing. And they bought, it looks like, a record amount of bonds in December, and have begun off this year also buying more bonds than they had previously announced they would buy. So they're expanding their balance sheet while the Fed's balance sheet, as you know, is falling. And the big surprise, I think, at the end of last year was that the ECB's balance sheet fell much faster. ECB balance sheet off about 8%, Fed's balance sheet off about 2%. China's the other big story.
Go ahead, Mark, with China. Go ahead.
Yeah, I think that, in my work, I don't know how the Chinese do it, how they manage the currency in such a tight range. But I do think that the direction is clear. And I had thought that it had been linked to just a general performance of the dollar, looking at, say, a high correlation between the euro, yen, and the RMB. However, these new measures by China on the property market seems to have given sort of greater independence to the Chinese currency, and it's strengthening, even though the dollar is strengthening against the euro and yen today. RMB is at essentially 3-month lows, or I should say the dollar's at 3-month lows against China.
I was going to say Bank of Japan, you mentioned this month, January 18th is when we'll hear from them. And, Mark, you mentioned the Canadian dollar and, again, kind of tying back to that dollar conversation and the Fed as far as their efforts to combat inflation, the likelihood of a 50 basis point rate hike versus what many think we'll see 25 in terms of a more aggressive approach. But I wanted to get your thoughts on some of that weakening U.S. dollar activity we've seen off the highs from last year as the euro's firmed up, because it does seem like they're kind of still struggling with some of those inflationary pressures. We saw earlier this week, the PPI, it did dip, but still year over year, I mean, something like 27% coming in. I pointed out this morning's numbers, the EU CPI numbers, which again, the core actually inched up a bit here. So it does seem like the EU, and possibly that's why we're seeing that euro currency firm up a bit, is they still have some work to be done here, and maybe even more than the U.S.
Yeah, I think that's really been the issue is, the ECB used to say they don't pre-commit.
Mm-hmm.
Yes, ECB President Lagarde pre-committed to a 50 basis point rate hike. When they meet again the day after the Fed, that would be February 2nd. But I think that for me, the part of the story of the euro's recovery has been the market has not only thought that the Fed will peak around 5%, but they also took more aggressive towards the ECB. You can see this in a 2-year interest rate differential, with a 10-year interest rate differential. And so I tell you, though, the problem that I have right now with the euro is that the speculative community, that is these non-commercials picked up by the commitment of traders at the CFTC, have the largest net long position in about a year and a half. So the market's been anticipating a stronger euro. They got a stronger euro. And now I think some of the late longs, some of the weak longs have to be shaken out.
Taking a look at the hourly time frame, the move off the September lows, we saw below parity up to back, just shy of 108. And as I step back, looking at the daily time frame, here you can see that massive sell-off from 115 all the way down to that low I just mentioned. We're talking the euro traded down to just below 96, all the way back up again. We're talking to near 108 here, hanging out right at 105.44 this morning. We'll keep an eye on the U.S. dollar rates, the curve, the inversion. And Mark, always appreciate you joining us here. Another day to get a lot done here, and it's on the report headed our way. Mark, thanks for joining us this busy Friday morning. Mark Chandler, Chief Market Strategist at Bannockburn Global Forex. Coming up, the monthly jobs report with Chris Robinson. We have the Managing Director at TJM Institutional Services joining us, and Jenny Horn. Stay tuned. You're watching the TD Ameritrade Network. We'll be back with more futures after this.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CME Group, where risk meets opportunity.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios, dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the Income Investing course and a whole lot more.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com to all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Let's walk through charts, one of the most commonly used features on Thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select time frame to adjust time intervals or to favorite a time frame. Select style to change the appearance of the chart. You can add drawings by selecting Drawings, Drawing Tools, and then Type of Drawing. For symbol comparisons, select Studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to Thinkorswim, head to the Education Center on TDAmeritrade.com.
Oh, yeah, I'm going to take off.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set.
Choose the app that fits your investing style.
Welcome back to the second half of the Future Show. We're just about an hour away from the cash open, and everybody's waiting for this number here to hit the wire. We're going to have it for you in about 45 seconds. Let's check in first and foremost on where things stand as we come into the number, the four majors, and the S&Ps, the NASDAQ, Dow, Russell, hovering, well, hanging out now and coming off a bit in anticipation of, we've been chopping it up though, basically right around unchanged for the most part, as was this morning on the start of the show. We've got two of the four majors in positive territory, two of the four majors negative here. And again, we're just about 15 seconds away from this number hitting the wire. Expectations for 200,000, and that would be a slight decline from last month's 263. Checking in on where things stand in terms of the dollar and some of the other top traded products. Kevin Hanks, Mark Chandler from Bannockburn telling us to keep an eye on the greenback this morning at 105.31. We certainly will be. And again, as we await this number here, I'm watching gold hang out around 1840. We've got crude at 73.49, and this number came in, wow, higher than expected. They did revise last month significantly lower, though, I want to point out. But again, non-farm payrolls here coming in at 223,000. I'm seeing the private payrolls came in higher, and basically this number pretty hot. Looking at the wages, they did come in a little bit softer than expected. But look at the indices here, a sharp rally in reaction to. So again, a revision to last month's number lower, and the non-farm payrolls this month coming in a bit higher than anticipated at 223,000. You're looking at a big move up in the indices. They have gone from negative to positive. The Russell now enjoying a 1% gain here. Well, almost. I don't want to get ahead of myself. 0.75%, but it looks like the S&P spiked up to 38.75, currently trading 38.50 in reaction to the number. We're on highs as we speak. Taking a look here at, again, non-farm payrolls this morning, 223,000. They were looking for 200. I say the number last month got revised down, so kind of balancing things out a little bit here, and the market definitely taking this one in stride. But I think the focus here is the average hourly earnings. They came in significantly lower. Let's bring in our guest to help us take a look at the number, market reaction to, and well, we've got just the person for that. Chris Robinson, the managing director at TJM Institutional Services. Chris, you're our guy in the hot seat today as you only get a little bit of time to digest the number, but you're going to have to field a few questions about it. Talk to me. It seems like, I guess I'm a bit surprised in all fairness to see the reaction to, as I look at the non-farm payrolls, but as I look at the wages component, maybe that will explain the bid we're seeing in the indices.
Yeah, it's interesting. I think also the revision number one, and I think a lot of this was done yesterday with the ADP number. The ADP number was really out of whack. We're very, very high. And I think a lot of people, adjusted yesterday thinking, oh my goodness, it's going to be really a hot number. So 220 versus 200, I know they were looking for less than 200, but they did revise last month's number lower. And you did mention that the wages dropped, which is, at the end of the day, that's what the Fed wants. You've got the president pounding his chest, talking about all the jobs he's quote unquote created. And, at the same time, you've got the Fed really wants to destroy jobs to slow down inflation. So you have two competing ideas there. And this, at the end of the day, this gives the Fed cover to maybe hold off on higher rates for longer, even though they've been talking very bullish. If they can get the movement they want in the unemployment number, which is really what this seems to boil down to me. At the end of the day, that's what these guys, they really won't come out and say it, but they want the unemployment number to go higher before they lift their foot off the higher for longer rates. So at the end of the day, it's kind of a muted reaction. I mean, the SPOOs are up, 18 points, 20 points. Everybody was worried that 3,800 wouldn't hold. There you go. So, but I honestly think at the end of the day, most of the adjustments, most of the hedges, most of the panic was done yesterday on the ADP number.
I'd agree with you in terms of kind of a muted reaction as long as we don't see follow through up above the initial spike that we saw. But let's pull the chart here real quick because I just want to point to how that initial spike, short of the high that we saw in the overnight session yesterday, we were up around 38.85. You can see how we spiked up to short of just shy of 38.75. It looks like the high 38.74, but you can see again a kind of a reflection of what we've seen in terms of the bigger picture as well, right? As we've been in a bit of a range. Let's just take a look at that. Hold on one second. I've got the S&Ps here, so you can see that high that we had back in August, 43, the low in October, 35, and we're kind of contained in the middle of that range here right now. But this is a reflection of what you were talking about, Chris, in terms of those two competing ideas, right? The market's got a lot of information it's trying to sift through over the last few weeks and to begin the new year.
Yeah, and watching the dollar, your previous guess was correct. I mean, higher rates is going to be a higher dollar. A dollar's hanging in at 105. Just at the end of the year, right, we all thought, we might see 102 in the dollar. The dollar's turned up here on the idea that the Fed is not going to slow down the rate hike. So I would watch that dollar. That's a key indicator. Also, you got to continue to look at the 2-year versus the 10-year. I think right before the number, the 2-year was trading at, the 2-year was yielding, I think 4.5. I can't see where it's trading right now, but I think that's, you've got the 10-year at 3.7. I think as long as the 10-year stays under 4, that's another big indicator, because two things that really impact people besides going to the grocery store and paying a lot more for food, it's borrowing costs, right? And are we going to see the 30-year mortgage rate, above 7% versus where it was, a year and a half ago, 2 years ago at 3? Those are the two key indicators. How do you slow down the economy? You make it harder for people to buy houses, and you
slow labor conditions.
Slow the labor conditions, and I think that we did mention the fact that the payout, that number was lower, and I think at the end of the day, it's what they want. And you're starting to see it in the overall market. I mean, Amazon, laid off north of 15,000 people, Salesforce, and that's something that I think that's the way the economy turns. If you've got a company that you've got 500 employees, now you've got a little bit of cover if you want to cut off the dead weight and say, you know what, everybody else is cutting, sorry, here you go, here's your severance pay. And I think that may help get the economy where the Fed wants. And at the end of the day, the Fed wants less people employed.
Chris, we're looking at the 2-year right now, just below 4.5. And as you say that, it kind of reminds me of that old Three Stooges skit, inch by inch, slowly I turn, inch by inch, step by step. And it kind of reminds me the economy doesn't turn on a dime, right? And we're not necessarily going to see that. So these layoffs that we've seen possibly just kind of feeding into that slower for longer kind of narrative in terms of the economy. We've been talking about that, or did yesterday, how layoffs in many ways could be a good thing for the market, right? Because it does show that we're kind of getting to that point that we need to be without an aggressive approach to it, but real strong labor market or lack of layoffs ultimately, counterintuitively, may be bad for the market because that's going to raise the Fed's initiatives to kind of combat out inflation and ultimately their firm ground to stand on as far as raising rates. Let's talk a little bit about what this strong number means for the U.S. dollar, because it's holding on to positive territory, even with the indices in positive territory. I've got the dollar up about 0.25% here still this morning.
Yeah, I don't think that that's going to change as much. It is Friday. It's end of the week. I think that trend is still lower. Okay, I mean, maybe we caught a little bit of a bid here, but I tend to look at the overall moves. What have we done percentage-wise? We're still basically down 10% from the 20-year highs. And maybe that's, kind of the reset button for the dollar. As the dollar, everybody kind of sits back and waits to see if, and now we're going to have to wait and see, is the Fed going to continue to be, are we going to do 3 quarters? Are we going to do halves? Are we going to do quarters? That's where kind of the nuance lies. And now, so unfortunately, that means we have to go back to trying to read the tea leaves every time somebody from the Fed talks. That doesn't matter if they're voting or in the Fed anymore. It's like, well, what's the Fed going to do? But I think if you look, I try and simplify things because at the end of the day, if you're trading or hedging, you can get overwhelmed with, well, what about this? What about this? What about this? It just, at the end of the day, in my opinion, for what it's worth, it just seems like the Fed is not going to lift off the higher for longer until they get movement in the employment. And you're starting to see that. The revised number lower, that was huge. And I also think that the fact that it was not only 220, but I mean, after ADP's number yesterday shocked a lot of people.
Yeah.
So I think that was why we had our thing. And anybody that needed to get out of a bad position got out yesterday.
A great breakdown here. I appreciate you joining us here, Chris. Thanks for joining us to take a look at the number. Chris Robinson, the Managing Director at TJM Institutional Services. Now for a check on a closer look at the number here. And Jenny Horn joins us for that, markets correspondent on the TD Ameritrade Network. Jenny, kind of a mixed bag here. I'm looking at it. I see, well, we had the unemployment rate come in at 3.5%, so a little bit below expectations. We saw average hourly earnings here, which kind of appeased the market's expectations, and we saw a rally in reaction too, but that non-farm payrolls number is still a little bit higher than expected.
Right, Ben, and it feels like the areas of strength within this report have maintained their position as they were back in 2022. We're still seeing notable job gains in healthcare, leisure and hospitality, construction, and social assistance. Employment in leisure and hospitality rose by 67,000 jobs in December. Now, employment continued to trend up also in drinks and food services, up 26,000 jobs. Now, employment continued also to rise in amusement and gambling and recreation, which was up 25,000 jobs, while accommodations was up 10,000 jobs. Leisure and hospitality added an average of 79,000 jobs per month in 2022, which sounds great relative to the other sectors. However, it's less than an average gain of 196,000 jobs it added in 2021. More notably than that, in this space, it doesn't remain well below its pre-pandemic levels back from February of 2020 by about 5.5%. So even though that number is strong relative, it is still not nearly as strong as it once was back pre-pandemic, of course. Now, employment we're seeing in healthcare has also been a consistent bright spot for the last several years now. Healthcare employment increased by 55,000 jobs in December. We saw job growth in the healthcare average about 49,000 per month in 2022, considerably above the 2021 average, which just was adding 9,000 jobs per month. Employment in construction also did rise about 28,000 in the month, while construction employment increased by an average of 19,000 jobs in 2022. This was little unchanged to 2021 levels. Employment in retail trade also did change little in December, up about 9,000 jobs. But over the month, we're seeing areas that aren't really changing month over month, those being wholesale trade, information, and financial services. Now, one area I wanted to point out was the fact that we are seeing wage inflation at 0.2% versus 0.4%. This was a good read. So I think the weakest read we saw of this number really was the fact that unemployment, of course, did decrease on a percentage basis.
Yeah, unemployment here coming in. And as I look at it, Canadian unemployment as well, coming in lower than expected at 5%. Ours came in at 3.5%. They were looking for 3.7%. Jenny, as you say all of that, these are fractionally lower from last year's numbers, it sounds like, but definitely not the type of environment that'd be indicative of a recession. I mean, these are still pretty strong numbers here.
Right, Ben. And I think that's why we initially saw that strong reaction. You see a number like this, and it perhaps gives the market some encouragement. But I don't think this is necessarily a read into what is to come. Not to be totally doomsday, but I do think there is still the degree of, the concern that we will continue to see jobs weaken. I guess obviously that hasn't been the case today, so we will take this for what it is. Another positive was the fact that average hourly earnings did rise by about 0.3%. So all things considered, some strong numbers here, especially in leisure, hospitality, and social assistance.
Yeah, kind of right in that sweet spot, it seems like, as the market's reacting to very positively again, encouraging, as you put it, but maybe not too much so to the point where it's sparking fears of a more aggressive Fed in reaction to. Jenny, appreciate you joining us here. Solid breakdown, looking at the number. Jenny Horn, check her out throughout the day here on the TD Ameritrade Network. A quick break. When we come back, Kevin Green on how this week's jobs data impacts the Fed. We've got the chart master, Rick Ducat. Stick around, more futures in 2 minutes. We'll be back.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy. A measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The platform demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate TDAmeritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange new location with access to the biggest newsmakers in Wall Street, bringing you in-depth market coverage and real-time trade ideas. Do not miss our exclusive interviews with CEOs, bell ringers, traders, and stock pickers, keeping you informed as you navigate your investments. Don't miss Trading 360 at 11 a.m. Eastern and the watch list at 2 p.m. Eastern, live from the New York Stock Exchange, only on the TD Ameritrade Network.
Welcome back to the Future Show here on the TD Ameritrade Network. The focus this morning on the jobs report coming in, while non-farm payrolls higher than expected, but the wages off a little bit from consensus levels. So the market's getting a nice reaction to all four of the majors. The S&Ps, the NASDAQ, the Dow, the Russell enjoying gains as we head into the cash open. Kevin Green, senior markets correspondent here on the TD Ameritrade Network, joins us to kind of take a look at the bigger picture here, right, Kevin? I want to focus on the forest, not so much the trees here, because today's report here, just one of the better than expected jobs releases this week that the Fed has to contend with. Where does it put us as we await the decision come the beginning of next month?
You know, Ben, when you look at this data here, one thing's for sure, the Fed still has a long way to go, unfortunately. I know the market is up right now. I'm kind of surprised to see this type of reaction here. And here's the reason why. We have to look at the trees that makes up the forest, right? And at the end of the day, we saw the Challenger job cuts. Those were somewhat significant, if you will. But if you look at some of the other data that we had, the ADP data is really good to be able to see. Obviously, that shocked the marketplace. One thing to note about the ADP number, though, it's really going to be services focus. So that's why we probably saw a little bit of a spike in that number compared to what we saw here today. But we are still gaining jobs. We are still beating the expectations from the street. I think the bright spot in today's report did show the participation rate slightly increasing. We want to definitely see that. That means that there's a lot of individuals that are coming back into the marketplace that were out of that marketplace. So that's good to be able to see. But you talk about the average hourly earnings. I'm not sure how much stock we can take into that, Ben. And here's the reason why. When we talk about the job growth that we have seen, a lot of those coming in from leisure, hospitality, typically we do see those wages a little bit lower than, say, a white collar or office type of position. We saw the same type of dynamic right when we got out of the recession, or not out of the recession, out of the pandemic as well. In 2020 and 2021, we saw this huge influx of hospitality workers getting back into the marketplace. And we saw those wages starting to be a little bit stagnant or even coming down. It didn't mean that the overall wage themselves was coming down. It was just that a lot of office workers were still able to work at home, and a lot of those hospitality workers were able to get back into that labor force. And so it's just a little bit of a basis play at this point in time. So that's just my perspective on it. Overall, I do believe the Fed's going to still have to do more. Right now, we're at about 4.25% when it comes to the target rate. They're talking about getting the rate to 5.17%. That was on that dot plot. So you either say 5% or 5.25%. If you're conservative and you say 5.25%, we still have 100 basis points to go. We know that in the February meeting right now, it looks like we might do 25 basis points. March, we could do 25 as well. So that's 50 basis points. We still have either another 25 basis points to actually still go here, or potentially another 50 basis points. So there's still going to be a lot of room for the Fed to make some action here. And then also we have to look at the balance sheet, that they're going to have to really address that as well, as we start seeing some of these fixed income markets become a little bit tight when it comes to the credit spreads there.
You know, as you say that, I think of jobless claims also this week. I mean, just barely above 200,000. And obviously, again, suggesting or reflective of a very strong labor market, again, in addition to the other data points you mentioned this week. And, you know, earlier in the show, we had Mark Chandler from Bannockburn join us, and he was talking about how he thinks the Fed's going to go 50 basis points when we see that decision in the beginning of next month on February 1st. But, you know, nothing written in stone here, obviously, right, Kevin? I mean, and that's why the Fed's equally data dependent as we are as traders and investors. I mean, that's why we're so hypersensitive and focused here on it, not only on the Future Show, but across the TD Ameritrade network.
Definitely. You want to be able to get this thing out of the way, Ben. I think the market's kind of fed up with it. I think even the consumer themselves are a little bit fed up with it. So I would tend to agree. That would be a nice move for the Fed here. If we know that we potentially have another 100 basis points to go, why not try to front load it and knock it out at this point in time? Stop waiting and doing 25 and 25 and 25. Because at the end of the day, right now, the reaction that we are seeing in the economy is only reflecting what they just started last year. We're not seeing the immediate impact as soon as they cut rates. It's just something that just does not occur. Yep. We won't see the full impact of this for potentially another 6 months, 8 months, maybe even a year or even longer than that. So that's going to be the risk. And the Fed fund futures, I find it very interesting here, Ben. They have been on point for the last year and a half when it comes to Fed policy. Right now, there is a disconnect. They are still planning on having a cut of 25 basis points in September or potentially October. The Fed is coming out and saying, no, that's not what we are intending to do. We had some Fed speakers yesterday that kind of reiterated that stance as well. And if the Fed fund futures themselves, which is going to be that 30-day look at those rates, if they're incorrect, that's going to be a major adjustment across the board in the yield market here. And that could have a major disruption when it comes to the equity markets and even some of the commodities in the marketplace as well.
You know, I like that, Kevin, because, well, we were talking about some of the Fed speakers we heard from this week. Bullard, traditionally one of the more hawkish, actually, a little bit more of a dovish tone, but he was saying basically, let's get there sooner rather than later, right? We still have some work to do. Let's get it out of the way. And Kevin seems to be, you're in the same mindset. Kevin Green, appreciate you joining us here. Enjoy your weekend. Kevin Green, contributor here on the TD Ameritrade Network. Let's bring in the chart master. He's got his eye on the big spike we're seeing in the S&Ps in reaction to the jobs report. The move here has them, well, from negative to positive. We were kind of chopping around unchanged, and you can see reaction to up to 38.74. We're higher by about 0.9%. Rick, talk to us about what we're seeing here in terms of the jobs report and the move in reaction to.
Pretty dramatic move upward there, just rocketed up right when the data came out. Gave back some of those gains, but then it's been kind of grinding back up since then. So as you said, we're up about 0.9% now. Right now, hovering near about 38.68 or so. So it's been an interesting few minutes here.
So we have the initial spike up to 38.74. We're talking a significant move here. I mean, we've got 55 handles to the upside in terms of movement to the upside there. So, and we're still holding that upper level, which I think is important because Rick pointed out we did pull back to the middle of that big candle, the upside back to the 38.40 area, and we're coming back here. But now as I look at that 38.74, I'm reminded, this chart doesn't show it, but if we were to go back a little bit more to the left, the highs from earlier this week are still intact. We've yet to take that out.
Well, we can look at our longer term chart to take a look at that and address that right now. So we can see that it looked to me like we were in more of a symmetrical triangle type pattern in the short term. This is a 30-day, 1 hour chart.
Okay.
Ever since we were at these lows near 37.88, we've been kind of making some progress upward there.
Mm-hmm. Higher lows
here, lows here, lows here. And then we dipped below it a little bit this morning. Now we're back in the upper half of this range now. So pretty interesting situation.
You know, that dip below as we see there, I'm not sure how significant it is. Pre-number, it's a thinly market,
exactly.
A thinly traded market. And here, to my point, you can see that big green candle. Yeah, it's significant, especially when we look at it on the 1 minute time frame, but kind of loses its significance as you look at it in terms of the bigger picture here and what's been going on over the last couple of weeks.
That's why it's important to look at different time frames, man. It gives greater context and it gives you more of a perspective on how big the move really is. And right now, I mean, it's not really taking us into any unexplored territory here. We're kind of just within the same boundaries we've been in.
Which is the theme I've been talking about, which is the market. It's been, well, intraday, we've seen some volatility. I mean, look at these moves, but it relatively contained for the most part.
Yeah, and looking at the longer term chart now, we've got a 1 year, 1 day chart with our three moving averages, our 2163, 252 exponential moving averages. And I took this chart back to December 2021 because this long downtrend is still in effect here. We haven't really broken above it. More recently, our two shorter term moving averages have been serving as resistance to the upside. Really been looking a little bit more range bound than anything lately in this broader picture here. Because we also did break to the downside below this blue dashed line, this uptrend that we saw off those yearly lows. That's been collapsing now. So really, it's just kind of moving sideways. Looking at our moving averages, we're trading below all three of them. They're starting to trend down a little bit, very slightly here. RSI not really showing us too much, just in bearish territory.
You know, you can see that overlapping rotational type price activity that we were just looking at on the hourly time frame. And then, you know, as I look at this here, I just see this contained on the bigger picture here as well, basically hovering around this 4,000 level in the S&P's 3,900. You've got the highs from the August highs up around 43. You've got those October lows around 35. And again, for the most part, we've been in the middle of that range. But, you know, I just noticed here, Rick, and I hadn't seen this before, but the lows that we saw back in February and March of last year, that's right where the market topped out in August, September of last year. And that also coincides and provided us that third touch point for the trend environment to the downside and that white dash line. And then you can see this happening again here in the end of last year, beginning of this year. Rick, talk to us about what do we look for now in terms of bigger picture as you look at this chart? Is it 3,500 to the downside, 43 to the upside, and everything within this is just kind of noise and chop? And while there is opportunity within that range, it's fairly random. It doesn't provide a lot of conviction one way or the other.
I'd say that's probably a good place to start, is thinking of those two numbers. In the more short term, though, I would say 37.20, this green dashed line where price bottomed out previously, that would be kind of the first stepping stone to more downside price action here. But as I said as well, we've got these two moving averages that are clustered together right here near 38.88 to maybe 3,900 or so. So the 3,900, big even price level, that'll be something to watch for sure. If we do make it up, though, we've also got this to contend with. We've got our big long-term trend line right in confluence with our purple 252-day EMA right near 40.26, 40.28 or so. So I think there's a couple important points to look at before we get to that 4,300 level and the 3,500 level.
Okay, I like that 30, 40, 39, 40, 30 area to the upside, to the downside, 37.20, which is important, I think significant as well, because I've heard a lot of people talking about how we could test 3,700. So to see that key area come into play there, and I'd agree with Rick, there are some areas within that range prior to 43 or 35, but that is the bigger picture and more contained area we're looking at here. Rick DeCat joining us to help us break it down, taking a look at the big move up we're seeing in reaction to today's jobs report, non-farm payrolls, and the spike in the S&Ps. We're talking up, well, over 1% right now as we speak. That's it for us here for Futures. Thanks for joining us. Stick around. Lots to come here on the TD Ameritrade Network. Up next, Oliver Rennick, Morning Trade Live.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it could potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange new location with access to the biggest newsmakers in Wall Street, bringing you in-depth market coverage and real-time trade ideas. Do not miss our exclusive interviews with CEOs, bell ringers, traders, and stock pickers, keeping you informed as you navigate your investments. Don't miss Trading 360 at 11 a.m. Eastern and the watch list at 2 p.m. Eastern, live from the New York Stock Exchange, only on the TD Ameritrade Network.
Let's walk through charts, one of the most commonly used features on Thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select time frame to adjust time intervals or to favorite a time frame. Select style to change the appearance of the chart. You can add drawings by selecting Drawings, Drawing Tools, and then Type of Drawing. For symbol comparisons, select Studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
It is Friday. It's day 4 of 2023. So far, it hasn't been great for the U.S. stock market. Will today be any different? we do have a nice little bump in futures after this morning's employment report. Very interesting set of numbers. Kevin's going to walk us through them here in a moment as we get started, taking a deep dive. Some really interesting stuff. And the top line, adding more jobs than expected. So that certainly fits with all the other employment data we've gotten this week, which have been strong, higher than expected. That's caused a little bit of a return to last year's regime, where we got a few days of higher interest rates, lower stocks. But investors keep coming back to buy bonds and eventually pushing yield lower like we saw yesterday, with the Treasury market generally flat and the yield curve even flatter by the end of the day, though. Equities have not liked that. We're going to talk some stock news. Vince McMahon is back into the wrestling biz. We'll discuss some fun stock-specific stories, take a deep dive into the video game biz and the likelihood of Microsoft's Activision deal. Here's futures right now, up 1%. Now, we've had these early morning pops that fade, but keep in mind that earlier this morning we were down. So we already kind of have a bit of a reversal on our hands. A little bit of hesitation going into this report. Futures were lower, bonds were lower, and now everything's turned the other way. We've got the 10-year future up now about 0.25%. Stocks trying to respond in kind to that. So this year so far has been pretty choppy to the downside. A lot of particular tech weakness, layoffs in the tech sector, and a market trying to look through it but unable to ultimately, as we're sitting at the lows for the NASDAQ right now from the past year. S&P and the Dow Jones have more space between their current levels and their lows, but the NASDAQ and tech being the leader here is where we're going to focus our attention. Dollar down about 9 bips right now. Not a huge decline, especially given the downtrend in the dollar over the last 2.5, 3 months. I think if you're going to want to see a big macro uplift today on this number for stocks, you're probably going to want to see the dollar down more than this. This is not a big decline in the dollar. We do have bonds right now up. 10-year futures are higher by about 1/3%. So bonds are catching a bit of a rally. You'd think that might push the dollar lower here. But lately, the focus that I've tried to bring is that these correlations have been breaking down. That's been the main theme of my coverage here over the last, call it 4 weeks or so. Let's see what happens. Give it some time to breathe. The first response is for stocks and bonds to rally together. Stocks and bonds rallying together and selling off together. That's the 2022 regime. Well, recently we've seen some breakage in that relationship where there are days where bonds rally and stocks still sell off. Think about yesterday. We had an early bond sell-off throughout the day. Treasuries rallied back, yields came down, and stocks ended at the lows anyway. So is the bond bounce going to be a surefire bull case for stocks? I'm not convinced at this point. But on these specific data-driven days where investors are alert to inflation risk and too strong of an economy, we might see more of that 2020 regime where bonds and stocks do the same thing. So far they are. Looking at what's happening here in the dollar over the longer term is important context. We've had the dollar sliding now for a couple months. The dollar, when it first peaked out, it gave that lift to equities. This is a 9 or 6 month chart. This is the fall right here, September and October. So we got that stock bounce as the dollar peaked. But as the dollar has broken down further, we lost the stock bounce, of course. And as the NASDAQ's now at the lows, dollar here is kind of plateauing a little bit. Question I have is whether or not the downtrend in the dollar is trying to turn around, as we did get a couple good data points that pushed the dollar higher here already this week. If you look at the long-term trend and pull it back to 18 months, 2 years, the dollar's probably still trending higher, but that might be yesterday's news. What's more important, I think, is what's happened here in the last 3 months with the trend in the dollar lower. That's been happening as other central banks have more potential to surprise than the Fed. We pretty much know the Fed's plan. The market seems to have acknowledged that inflation may have peaked and therefore Fed aggression may have peaked. But the sustainability of inflation and the Fed's warpath against it came back under scrutiny here the last few days, given the Fed minutes showed us that they're still not messing around. They don't want to see the stock market rally too hard, and that jobs data continues to come in warmer than expected. And suddenly the dollar here has kind of stopped going down when you look at the last couple weeks. Watch the dollar today to see what it does. Generally, stocks probably still prefer the lower dollar, but that message has also gotten mixed up. Sorry, I don't have a lot of obvious answers for you right now. Things have gotten murky here the last 3 weeks. The relationships from the last couple of years have started to break a bit as investors become more worried about recession. So if good jobs suggest that the consumer could stay strong and maybe that recession gets pushed out, perhaps we have a market that can deal with a strong jobs report. I'm not sure. Let's find out and revisit at the end of the day. But one thing I do know is that the yield curve continues to flatten. It's getting scrunched, and generally, that's not a good thing. So we might get gyrations on a day-to-day basis, but if this trend continues and the yield curve makes new lows, that tells us the economy is still under threat, and that's probably ultimately not going to be a good thing. Come on in, Kevin Hanks. Tell us about this number here. What do we got? Really interesting one.
Oliver, this is a number with a lot of different talking points, and a lot of them are good, Oliver.
Okay.
Let's get
good
to
for the economy or good for stocks?
Well, both.
Okay.
I mean, progress. So you're getting, it's easier to do it by going through the numbers.
Okay.
First, non-farm payrolls. Expected to be 200, come in 223. A solid number and a beat, but not a crazy beat like people feared, right? But then, Oliver, unemployment. Here's where it gets really interesting. Unemployment going down to 3.5%. You would think that would scare people, except the labor force participation rate went up and unemployment came down.
Okay.
Normally, you could make a case if the labor force participation rate went from 62.1 to 62.3 and unemployment went up, you can justify it.
Sure.
But
more people enter the workforce.
But this is the double positive on that. So that labor force number and unemployment number, that's really enormously positive. So that's good thing for the overall economy. Now,
generally what the Fed wants too, right?
Exactly right. Exactly. So now let's get to the inflation part of this. And here's where it gets interesting. 0.6 a month ago, down to 0.3 on average hourly earnings. Year over year, here's the big beat. I think this is why stocks are higher. From 5.1, expecting 5, going down to 4.6%, Oliver. And then average work week down a tenth, not really important. But it's that year over year wage data, I think, that really shocked the market and something that I think stocks are embracing. Now, Oliver, not only that, that's good. The monthly data is good. The revisions were all better for the overall market.
256.
Almost across, down on the payroll number, lower on unemployment to 3.6. Private payrolls lower, manufacturing lower, labor force participation rate already picked up a tenth. Average hourly earnings year over year from 5.1 that bothered the market a month ago, they revised that to 4.8.
Yeah,
so all the numbers started to move down and were revised lower. So, Oliver, I don't like to paint with a broad brush because a lot of times there's a lot of nuances. It's a good number across the board, Oliver.
Okay.
And remember, one last thing. I was talking about the ugly tone, the black cloud hanging over this market. What it needs is a tone change. You just got your tone change.
Yeah, this is a really interesting one because it suggests that maybe there could be some functionality to the Fed's pressure where you're causing some cracks. We've seen the layoffs in tech, but with the participation rate climbing and unemployment going down, that's really kind of the golden goose.
It's the hit the bullet with the bullet.
Yeah.
That we talked about because you're getting lower inflation, but the labor market helped by leisure and hospitality, 67,000 jobs, healthcare, 55,000 jobs, helped by still good jobs with inflation starting to creep lower here. Now 4.6. Now, here's the other side of this argument. You don't want wages to go down faster than overall prices to come down. We'll get CPI data next Thursday. That's concerned, but Oliver, something's got to break first, right?
Sure.
As long as we get a good number on CPI to confirm this next Thursday, this is one of those situations where you can say start buying the dip here.
The other thing you need is, the catch, to your point, you need to see inflation keep cooling.
Right, you don't want wages to drop and prices to stay high.
That's not
and now you're at a net negative there. So there's that. But the wages, something's got to break first. And if it's the wages part first, based on big tech or where the layoffs are coming versus leisure and hospitality, those are historically lower paying jobs. Something's got to break first, Oliver.
The other thing, too, that I do wonder is if you're the Fed, if you're Jay Powell, and you're looking at this and you're feeling like you're doing a pretty good job, then you might want to keep doing that job. And after what we saw for the minutes yesterday, if they're not breaking things to the point where we are collapsing, falling apart, they want to drive a wedge into some of the strength of the economy. They also don't want to unnecessarily send it into a tailspin.
Exactly.
This is not a tailspin report. So that, I guess, would give us and them some confidence that their strategy here might be the right one. And their strategy has been to be pretty aggressive and tight for policy. So we should really take what they said yesterday at its face and believe that they're not, they're not going to cut.
Not lowering rates.
Exactly.
But now, Oliver, by the end of the day, what will come into the rhetoric here is the term soft landing again.
Okay.
That it's actually starting to work, where the labor market's staying strong, but inflation's coming down.
Can a very pure good report actually be good for stocks?
Right. Well, we'll see. I mean,
we're going to find out.
This rally will be met with some selling, right? There's a dire look for fourth quarter earnings and a lot of expectations that fourth quarter earnings have to come down even more in their expectations. So there'll be some selling, but let's see. I always say, how does the day end? How does the week end?
Do bonds keep their bid as well? And then does the dollar stay down too?
You mentioned something about the dollar being unchanged, but look at the highs on the dollar futures today,
Sure.
105.5. So it's already come significantly lower from where it was, but you're right, it's close to unchanged.
Okay, great stuff.
Yep.
Good deep dive. A very good report. Can stocks take it in stride? And to the point about earnings and company specifics, let's talk, some Tesla. Caroline Wood's joining us from the New York Stock Exchange. So if the market is happy about this employment report, Caroline, the tech bulls are going to be frustrated by Tesla still dragging at the same time this morning. Got hit really hard. I checked a few minutes ago, it's down like 7-8%.
Yeah, the hits just keep on coming for Tesla. It's currently down about 7%. Going into this latest news on price cuts, it was already down about 10% in 2023. It was, of course, down, 65% in 2022. So if you were hoping for a reprieve in the selling in 2023, not so fast. Shares are lower because Tesla is cutting prices on its EVs in China once again. Comes after deliveries fell sharply in December to 55,800. That's from 100,000 in November. Q4 global deliveries, of course, did hit a record, but of course, they also fell short of estimates. So there's been concern leading into these price cuts. A Model 3 is now priced at about $33,000 US. That's a 13% price cut. About 30% cheaper than the same car here in the United States. Model Y has been reduced to just under $38,000. So it, of course, raises additional concerns about demand. We know there's increased competition. We know there's a lot of macro headwinds. We've been seeing a lot of competition coming out of the CES highlights in Vegas. So it's not just Chinese competitors, but so many others. So Tesla, of course, not the only stock lower in the pre-market. Taking a look, NIO down 6.5%, XPeng is down 12%, BYD down about 2%. So definitely spanning the board here, but not a good day for Tesla investors, at least 15 minutes before the market opens.
Yeah, and after all of the debate about just how negative the China impact was going to be, it seems like we're getting the answer here as now the decisions are being made by Tesla, because they had pushed back on whether or not they were going to have to cut prices, whether or not production was going to slow down. Generally something the market's not crazy to see. Lower prices, of course, mean generally lower margins unless something really changes on the production side for Tesla. Okay, so market doesn't like it. How does the market like the Southwest situation that now is going to be affecting their baseline fundamentals? Caroline, let's go there.
Well, we of course know Southwest had that total system meltdown amidst the bomb cyclone and the blizzard. It caused a whole bunch of scheduling issues for its flight and crew. And now we're learning about the impact that it had on Southwest's bottom line. Of course, it had to cancel nearly 17,000 flights from December 21st through 31st, operated on a reduced schedule for days. So now the airline says it expects to report a Q4 net loss, estimating a hit in the range of $725 million to $825 million from the disruption. Caused Southwest an estimated $400 to $425 million in lost revenue. Q4 seat capacity fell about 6% from 2019 levels. That's about 4 percentage points lower than its initial guidance. And it's disappointing because I believe it was in late October, Southwest said it expected to generate strong profits in the final quarter of the year, barring any extenuating circumstances, which of course did in fact happen. And analysts were expecting EPS of about 59 cents a share in Q4. So net loss, definitely disappointing. Taking a look at shares, they're off about 2% right now in the pre-market, but heading into today, they were already off about 8% from December 21st. So Southwest definitely getting punished for this system meltdown.
Yeah, seriously. Wow. To see the numbers put to it really gives it a new perspective. Just shy of $1 billion. I mean, that's a big deal for already an industry that's taken so many hits over the last couple of years. This one, though, arguably self-inflicted. Thanks, Caroline. Great stuff here on the big stock moves this morning. Let's take a breather, come back with about 12 minutes until the open. Talk some more about today's numbers and whether or not it's going to be a respite for stock bulls. Looking forward to catching up with Rebecca Walzer, who's had a really good message over the last year of caution in the stock market. Right now, we do have gains, about 1%.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our portfolio management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcast and start learning today.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience that pushes you to be even better. It just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Oh, yeah, I'm going to take off.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set.
Choose the app that fits your investing style.
I'm Nicole Petalides, live on the floor of the New York Stock Exchange, empowering investors every single market day. Tune in to the TD Ameritrade Network.
The dollar is still positive. Stocks have lost a little bit of their bounce. Rates trying to pick a direction. It's an interesting response to a very interesting number from the employment situation this morning. Let's talk with Rebecca Walzer, President of Walzer Wealth Management. Rebecca, welcome back. Happy New Year. Good to have you here.
Happy New Year, Oliver, and thank you.
Absolutely. You've given us a message of caution that it was very correct and helpful for stocks the past year. Does any of that change as we look at the employment situation right now?
I mean, obviously it's good. Anytime we beat expectation and we have a positive uptick of jobs, awesome, really good news. And we love that. And that means the Fed, can continue its mission to achieve the almost impossible soft landing, especially these global macroeconomic factors. So I still see a lot of caution. It's not so much, we're just not isolated, Oliver. No, we're not just U.S. domestic, right? It's a global situation that we're dealing with. And so obviously that has an impact. So I still see a lot of caution in this Q1, but I love any good news, and every win is a celebration.
All right. Now, right now, the market that's been winning the most is Chinese stocks. The last couple of weeks, they've had a face-ripping rally. So when you talk about playing the international front, that's what I think about right now. Across the pond in Europe, they've got some major inflation issues, bigger than ours right now, arguably. Yeah. So if you look outside the U.S., what are our options?
So yeah, I agree with you. I mean, Europe has seen it come from 10 down to the 9 range. So they're seeing a little bit of impact, but they were a lot slower, Oliver, to, go for interest rate increases. We saw that very slow, even Bank of Japan, obviously I'm going over Asia now, Bank of Japan, obviously not doing, the only central bank of all of 2020 that did not do any rate hikes. So Europe is seeing a little bit of a downtick in inflation. I think that we're going to see, probably because we're still 2 months left of winter, and the energy crisis with Europe and the pipelines and all those things still have yet to have that impact. So I'm still bracing from that perspective to see kind of how that works out. But as far as China, I think, the market braced for these really, archaic maybe lockdowns from coronavirus, because obviously they have something going on over there. And I think when they eased restrictions, that the market said, oh, well, you know what, maybe there's some hope. And I think we're getting a reaction to, okay, we might still have some hope that we could have some sort of a normal start to the year without these crazy zero COVID policy restrictions. So I think that there's really positive news everywhere, but nothing is actually fundamentally resolved, Oliver, and that's the problem.
So here, and our inflation situation improving as the numbers have come down, but still elevated, and a Fed that looks pretty set to keep fighting inflation. And from the messaging in minutes this week, that they also don't want to see financial conditions loosen too much through stocks. So has anything really changed in terms of how investors should think about the regime that's been created by the Fed? Growth stocks going down, value stocks doing a little bit better, but still going down too?
Yeah, I mean, I think the problem with the value stocks is obviously we look at value stocks for dividends usually and cash flow, right? And if the underlying stock value comes down, you have a longer term investor who's not so worried about the capital gain side of it, because they're really looking for the yield on the value side. The problem with the value stocks is the dividends will look to be cut when the cost of capital is too expensive. In other words, if we can cut our dividends and use our own cash instead of going out into the market as the cost of capital continues to go up because of federal, interest rate, Federal Reserve interest rate hikes, that's when you start to see the value stocks start to make different, calculations on dividend policy. And so I caution investors to say and to believe going into 2023 that they can just move to value and rely on cash flow, because that too can change if our economic conditions really worsen, and companies will make that decision. But for now, obviously, the winner of the day would be someone where you don't worry about the underlying price fluctuation of the stock, and you're really looking for yield and cash flow. So I can see that makes a lot of sense, but I would still just have caution, because the Federal Reserve likely will give us another 50 basis points, I believe, at the end of January. I don't think the job report alone, now obviously we'll get CPI data next week and we'll find out. And I think though, Oliver, it only re-emphasizes and only re-encourages the Federal Reserve when they do see their actions working to continue on that course.
Okay, that's kind of exactly what I was thinking this morning, which was, if I'm Jay Powell, I'm looking at this, I'm kind of going, all right, not bad.
Exactly.
Participation rate going up, unemployment down. a few cracks and some issues in the high tech stuff, but maybe a price that I have to pay to cool down the bubble from the last couple of years. So I guess they can look at this and think jobs going all right.
Yeah, I mean, I think right now, I still have a big concern about where are all the workers. We still have almost 10.5 million job openings, but it is great to see a really strong job report at the beginning of the, end of the year, obviously coming out this year. And every win we'll take, Oliver. We'll take, the 2022 was so difficult that any kind of good news we want to hold on to and celebrate, like, yay. But at the same time, this is, we have not turned the corner. We still have the Fed in a rock and a hard place. They have to keep the strength of the dollar up globally because of the monetary macroeconomic changes that are happening with the BRICS nations, the gold reserve currencies coming on board. This is a lot of macroeconomic changes that Powell needs to keep that dollar strong. So I really think that it's going to take a lot more to make him go from hawkish to something else.
Rebecca, looking at your notes and a few other items that are on your mind, I want to get your thoughts on real fast. Some of the residual damage from the last year that seems to be now kind of almost independent of the month-to-month.
Good morning, everybody.
Bed Bath and Beyond talking bankruptcy.
We got about 3 minutes to opening bell. So let me get the intro out in case somebody is watching this in the replay. Good morning. My name is Sandra, and welcome to my channel From Lack to Legacy. On this channel, we're all things money, investing, and mindset, particularly how to go from a scarcity mindset to a mindset of abundance. If that sounds like something that you're interested in, please stay. If you're new, welcome, welcome, welcome. Don't forget, smash the like button, and don't forget to subscribe. I say this all the time. It just hurts my feelings. 66% of people who watch aren't even subscribed. It hurts my feelings. So go ahead, hit the subscribe button, and I'm going to go ahead and pull QQQ up. Hold on one second. So let's see, where are we? I'm going to cut that one.
It's just a whole mix of retail versus online versus brick and mortar. It's just, and then it's a novelty, not a novelty, but it's not like a utility shop. It's not like we have to go there and we have to buy.
And we are off to the races. We're just a few minutes before opening bell. Hey, C-Bar. Hey, L. Hey, Frank. You already know. Look, I took a nap. Retired life is it's a good life, y'all. It's a good life. It's a good life. Oh, but I got to do my gratitude thing too. I have one. Each day, I'm putting in a gratitude statement in my jar. And to be honest with you guys, I'm grateful for tribe and community. Yes, that's it. I'm grateful. And that's the truth. I'm grateful for community. So, and let's see, maybe QQQ will make us grateful today too. So that goes in my jar for today. Okay, and it looks like we're off to the races. So I'm just going to check some things, how we do. I'm going to check Market Watch, see if anything's going on. Check our, let me get this TV in proportion. I'm going to be checking our watch lists. See what we're doing here. I know Costco had a good day. Look at Costco up $15. Let me just go peek at Costco. Just for the heck of it. Look at Costco overnight.
Select the name box, then create.
And look at it this morning.
Enter a watch list name.
Look at that mean wick.
Enter a ticker symbol in the symbol box, then select enter. Continue
Okay,
adding.
let me get over here and watch my baby, see what she's doing
then
today.
select save.
But it's so good to see everybody. Happy Friday, everybody. Happy Friday, happy Friday.
After creating a watch list, you can add symbols to it from
I hope everybody made good money this week.
From the charts tab, select the list icon and then
Good morning, Frank.
From the
L. Who else is here? Hey, lovely lady. Welcome, welcome, welcome.
And that's how you make a
Is that Eileen? Good morning. Good morning. If you're still here, welcome everybody. We're just watching candles come in, doing what we do. watching QQQ, amongst other things. If you are trading something else, or if you're trading today, please drop it in the chat. Anybody paper trading? If you're paper trading, drop that. We want to know. We want to share in your joy. We want to share your victories. Look, you can lean on our shoulder. We've all been there. When a trade doesn't go your way, we're here for one another. So if you're new, yes, this is a learning community primarily. Why does my computer keep adjusting? This is a learning community. I'm a new trader. I am not an expert, but there are experts in our community who are always willing to share. Good morning, Johnny. Good morning, Deborah. Good morning, Miss Vice. So yes, we're every trader imaginable, from the one who's never even pressed the button to people who have solid, locked in strategies and setups that they know and can teach and are willing to share. So if you fall anywhere in between there, you are welcome here. You're welcome in this community. So the way it works is you drop in, we drop out. I'm here all day. I've invited everybody into my kitchen. I just host. And I just talk. That's about the size of it. And I sip my tea. And today I have something so good. It's a eucalyptus, honey, and usually I put a little ginger in there. So we'll see. I was rushing, so I didn't get a chance to hook it up the way I normally do, but that's neither here nor there. Let's see what QQQ is doing. Johnny, what you trading today? Or you on the sidelines? You watching?
Bitcoin's still down 80 bips.
Oh, come on. Time flies.
Don't necessarily scream out risk on. Let's give
Let
it
me
some
see
time.
what
See
y'all
which way the
doing.
gap closes. Going back,
I'm going to turn the news up just a little bit because I need to get a sense of what's happening today.
Southwest even is coming back here. They're only down 1%, Caroline. I can't believe that.
Yeah, not quite as bad as it initially looked. Was down about 2.5% in the pre-market, then about 2%. Now only down about 1% on this news. Although keep in mind, we did talk about Southwest already has been pretty punished since canceling nearly 17,000 flights between December 21st and December 31st. But now we're learning.
I tried to log on to Southwest website to book a flight, and I couldn't even book a flight. So I don't know what's going on with that.
Expecting about EPS about 59 cents. So pretty disappointing there. Southwest estimating a hit
I
in the range
know,
of
I know.
725 to 825
So yeah, I'm chilling too,
million
Johnny,
from
just
the
watching.
disruption. An estimated 400 to 425
But you guys, I
million
tried to
in
book a
lost
flight
revenue.
on Southwest, and when I went to the site, nothing, blank. I couldn't do anything. So I'll try it again. But man, it must be a mess. I don't know. Snowstorm or something got them all messed up. But I tell you, they better get it together. Let's hear.
But heading into today, shares were down about 8% since December 21st. So adding to those losses, but not by all that much.
Good morning, everybody. Welcome, welcome, welcome. Welcome to my channel, From Lack to Legacy. If you're new, make yourself at home. We're just a bunch of traders here, chilling. We come together, we peek in, we pop out. So you don't have to feel obligated to stay, but we share here. We share knowledge, we share skills, we help one another, we cheer for one another. And we always welcome, any other traders. You are welcome here.
So maybe we get a little support down here. We'll see. If it starts to rally, that'd be really interesting. Right now, it's just not selling off too much. But still, I mean, I'm pretty forgiving.
So things look a little green.
But let's talk some retail and some consumer. Costco
These numbers look
shares
like
up almost 5% this morning.
Yeah, I had a good holiday quarter, or a holiday month, I should say.
Costco's up over 5%.
Reported net sales of $23.8
Let's
billion
check 'em out.
for the month of December. That's an increase of 7% last year.
Ooh,
So we're seeing
shoot.
shares
Look
up
at those
5%.
candles.
Investors clearly cheering that. Same-store sales, meanwhile,
I don't
rose
chase, but
5.5%
man, that's the way
for
it looks when it comes in,
Saw
y'all.
Food and sundry sales climb in the mid-teens. Even non-food categories were up
Only thing that
slightly,
worries
driven
me
by
about
strong
that
sales
is
for
it's
tires,
over.
sporting goods, apparel, health, and beauty. So it
Wow.
could maybe quell some anxiety that we saw
So, yeah,
for
look at that.
Costco shareholders back in December when it
I like
disappointed
Costco.
in terms of Q1 earnings and revenue back
I'll be
in December.
curious to see
One
how
weaker
that
point, though, to note,
unfolds.
Oliver, E-commerce sales actually fell more than 6% in December, but investors appear to be focused on the positive today, up about
Look how big and
5%,
strong.
and now a winner on the year, up about 4% in
Look at over
2023.
here, mind my
In
business.
the early going, but
Mind
hey,
the business that
not a
pays
lot of
me
winners so far this year, so have to focus on the
sometimes.
positive.
Okay, and we've got some of that this morning. Nice lift off here for retail, with the exception of
Johnny,
Amazon.
what would be the downside of
Thanks,
getting
Caroline.
in or jumping
Good
in
stuff.
to a
Numbers
Costco
leading to a rally this morning.
call?
Costco
It's never,
up,
it's not even,
stocks
wasn't really
up,
on my radar. I mean, I
and
knew
we've
that they
got
were making a
quite a
move.
bit of news flow
But what
to
would
hit
be
with Mr. Jeff
the,
Pierce,
you know, you looking at
Senior
it.
Manager of Derivatives Trading at
Where
TD
is she?
Ameritrade.
That
Jeff,
looks like a
let's talk
very
some wrestling.
healthy.
Let's have some fun here. Vince McMahon is back.
Come
That didn't
on.
take very long. Just
Well,
like Bob
we'll
Iger coming
see.
back
Maybe
to
so.
Disney.
That third, maybe that confirmation
Seeming
candle
like it with
coming
the
in
stock up over
might be
13%
helpful.
right now. But yes, he said that majority owner, the CEO of the
Sometimes I answer my
WWE
own
has said
novice
he wants to return
questions.
to their company after retiring just last year. He told the board
I know what I
wants to
need to work on.
renegotiate the
Patience
company's
is
media rights and
definitely, and
capitalize on
wisdom,
the
just
unique
being wise. I
opportunity
think that
to
comes the more
maximize
you
long-term value
trade.
for shareholders. In doing so, he wants to join the
As
board of directors
Southwest will
and is said
lose.
to
Oh my
expect
gosh.
to become the executive chairman. He's also going to bring back a former co-president
That's a
and
lot of
another
money.
director with them. In a statement,
That's a heap of cash.
expected suitors or potential buyers of this deal that he keeps talking about would be Fox and Comcast, their media businesses, which already play the WWE program.
I'm not sure about cost. I could look it up, but
whether or not these companies will want to work with the
Costco, yeah, Costco. I think their contracts are expensive. Yeah, I'm talking about Costco.
Federal intervention as well.
But I think maybe that all spilled out overnight. They shot up on news. So let me get over here and watch QQQ. This is why I don't jump around. Because I know what's happening over here. I know what this looks like. I understand this beast. And so I stay in my lane.
But you know, as you see the reaction from
Stay
shareholders here is
in
positive.
my lane.
There's certainly going to be a part of the board that could see him being the man to do the job in terms of getting these negotiations done.
Here's the big pop, 14%. Here's what's amazing. If we look at the 1-year chart again, it's just, markets are a beautiful thing, Jeff. Not as beautiful, of course, as, you know,
we got news today, right?
Okay. In
I
terms of
haven't really followed it.
entertainment.
Yeah, me
I'll tell you
either.
what, man, this stuff
That's
right here is
all the
pretty
reason in the
too.
world not to jump
Trend
in.
is amazingly
Because you haven't been following it. Yep.
and draw through all
Okay,
those
what we doing over
higher
here?
lows. And when we broke that,
Oh, Lordy
amazingly,
B.
Vince McMahon comes back and sends
Come right
it
out the gate
back
acting a
above the
fool. Johnny,
line.
maybe this our maybe.
Yeah, well, coincidence or not, I mean, it's just amazing
Maybe.
stuff, and the uptrend holds.
Yeah, absolutely. I mean,
Let's
listen, you've got a
let me
market
look on
cap
the
over $5
hour.
billion, generating over $202 million in operating cash flow for the last 9 months in 2022. I think you've got a business model that seems to be working here. You've certainly got a lot of revenue
260.
coming in from the shows that they play. If there's an idea that they can capitalize even more, to your point, stay on track with what we've seen from the stock previously. Obviously, investors are over the moon about that.
All right, big day here. Even as the rest of the stock market gets a little bit of a smackdown right now. Okay, we are lower by about 0.5%. So futures are dropping off here a little bit. We'll keep our eyes on it. So interesting, a good story for WB. The gains continue to hold. Let's talk some of the analyst notes out this morning. Generally pretty positive.
So Johnny, is it correct? Because we know QQQ has been trading in a range and it hasn't been able to break market structure at the support of 260. So if it were to break out and beyond 260, and I'm thinking, you know, I got to put bias. But if it were to break down and stay below 260, is it that's what we're looking for? That's what we're hoping for, right? That it breaks out of that range either up or down, and that it stays out and makes a run for it. That's what we're looking for, support of.
Possibly some more headwinds
Because here it is on the hourly. Holy moly.
Price target of $380. That's up
And
from
it's
262.
Yeah, it's been sitting between 263 and 260.
Demand broke down, inventories ballooned, cost spikes. and they see a very challenging catalyst path heading into 2023. They also said holiday results were likely okay at best. With a difficult Q1 setup looming, they think street numbers will likely be coming down on weaker initial guidance. I think if you look at the last report, obviously we saw a large stock drop. We saw them beat on earnings per share. We saw them beat on revenue. Comps were up 22%, beating expectations, but the Q4 holiday quarter guidance disappointed with the higher end of their earnings per share and revenue, both just coming in line with analyst estimates. We know that the pressures of inflation, the slowing spending, the lower e-commerce sales have dragged on the stock, especially a stock that hit 485 back in late 2021.
Okay. Yeah, the challenging path ahead. I mean, it seems like it's it's a macro challenge. It's
so interesting watching. I'm telling you, I could do this for hours. This is insane. Trading in smaller accounts.
Like everybody's in a race.
Class
Lulu's
under education. It is a download that's attached to the class. Okay. Yes, break 260 would be a trigger to short. Yes. Yes. And above 270, yes, on the upside. Okay, perfect.
There was an Athleta and there was a Lulu, literally a block away in Alexandria.
On the downside.
And Athleta prices were like 60% off. Lulu.
Yes, that's what I know. I was looking at yesterday's low too. Okay. I know if it breaks market structure, that's always significant. That is okay. So Johnny, is a break in market structure always a buy or sell, or is it just, well, I guess it depends on if it breaks for real and stays like, not just dips down, not a fake out. Because I've seen those. Plenty of times, plenty of fake outs. They break out, but they don't stay out. I think that's a definition. My definition of a fake out. They break out, but they don't stay out.
Down 40% in the last year, but I can see why analysts still think that maybe there's upside to the $250.
Yeah, and listen, the estimates, the sales estimates for the holiday season are gains of about 28%. Again, you mentioned the price cuts. That is a concern for investors out there. I mean, inventories grew by 85% last quarter, same as the prior quarter.
I've been faked out a time or two.
They're going to have to start adding discounts onto their brand. Having said that, to your point,
taught me not to be so eager to jump,
because
you can get faked out. Okay, let's go back down here where I like.
Is there. The question with some of their guidance out there is, are they just being a little bit soft on their guidance?
So if anybody's watching this candle come in, I mean, it's a very robust red body, but look at that wick. Johnny reminds me, that wick is telling too. There's a lot of buying pressure there. So, and then when I like looking at the candle broken down. So that 15-minute candle is made up of 5-minute candles. So if I go down and look at the 5-minute candles, you can see that there is some buying pressure, and you can, this is looking.
Yeah, we've got some more optimism around.
So we're getting down below all of the SMAs.
The analyst says that they think the Las Vegas Strip momentum
should easily
continue through 2023 and 2024. They see more value with Macau and Las Vegas Strip.
And the way one closes and then the next one opens right as, and they do that. I'm telling y'all, that's a stair step thing. I'm always on the lookout for that stair step thing. Because look at it. You see the green? Telling you, if you can string some of those stair steps together.
All of that would be good.
That's a move.
We've seen these casino stocks with ties to Macau struggle. One of the
so let me look down on the 3. Well, all of these candles are made up of 3-minute candles. So I think that's why I like to size down. So because you can really see what's happening. It tells a story. Look at that doji sitting there.
And the Macau deal.
Doji signify indecision. So, or I don't know, is that equilibrium even? Because price opened and closed just about at the same place. So what does that say? So now you guys, now that we're studying candlesticks, I'm thinking more about like market psychology. Like what are these candles saying to me? Not just you know,
MGM
it
looking
opens
better
up a
than
whole nother
Caesars
can of
right now,
worms. Oh my
looking
goodness.
better than Penn.
Opens up a
on the
whole
past year.
new line of
MGM
questioning.
down about 20%. Penn's down 36%. Caesars is down 52%. So as far as the Vegas Strip casinos, MGM right now looking like it's really the only one that has
No
like a
follow
6-month-long
through.
uptrend. So bullish note and an
No,
upgrade,
you did
full
you really,
upgrade to the
Frank?
buy. Okay, good stuff.
Frank is in here
bullish
scalping.
Last one, Jeff, before I let you go, is the way we're seeing tech roll over again today.
369.
Still higher after
Dang, Frank.
Bear dropped the.
I'm not
DC
mad at
Bear
you.
Case. They're not saying buy it, but it still has.
That was fast.
Here, as we do have.
Frank is in and out, y'all. Frank is in and out. So you bought a put, I'm assuming, of course.
It's really following those
Great job, Frank.
talks with Kiaxa. They said the generic.
Frank and I said we're focusing on base hits. We are not looking for home runs. We'll take $100, $75. We'll take wins. Wins are wins. You string a bunch of wins together.
They said the significant decline in Western
Keep your losses small. Keep your losses tight. That's what I'm learning. Oh my goodness. Oh, I had to learn that the hard way. Oh, I got myself in so much trouble, y'all, by not keeping my losses in check. So yeah, base hits. Great job, Frank. Yay.
Previously, they had to stop. We know that the company.
Frank said, "I'm in and out. You on your way out, Frank?"
They want to merge, like to become one.
Start your weekend.
Currently, Kiaxa is private.
That's a scalp. That's a morning scalp for sure. Let me get myself in here and see.
Okay.
Because it went from 264. Ooh.
So we'll see
to 261, 62, 262. Let me see. It was 264.30 and it dropped all the way to 262. I'm not mad. And if you waited for this candle, it got all the way down to 260. So hey. That was a $3 move at least. I'm not mad. That was gutsy. Get in and get out, Frank.
At least 3 of the other video game businesses still have quite a bit of upside left, and that includes software stock.
Yep, gotta be quick.
On the show a few times. We'll talk about AppLovin.
I bet he probably had his stuff all queued up. Unlike myself, let me go queue up my stuff. Hold on, y'all. I'm taking y'all out of here so I can go queue up my tray that I should have had done that I didn't do. Oh, is that a glare? Oh, I couldn't even see that. I'm going to slide over.
Go to the Analyze tab and select Fundamentals. Enter a symbol, then select Enter. To download detailed analyst reports, select Download. By the Numbers provides balance sheet information and other fundamental data.
Did you guys hear that?
Provide summary
Wait a minute. He said Analyze tab, Fundamentals, and enter a ticker.
If you find any of the information particularly helpful, you can print it out or take a screenshot. For more demos on how to think or swim, head to the education
That's
center on
what I was looking
TDAmeritrade.com.
for. Okay, I'm gonna have to show that. I'll show you guys that because we were talking about how to do fundamental analysis yesterday. I might as well do it while I'm here because if not, I'm gonna bring you guys back in to show you something. Remember we were talking about yesterday, how do you research in order to find out if a company is a good company, and you want to do fundamental analysis. You want to look at their balance sheets. You want to look at their money. You want to look at leadership. And the way you do it, where you can start, if you are on Think or Swim, you can go to the Analyze tab. So let me go to charts first. So it would look like this. Normally we would start from charts, go to the Analyze tab, then hit Fundamentals, and then this will pop up. So here you get to see we're talking about Apple. It's information technology. You see the price that it's trading at. You see the buy rating. Some are saying buy, hold. You get to see all of that. Market Edge says avoid. You can view all of those reports. Then it gives you some background information about Apple, and then you get into all the numbers. And then the valuation. So here's a place that you could start right at your fingertips if you were interested in doing some research for long holds. I know we were talking about that yesterday. No, I don't need that. We were talking about getting ready to purchase long holds and how do you research if a company is a good company or not. So go Frank, go Frank, go Frank, go Frank. Yeah, so that's how you can find that it's under the Analyze tab and Fundamentals, and there you have it. So let me go ahead and set up my stuff because I haven't set it up. So let me get over here and set up some calls and some puts. Look at this options chain. See what's happening. Okay, I'm just looking for calls and puts because you never know what the day holds. So, okay, wait. And I keep making adjustments to my stop. Yesterday, I had it set really tight, like at somewhere between 4 and 6%. I'm going to keep playing with it till I'm comfortable with where my stop is set. So let me get over here. So I'm going to move it to maybe 6%, 7% until I am comfortable because it stopped me out at like $50 and I could risk a little more. So I'm going to keep playing with it until I'm comfortable with the risk, until I'm comfortable with that. So let's see. Okay, I just want to check this order over really closely. Okay. Save it. And then I have to clean out my tray from yesterday because I always have leftover stuff in there that I need to clear out. So yeah, that part. That's amazing. Yeah, my stop was real tight. I had it at like 4%. So I'm going to delete that because I put it at 6%. Let me make sure I got that right. Yes. Okay. So that is done. And some of the ladies were asking if we could show how to actually place a trade and do a trade. And I will do that. I'll do it in paper money so you can actually see everything step by step, how to place an order. So let me go over here and find a call. Hmm. And so I'm using my OCC bracket that my friends taught me how to use. I learned that right here in this group. So if you're new, please don't feel intimidated by what you see or what you hear. And right now you can't see or hear anything but me. But if you're new, I promise you, we all started the same way I did. And people have been so kind to me in this community. They have helped me with stuff that some people would be like, how are you even out here trading and you don't know how to do that? But everybody has to start somewhere. And so I'm not afraid to share my practice. Thanks to Stephanie Perry. She told me to practice out loud. And so I'm practicing out loud in the most real way. I practice for the world to see right in my kitchen. And that's what's happening. That's how this all got started. I didn't want to trade alone. And so hey, I opened up my kitchen to my friends. Okay, let's see. I got to make sure I got all this right because trading might not be difficult, but you do have to pay attention to details. And so while QQQ is just trading in this range, still range trading, I am going to get all set up for today. Let's see, confirm. Save. Okay. I want to look at puts over here too. Oh, wow. There's a lot of people here. So I'm just queuing up another set of puts with a different expiration date because I just want to look at them side by side. So that's what's taking me so long. Yeah. I just want to make sure I get it right. That's the kind of stuff where I just don't want to rush, when you're trying to pick the appropriate contract, it pays to just take your time, especially if you're new like me. Take your time. Don't feel rushed. Okay, I think we got everything. I want to see the price on this. Okay. Hmm. Okay, I think I'm all set up for today. I think I'm all set up. Okay, so let me bring you all back in. Let me make sure I got it on the chart. And here we go. Okay. We are back, everybody.
When looking at a trade setting up based on what Martin expects here, I think he's got a $150 price target on this one and outperform. So looked at something that takes advantage of maybe a grind higher into that earnings event, but avoiding it at the same time because we all know the volatility that can be produced on an earnings event. So went out to the January 27th weekly series before those earnings. And I've just bought a simple $5 wide bullish call vertical where I'm going to buy the basically at the money, the 125 strike call, sell the 130 strike call because maybe you don't think it's going to go up and I want to reduce my cost on that bullish 125 call. You're paying roughly about $1.90 debit for that $5 wide call vertical that can expand to $5. So you've got a good risk reward setup on this one. Your break even of 126.90 to the upside over the next 3 weeks. Only it's less than 2% above the current share price in EA. So if you think that, we're going to see some upside in the stock, you want to avoid that earnings event, this might be the way to play it, leveraging the option market.
All right. 2 bullish trades, just a little bit more bullish in EA.
Yeah.
All right. Thanks, Tom. $150. Martin Yang for Oppenheimer on Electronic Arts. $145 for Take-Two. $26 for Mobile Business App Lover, which right now trades at $9. So he's looking for a pretty big pickup there. Coming up, let's talk the next data point. ISM, market likes this one. Going to give it another shot. NASDAQ did go red. Now we're trying to flip back positive. We'll bring Ben in for a rundown, and then we'll talk some banks. We got earnings next week.
Ford's been moving. Let's look at Ford. Let's see. What is Ford doing? Look at Ford just chugging along, y'all.
Let's walk through
some
charts.
calls on Ford. Look at Ford.
Features on Thinkorswim.
Chug on.
Start by going to the charts tab and entering a ticker symbol. Select time frame to adjust time intervals or to favorite a time frame. Select style to change the appearance of the chart. You can add drawings
might be
by
a little
selecting drawing tools, and then type of drawing. For symbol comparisons, select studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
What are you doing? Okay.
When traders tell us how to make Thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade. It's a 13-hour flight. That's not a weekend trip.
15 minutes. Are we
I'm going to take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Thanks.
We'll see you. They're getting so smart.
Choose the app that fits your investing style.
$262.34.
All right, things get very interesting here this morning. 30 minutes into the trading day, we got a lot of back and forth. NASDAQ lost its post-employment bid and went negative right before ISM Services dropped the bomb. Huge miss on what has been the strong part of the economy. The strong half of the ISM and PMIs have been services, so to see it go sub 50, we do have a market reaction with bonds rallying. Now we're really going to test just how much stock bulls still want to see bad data, because that ISM, that was a bad print. All right, we'll talk about it in a moment here with Ben and Kevin. We still have a lot to discuss for stock specifics. We do have earnings coming up next week for banks, so there's no shortage of analyst commentary going into the early earnings. The latest is a downgrade on a couple of the big ones. We're going to talk with the CEO of a very interesting business that I think is very important to the services conversation about restaurants, hospitality. Shift Pixie, which is publicly traded, is trying to address the gig style of work today. I'm looking forward to that conversation.
Not the gig
Chart
style
Master, we
of
do have
work.
some other analyst notes to talk about.
Oh
Another
my goodness.
note out on
Okay,
beer
so
business,
Google is
Molson
down.
Coors, a few other interesting names we'll talk about, including
Amazon, Microsoft,
Penn, which you
and
mentioned earlier in the
Tesla.
gaming convo.
I can't
All right, let's
barely
bring
even
in
look
Ben,
over at
Mr.
Tesla.
Lichtenstein,
Gosh,
futures
yeah.
host. What's going on here?
Boy, tough to figure out, huh, Oliver?
Okay,
It depends
well,
on,
Tesla, there
are
you
you talking
go.
right
We
now,
need some
5
good
minutes ago, or
news.
what we're going to see in a couple minutes?
Right, or an
because,
hour ago.
This market's all over the place, to say the least. Now, we came into the cash open, or I'm sorry, into the jobs report, 2 of the 4 majors positive, 2 of the 4 majors negative. We spiked up in reaction to, gave some of it back, as Oliver mentioned right before the ISM.
Almost all of it back.
NASDAQ was actually negative as the ISM number came out, but here you can see we're upticking right now. The NASDAQ's up by about 1/3%, but still struggling with 11,000, the NASDAQ. This rally here, I want to point out, never took the highs out from earlier in the week, so all of this kind of craziness contained relatively on the bigger picture. But let's get into the numbers here and behind what's moving the market higher now at this moment here, and that's weaker than expected ISM data and weaker than expected factory data here, Oliver. Let's begin with the ISM. Look at this. Non-manufacturing PMI below the 50 level to 49.6. They were looking for 55, prior 56.5. Business activity slowed. Employment slowed, Oliver, below 50 from 51.5. New orders to 45.2 from 56. I mean, that is just a cratering, and then look at the prices paid even falling off, and that's a good thing. So I think that's why we're seeing, again, slowing and easing in terms of prices, employment slowing a little bit, and we're seeing the indices rally in reaction too. We've got factory orders here this morning as well, Oliver, down 1.8%. They were looking for a decline there of down 0.8%, but also, Oliver, they revised last month's to lower, down 0.4. So all of this kind of showing signs that things are slowing a little bit, especially this ISM. Now, the real question here, and I think this is what's important, is if we go negative, if the NASDAQ, I should say, goes back into negative territory before the end of the day, then that kind of feeds into the narrative that we've been talking about, where if bad data is good, then the market's going to rally on this kind of news, right? But if bad data ultimately, longer term, which it is bad, then ultimately we're going to see stocks continue to falter. And the NASDAQ is punching up here, but still holding below 11,000, still holding below this week's highs, and it's only up by 1/3% here right now. So let's keep a close eye on the NASDAQ today.
Yeah, it's very interesting, the combination of numbers with a really nice employment print this morning, to be followed up by the drop in the services in particular. Factory orders down 2%. Not as big of a surprise. They were expecting it to go negative, connected more towards some of the manufacturing data that we've already seen showing contractionary readings now for a couple months. The other half, though, of PMIs and ISMs, which we got in the services, that non-manufacturing component, that is a pure shock. Like if we saw this in a month after Southwest canceled 17,000 flights, all right, maybe we'd but this is something totally different. This is a very big surprise. Doesn't have a lot of obvious explanation for it when you have this type of a steep drop off. And the fact that new orders go down with it too makes it look very, very real.
Well, that's what I'm looking at here. I'm trying to figure out the last time we saw new orders below that 50 boomer bust level, and I'm going way back here, Oliver. It might take me a second,
but
yeah,
have to go to 2020.
This is again, you got all the way back to, you said it, June of 2020. We were down around 42. So after that, we saw a spike up into the 60s, and we've been holding above 50 cents. So yeah, this is definitely going to raise some eyebrows, and it's going to raise the indices a little bit. Look at this. The NASDAQ just doubled the percentage-wise gain since the last time I quoted it. It's up 0.6% now. It was up 1/3.
There you go. Here's bonds rallying big.
This is why, yeah.
So it looks like when you combine, because that first pop is the employment report, the second one, the data we just talked about, it looks like combined, the net move here is a big bond rally, which is the market saying the data is either weak, non-inflationary, or potentially could slow down the Fed. To your point, if stocks rally with it, then it still might suggest the bull case rests in bad data, but TBD, because we've seen all these levels before.
That's right.
To your point,
this is all on the bigger picture, just chop random type price activity, and we know where the Fed is headed ultimately in terms of the bigger picture.
And we're very close to the lows for the NASDAQ too. So this is happening near the lows. If we sell off, then we're breaking to new lows. That would be a very big deal. It would be a huge a wake-up call for those that think bad data is good if we drop today. But so far, we're up right now.
Especially if we were to see treasuries continue to rally and the NASDAQ were to come off. But again, yes, we are up 0.75% right now.
Dollar's down about 0.25%, so that's weak again. That can help stocks. Apple's up 2%. That's definitely helping. All right, fascinating stuff. We'll give it some time to marinate here. Thanks for the walkthrough here, Ben, of the data. Take your pick. Good employment in the morning. Bad services data later in the morning. Let's talk some earnings. A very important note out. Kevin Hanks going to take us through it. Downgrade from a bank on the banks, Kev. Next week, earnings never really stops because we hit them all the time here. We hit everything.
That's right.
Up to the late reporting cloud companies, to the early reporting financials. What are they saying?
We're in the slow period where earnings are over for last quarter and about to start for next quarter. Oliver, January 13th is when we'll get earnings from JP Morgan and Bank of America that we're about to talk about. Also Citigroup and Wells Fargo. And this morning, Deutsche Bank comes out, lowers Bank of America, lowers JP Morgan, both. They take them from a buy to a hold. The price targets on JP Morgan, 155 to 145. The price target on Bank of America, 45 to 36. Now, Oliver, when you think about the banks coming out a week from today, you think the good, the bad, the uncertain, right, is going to go on. Net interest margin, good, a windfall for all these financials, but you can look at the 10-year yield. It's tapering off, right? The spike in net interest margin. So that's going to level off. How about capital markets fees? If volatility in the overall market comes down a little bit, people start trading more. You'll get more fees from there. But loan loss reserves, loan growth, deposit sluggishness, all those things are working on these banks. We'll see, but make no mistake, net interest margin is still a windfall for some of these financials. So as we get to working into next week, remember, JP Morgan and Bank of America probably most similar in terms of community banking.
Yeah.
They do everything in terms of financial. Remember, if you look at Bank of America, within the walls of Bank of America, Oliver, remember, lies all of Merrill Lynch from the financial crisis on. This is a big bank.
Yes.
JP Morgan, obviously, is a big bank.
The two that have that balance of the bulge bracket, Wall Street trading element,
right,
and the everyday regional style lending business, consumer business. And then Goldman, on the other hand, kind of a more pure Morgan Stanley and Goldman, more pure
investment
Wall
banking,
Street investment
trading,
bank,
risk management. Exactly.
Yeah, capital markets. The thing is that Goldman had one of the most powerful rallies during this bounce that we got in the fall. It gave a lot of that back. It's JP Morgan basically is kind of the standalone here one, going sideways a little bit at sort of the midpoint of their trading. But anytime I see analysts downgrade companies right before their earnings coming from another bank too, it's like not a great sign.
Remember, it was about a month ago, 3 weeks, a month ago, that JP Morgan or Jamie Dimon warned about slowing economic activity across the board. Remember, and then one after another, the CEOs of Bank of America, Citigroup, they all came out, Wells Fargo, all came out, the CEOs, and talked about a weakening overall consumer demand. So we'll see if that shows up. But make no mistake, net interest margin, without a lot of work by the banks, is a windfall for these banks. So that'll always be a big number here with interest rates rising.
They're doing all right here today. They're hanging on.
Yeah.
They have had a couple of good days while the market's been soft in the last couple of weeks. Again, the fact JP Morgan has held on to its fall bounce while all the tech companies gave it back, that's important. Definitely tells us there's been a little bit of a tone change in what investors are kind of trading as perhaps a bastion of safety right now, because they sent all the NASDAQ stocks back down to the lows, but banks are still elevated.
Remember the tone that the Fed officials are sounding, which is higher interest rates for longer favors the banks.
Okay. Thank you, Mr. Hanks. Nice look here at an important note. Bearish tone, not deep price target cuts, but formal downgrades ahead of earnings next week. Let's trade the group, in particular JP Morgan, with Mr. Dan Deming. All right, Dan, what do you think here? Pretty negative tone from this analyst ahead of next week, but the charts actually look all right.
Agreed, Oliver. I agree with that. And yeah, it's interesting. going into the earnings announcement that you'd get a downgrade. Like, of course, it's coming from Deutsche Bank, and so I don't know, take that for what that's worth. But anyway, looking at the price action, I'm glad that you and Kevin touched on this, because you look at the big four: Wells Fargo, Citi, Bank of America, JP Morgan. JP Morgan has certainly shown relative strength compared to the other three. It's been much stronger position and performance-wise over the last year. I mean, they're all lower, but JP Morgan low. I mean, basically almost 10% better than the other ones. So when you go into this announcement, I think there's still a lot of variables out there, and I think the possibility that you could see some price action, higher and lower after the earnings announcement sets up for a difficult trade around the earnings announcement. However, I do think the general trends, and if the market's able to stabilize here and regain some footing and take out 3,900 in the S&P 500, that the banks are going to participate in a trend higher as well, particularly if these earnings announcements come in flat, a little bit better than expected. So I'm looking to play it relatively safe with this trade example, Oliver, and looking at a calendar spread in February and March.
Okay. So you give yourself a good bit of time here. This is a pretty long-term trade.
It is, yeah. You got a couple months, or so going out, particularly if you play the duration in the March option. But the thing about this trade, Oliver, allows you to participate to the upside. It's a relatively low risk kind of metric as far as when you look at the risk metrics on the calendar spreads. Don't have a lot of significant risk to them. I mean, there's potential of loss, but nonetheless, nothing like just selling an outright put or potentially buying a call spread that goes to zero or something like that. That's defined, but right now you're looking at the implied volatilities going into this announcement. Those calls are pretty expensive, and I'm not sure exactly how this is going to play out with these announcements next week. But this gives you a little time. It allows you to digest the earnings announcement. And if we continue to maintain this upward trajectory and start to break above the 140 level, then 145 by the middle of February is certainly not out of the question. And you're going to see that February option decay. You're going to see the March option hold its premium, and you'll see this calendar spread widen as we push towards 145 if that plays out. If we don't, you still got some time to work with this trade, and you're not really putting out a lot of capital to initiate this position.
Okay. So you've got a range of outcomes here that works before the expiry of the longer.
I'm trying to make sure QQQ stays above 264.
And a big event coming up here. Does that mean that you will possibly close this trade out if it goes the way you want early, Dan, or do you plan to generally hold it through?
You could. I mean, typically, when it comes to spreads, usually, my thought process is historically been to unwind the spread. And you could have a decision to make as we get towards February expiration. Do you want to stay long the March call or not? I guess that's the decision that would be made. But if we see some type of upside trajectory after the announcement and we push into that 140 level, it's something that, as we get towards February expiration, it might be a position that you just want to take off and capture what would appear to be at that point a reasonable gain, considering the fact that you're not putting out a ton of risk on this trade due to the fact that calendar spreads have pretty much they're not too terribly exciting one way or the other, but they do have the ability to capture a trend, and it's a way to capture that trend without putting out a lot of capital.
Okay, thanks, Dan, for the trade. I like the explanation, and the approach. Appreciate it. Dan Deming, Managing Director at KKM Financial. Looking at the calendar spread for JP Morgan ahead of earnings. All right, we'll get away from some of the intraday action as stocks try to push back to the highs following that bad ISM. We'll talk about the services economy, which just gave a shocking print of weakness with the CEO and co-founder at Shift Pixie. Very interesting company. We talked about it in our Overlook Stock segment here on the program in October, last quarter. The shares have had a pretty tough go. Sure seems like an important business, though. We'll get into the details next.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our Active Trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcast and start learning today.
I'm Nicole Petalides coming to you live from the New York Stock Exchange every single market day from the opening to closing bells. Tune in to the TD Ameritrade Network.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Shares of workforce software and application shift. Pixie have had a rough couple of years, but as we see the services economy pick up, is there a comeback in store? Let's talk with the CEO and co-founder. Scott Absher joins us from Shift Pixie this morning. Scott, thanks for being here.
Good morning, Oliver. Good to be with you.
We were just talking about your stock at the end of last year in some detail, specifically around, at the time, a reverse stock split, but also just the connection into a services economy that's trying to rebound after COVID. Tell us about what you do.
Yeah, we focus on part-time labor-driven markets. We manage the human capital side of that, and we do it through a very elegant mobile technology platform. And so working on part-time labor brings us into the restaurant industry and retail as an example, but also the flexible labor force, which would be temporary staffing, whether it's medical staffing or industrial staffing. But those are the markets that we focus on.
How much is literally what the name suggests, a worker finding out where there are available shifts and openings? Is this for people that can work multiple jobs at the same time?
It is, yeah. And our platform is, the way we constructed it, our background is in human capital management for over 30 years. And so our approach is compliant employers. So everybody on our platform is a W-2 employee. The idea on the platform is that jobs can be shared. They can be, a worker can operate very flexibly on our platform, really in any market around the country.
How do you get employers onto the app? How much of your business or sales team is dedicated to that right now versus how much do you already have already in? I mean, if I'm working in Chicago and I'm a waiter, or I wash dishes, or I deliver, what are the odds that my employer is going to be on your app?
Low in Chicago at the moment.
Okay.
Our primary focus has been in the East and Southeast, but also in California, where we originally launched the company. So we have population and we have job opportunity density in those markets. However, one of the things that we're doing, to your question about our force, we have a national sales force that focuses on two markets. One focuses on QSR or the restaurant vertical that we service. The other is focused on industrial staffing. And so we've just recently opened markets like Chicago, Denver, Dallas, Columbus, Ohio. We're getting ready to open New York again. And so those are the markets that we're trafficking in. But I would say that what you will see is a job seeker will start to find opportunity primarily in major metropolitan areas. That's where we're most effective. A little less effective in rural markets.
Are the employers that are using the app mom and pop businesses, single store enterprises, or are you able to get franchise big names on there? Like, can you get like an Outback Steakhouse or names an Olive Garden that's all over the country? And if so, what happens then?
The way our legacy approach to the business has been is to work with franchisees under a lot of those brands.
Okay.
So Outback, as an example, is not franchised. But so, for example, Del Taco, Taco Bell, Burger King, Wendy's, Carl's Jr., we go after the franchisee in those organizations. It's a little, it's kind of a third rail for a franchisor at the corporate level to kind of push us into the mix because we're so enmeshed in human capital. It's really an area that's not favorable for them to participate in for joint employer liability issues. But most of our clients, I wouldn't consider them mom and pops. Most of our clients have multiple stores. They're 10 to 20 to 30 stores. So these are sizable operators.
How do you make money, Scott? What's the revenue stream? Is it coming from, I imagine that people, I don't know, do people want to pay to be a part of this? Does it give them opportunities that they wouldn't have otherwise? Or is the incentive from the employers to get the human capital they need? Are you advertising on the platform? Where does the revenue stream come from?
So the revenue stream comes from our engagement at the employer level by the operator. They pay an administrative fee per employee per month, usually, to participate on our platform. So in that market, the population generally originates with the operator, that they move onto our platform and are processed on our platform, but they don't pay anything for the technology, anything additional for the technology. They get to use very elegant tools to manage that local workforce. But also, our technology takes us in some very unique recruiting methodologies. We're doing some crazy, innovative, but very effective things on reaching a worker population. And so, for example, we've run several use cases with some of our multi-unit operators where they may have, for example, 100 openings. And in very short order, we can bring them over 500 candidates. And the recruiting cycle in most industries never works that fast. And it's all really about meeting today's workforce where they live, and it happens to be their mobile device. So that's where we're meeting this new workforce.
Fascinating. It seems it's funny. I was months ago, I guess before I even knew about your company, before we covered it, I was thinking my job in high school and for much of college was actually out in Outback. They used to be franchised, I believe. And I was thinking at the time in New York, visiting a friend, that there needs to be some kind of service that can match people up, because post-COVID, a lot of different dynamics. Certain restaurants that used to be popular maybe aren't. Some of them are closed. Some of them are new. And the need to have something connecting for someone that's maybe they wash dishes, maybe they're a waiter, maybe they have a job that's not there anymore, that they got to figure out where to go. So it seems like it has a very important application. What's going on with the stock? How come when I look at the chart, it's gotten killed, Scott?
One of the challenges, and this is, I always tell people that want to trade in ours, we have a very small float. We're under substantially under 1 million shares in the float. So what that means is, for day traders, we can become a kind of a playground. So it's easily maneuvered, manipulated. So that's one of the challenges. It can be maneuvered upwards or downwards, depending on the mood of the trader. So that's one of the challenges that we've always been subject to, just a very small float.
During COVID, of course, I can imagine, I mean, that's obvious why the company and the shares would have come under such pressure. In the reopening trend now, what's the priority for you? It looks like you're still operating at a loss. I imagine the sales component is huge as you want to continue to expand. How do you balance that need to spend to get people out there, to fund a sales force, to get your application ingrained into the economy, versus the pressure of the investing world right now that wants profitability?
Well, what you're going to see coming into this year, there's a couple of things. We were involved in a roll-up in the industrial staffing industry. We had to walk away from that at the insistence of the SEC because we were using a SPAC, and as a sponsor, they had some concerns about our being a sponsor as a small public company. And its impact is perhaps suggesting that we'd be an investment company, a 40 Act company. So in separating from that, we didn't separate from the work. There's an enormous portfolio of acquisition candidates that we still have curated, and we're still that are still active. So you should imagine that we expect to take advantage of some of that opportunity within ShipPixie from an acquisition standpoint. So so that will drive those us from a net negative profitability to, it should push us certainly into break even early this year and into the black net positive later in the year. But we've got a lot of work obviously to get all that done. But that's part of what's on the agenda. But the organic growth that we've staged for, I'm very optimistic about where we are there. We've got a lot of opportunity that we've curated. During COVID, you can imagine for us, especially in the QSR space, all of our clients or all of our prospects, certainly that we're reporting, all went into a bunker. Nobody was making decisions. A lot of these folks were not even sure that they were going to be in business post-COVID. So now that everybody's coming out of the bunker, it's an opportunity for us to go back to all the folks that we proposed and quoted, pre-COVID, and now we're actually going through and reinvigorating all those opportunities. So we're very optimistic going into this year about our organic growth alone.
Okay, looking forward to following along, especially with some of the operational reorganization. Scott, looking forward to keeping in touch as the year goes on. Thanks for being here.
That's great. Thanks, Oliver. Good to be with you.
Sure thing. Scott Absher, CEO and co-founder at ShiftPixie, ticker PIXY. Really interesting business. Seems like a very important one. Chartmaster coming up next. Got a couple downgrades to take a look at. Once again, focusing largely on the consumer part of the economy with Penn. And we've also got in the mix Molson Coors and Bath & Body Works. Be right back.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on tdameritradenetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Okay, we got some consumer charts to take a look at with Mr. Rick Ducat. Kevin Green is on the analysis. Let's talk some booze first. Molson Coors and TAP. Kevin, our positive one this morning with an upgrade. What's going on?
Definitely. So we see Cowen actually upgraded Molson Coors to outperform from market perform with a new price target at $60, and that's up from $55 here. Now, after about a decade of revenue declines, they do believe that the company is very ready to be able to capitalize on not only potential growth from a consumer standpoint due to their pricing structure, but also how they have been able to manage their expenses as well. They do believe that because of the pricing that they've had to increase for their products, but still that pricing is still lower than some of the premium brands. And as consumers can potentially, transition from higher priced beers to lower priced beers, they do believe that Molson Coors is going to be able to capitalize on that, not only through 2023, but potentially through 2024. So kind of an interesting upgrade that we are seeing here, especially after we saw the results from Constellation Brands a couple of days ago.
Yeah, I like that point, the conversation we had about the big drop in that stock. Molson Coors looks a little bit different here. It's not exactly great. How would you describe the technicals, Rick?
Well, kind of drifting sideways here, and looking at the price target that they put forward, right around 60 would take us to our yearly highs. So they're basically expecting a trip back up to the highs, about a 20% gain. Pretty ambitious. It's looking like kind of a tough climb up for me. We've got all three of our moving averages that we follow here. Our yellow 21-day, orange 63-day, purple 252-day exponential moving averages, all clustering together around the same point between about 51 to 52. So that could be a significant source of resistance there to overcome on it, by itself, not even factoring in that we've still got 20% upward to go here. RSI not really showing us too much here, kind of just following price action. We are tilted toward the bearish side in terms of momentum, though, so that's something else to consider, where we haven't really established an uptrend even yet. We're still within the boundaries of this downward channel here after this rally off the yearly lows faltered here. So, I mean, this area near 56 would be much closer to where I would be expecting to find some resistance or looking for perhaps a point to sell out on a long trade. But, who knows? I mean, we could be up for, a longer term uptrend if the things that they're saying come to fruition.
That would be like a first stop, basically, is what you're saying. It's like, before we start talking 60, let's maybe talk 55, where we just were last month, before we took this pretty hard U-turn that right now doesn't look like it has a lot of signs that it's going to U-turn back higher.
Not so much right now. And really, the thing that would make me the most concerned for this would be if we can get above these three moving averages that are all converging toward each other. And they're also right at the same point of this downward sloping trend line here. So we've really got four things between 51 and 52 to keep our eye on. The 49 level to the downside, roughly around where we had our previous lows. I'm just using an even number for for cleanliness on our chart here. But that would be roughly the area here. 49 would be our downward sloping trend line on the lower end, as well as those old lows.
Okay. In the past year, up a couple percent, not bad. I guess is the message, Kevin, that they can just maintain
Thank you, Johnny.
The position that they've already established because of
Thank you.
2%
I
gain
humbly
over
accept.
52 weeks. I mean, that's pretty welcome in a
She's
market
doing
where
my
even
famous
consumer
stair-step
staples,
move, so
many
I
of them
figure I
that
know
traded
this
near recent
one.
highs have come down
Once
pretty
we get
hard
above
off those
all of
highs.
those and it's green and we're doing that and
Essentially,
we're not
At
over
this particular point in time, when they're looking at this upgrade here, they are
fault
believing that
yet.
the company is going
We
to be
got a
able to gain market share.
little
And if they can gain market share,
room,
and
little
obviously have
leg
a good
room.
margin on that,
So
Oliver,
we'll see.
obviously that should increase their market cap. So that's where they are seeing the catalyst to
So
the
I
upside.
grabbed
So
that.
I don't believe that this
Let's
is
see,
actually
that's
a
been
rating change to be able to maintain the
369.
current status quo for the stock
I'm
itself.
mad.
I do believe
Let
that
me
they
go over here and
believe
see.
that they are
That's a
going to
little
be able to
change,
capture
Johnny.
that
I got a
market
little
share, be able to take
change.
it away from
I'm
Constellation
gonna see.
Brands
I'm
or
gonna
even
be. I'm gonna come out of it quickly
and things of
too,
that nature as well. So that should have a positive impact on the stock. So
because
this
I know
might
that
be
thing
a
it'll
situation where
end.
fundamentals break away from those technicals, and
So
hopefully that
yeah,
moves those prices
I
to
got
the
in. I
upside.
had a good entry too.
Let's talk Penn
I'm
here.
I'm
We've got
I
two
waited for
downgrades.
it.
Penn's the one that stands out to me. This
Yay.
morning we talked about the upgrade and the positive
So
note that's
we'll
out
see.
on MGM.
So far,
Penn's
so
gotten
good.
killed. What's up,
It's
Kevin?
a good.
Yeah, this
It was
was
a
actually
good
very
entry.
interesting as well.
I'm not gonna be here for
Penn
long.
Entertainment to hold from a
Be
buy
getting
rating
myself
and
out
put
of
a
here.
price target of $35, and that's down from $45 here. They do believe that the Las Vegas
I'm
Strip
just
momentum
watching
will
the
continue
chart.
between 2023 and 2024 at this point in time. And then
264.98.
also the
Of
market
course,
potentially
QQQ will
maybe
struggle at the
discounting
dollar mark. So if she could get
effects of
above that
Macau opening up here. And so some of those
265,
regional players in the
that would
gaming
be really
industry may
super.
actually
If
see a
she
little
could
bit
get
of a
above
cut in traffic as well as a cut in market cap as
265.
well. So that's why they are seeing
And there we
this
go. We're
slowdown.
above
Potentially the Las Vegas Strip
265.
might be able to hold up.
Oh, maybe she
even
could
if we
stay
see a little
above
bit of an economic
265.
downturn in
That
2023
cute. I
or
got
in
some of it,
2024.
Frank.
Okay.
I bought 3
Chart-wise, Rick, we're
calls.
trying to hold on to some pretty
So
low
we'll
levels here, it
see.
seems.
We'll see how far
Yeah,
she
and I didn't
goes.
really see much of a basis for that 35 level that they mentioned in the report either.
265.09.
That's this blue
Yay.
dashed line here.
We'll see.
Didn't really look like any strong
I'm
technical
gonna hang in
reasons for
there
that,
until
that
it starts to
particular level
turn.
here.
She
But
just
looking
went
at the
into
chart more
oversold
closely, we can see
territory
that
too.
ever since we hit
So
these
let me
yearly
share
lows, we
this
were
with you
trending
guys,
upward.
because I'm
Recently,
gonna
we
need to
broke
come
through
out
to
of
the
here
downside though
soon.
and started to
I mean, God
fumble
will,
a
and maybe
little bit
not.
here.
Maybe she'll just
It's
go up like
looking
this
like
all day. Maybe
the
we won't come out of this joint
2850
at all
level is
today.
a place where
But
price bottomed out
okay,
multiple
I'm
times.
just looking. I want to
Saw
make
some
sure she stays above
consolidation here,
265 and
another
above
bottoming
all of
out there,
these.
and also
The only
around
thing that
here
has
too.
me a
So
little
that
concerned
was the site where
is,
we
you know, the volume
found some
bars don't
footing
look
once
that
again there.
big,
So that's a point to watch to the
and
downside.
we're
Definitely.
over
We also
bought. And this doesn't look like the strongest trend I've ever seen in my life.
we have a
So
confluence
I
here.
will
We have
be
our
watching.
21-day
And
EMA,
on that note, y'all,
which is
I think I'm
roughly
about
in
to turn
confluence
coat.
with our
Gotta
trend
go.
line sloping
I
downward
don't
here near
know.
the 31 level.
I'm gonna see as long
So
as it
that's kind of
doesn't
the line in the sand for any potential
bounce
uptrend
off
here.
of this.
And just
You know,
beyond
as
that,
long as
we've
it
got our
bounces
orange
off of these
63-day EMA right near
SMAs.
32. So
Let me go
a
back and
couple
look at.
important
I'm gonna look
technical
at it
points to
over
watch to the
time to
upside
see
here.
if I should
2850 to the
stay
downside,
in this
31 to the
trade
upside. Pretty narrow range
or
looking
not.
for a breakout here.
So
And once again, we've got this
I'm
situation
looking
where
back.
our
I'm looking
purple
at the bigger
250
time
two-day EMA
frames
far above current
because
prices
I
here, kind
tend
of
to get
speaking
a
to
little
the
tunnel
notable
vision.
decline
So
we've
I'm
seen over
looking
the
at
past
the
year or so in price.
pulling out and looking at
From
the
again
larger
a
time
lost age
frames.
of COVID.
And on the larger time frames, it's
bubbling.
not oversold. And she is above. She's trying to stay above that 265. I think if it stays above 265, I'm gonna hold out for this trade. It's not oversold on the 15. And the trade, this trend looks strong. Let's see. I'm gonna look on the 30. Why not? I'm gonna hold for just a second. Oh, if it starts to break, I'm gonna get out of there. Because I just want to take, you know, I would like to take some profits home. Okay. That particular situation is due to higher prices as well as an increase in inventory that has really become. I'm trying to see if it bounces back up or is it coming down. That inventory out. And they do believe that this is going to be a continued challenge within 2023. But what is going to be very interesting, they do believe that the street's numbers, their estimates are overvalued at this point in time, and they are looking for cuts in the near future from other analysts, and that's what's going to also cause this catalyst to have the stock move to the downside here.
Okay. So pretty bearish note.
I'm turning coat, taking money, taking profits, y'all. Yeeks. I just wanted to make some money and get out of there. So done. I don't know if it's going to bounce or if it's going down, but I want to hang around to see. It looked like the trend was ending, so I caught that. Yes. In and out. It went from 263 up to 2. It's like $1.50. Little beach money. But look, if this thing bounces back up, I'm gonna be hot. I don't know. I'm glad. In and out, folks. In and out. I think that's the name of the game. Thank you. Thank you, Johnny. Thank you, Johnny. I think me and Frank, we're gonna be the king. We're gonna be the at the head of the base hit gang. Takes a little base hit. Adios, y'all. That was a good day. Sheeks. I'm just happy to put some more money in the kitty. Okay, let me get over here and make sure we good.
Kind of seems like this is the best looking chart of the three we looked at.
That's not saying too much, but I think I would agree. You know,
Yeah, short term at least, you got a solid short term uptrend, and then like 6 months, you got a decent little uptrend since July.
80% off the lows.
Yeah, okay. Still down 26% on the year, but hey, it's all.
And I'll cue something up in case something, maybe she keeps going. I should have left a runner, but y'all, I was just like, let me get out. Let me get out. Let me get in. Let me get out. I was happy to get that little bit. But here, this was the big move. Look, that whole move. Yeah. Let me pull y'all back in. Thank you. Thank you on the base hits. Oh my goodness. Frank, I think that's the name of the game. I really do. It's like, I think if you're waiting to get rich, it's not. This isn't that. I think the strategy, and I heard Barb say this, I like Barb, the one from TD Ameritrade, I like her. She was saying that this, base hits count. They count. Get you a couple base hits in a row. So I'll see if there's something else for the rest of the day. If not, I'm about to chill. I'm going to just relax. Just relax. And keep an eye out. If she gets above 265 and she can stay, that might be something worth discussing. But I don't know. I'm excited.
Binge watch the market with TD Ameritrade Network. The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy. Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere.
Yeah, yesterday was good. Yeah, but that was a gutsy move. I see you got in there and got out of there today too. I think sometimes you do. You have to just jump when you see it. You got to jump. Because I wasn't paying attention to this morning. But had I seen it kind of unfolding like that, that's why sometimes you guys, I do go to the one, because you can actually see the move unfolding. Whereas when you look at it on the 3, it's a little harder to see unfold. You're like, what is really happening? So, but it's not good I don't think it's good for entries and exits, but it's okay to watch. Look at this thing continuing to go. Is she going to bounce and keep going up?
Downgrade from Wells Fargo to underweight from equal weight with a price target of $400. That's down from $450. But just to put that into perspective, Ulta Beauty.
And so the bad part about that is that it'll have you jumpy. Never look at the one to decide if you're going to stay in or out of a trade, because it'll have you jumping in and out of a trade. But see, now look at this thing going to keep going.
Cost pressures will likely increase as Ulta revamps its supply chains and boosts IT investments.
I ain't going to fool with it only because of this part of this blue. I don't know. That looks, I don't know, 265.30. Oh, shoot.
Over the past year, recently hit a new all-time high, and it's only down about 0.6% on this report. I will note, though, that this Wells downgrade to to underweight is the only sell rating I see, according to Refinitiv. I'm looking at 19 buy ratings, 11 holds, and then just this one sell. So in the minority, at least at this point. And, talked about holiday sales being okay at best. A Deutsche Bank analyst recently said they're expecting solid holiday season results for Ulta. So definitely kind of a mixed picture in terms of analysts' expectations for this company. But Wells Fargo likes Lululemon instead, upgraded that to overweight, saying that it's a defensive and rare name with momentum.
I think I'm going to get one call and let it ride for the day. What do y'all think? I think she's trying to do a little runaway dance. How long can she stay up there, though?
Kind of comparable brands, I guess, in that
I think I'm gonna wait for the crash down. Because you already know QQQ will do that whole thing, go down, go up, and then she's gonna crash right down. We'll wait for the crash. We'll wait for the crash down. Maybe she'll crash down, maybe she won't. I'd rather bet on the crash down than the continuation. Let's see, 2-6. I don't know. 26545. Getting up there.
That being said, this is a stock that has seen a pretty impressive run up at this point, so could just be that this analyst thinks that it's all baked in. But other analysts are definitely more upbeat on this stock. Just taking a look at the median price target, it's 535, so currently trading at 486. Other analysts see more upside from here.
Yeah, it's definitely not phased too much. I mean, it's lagging the market today. But it's only down 0.5% on this cut from a bull. So quite a move in the last year, and it looks like it's going to take a little bit more to shake it out of that rally. Thanks, Caroline. Appreciate the details. Good stuff. Let's bring in George Till, Scott Durfee, and talk about this day so far here. We've had a lot of ups, we've had some downs. Scott, get us started here. What do we believe? I mean, I guess we're at the highs. So has the market decided?
No, the market hasn't decided, but we have some information that can help the market begin to decide better in the future. You know, as the labor numbers came out today, and also, you know, we got the numbers on the wages and stuff. You know, we're just seeing here a little bit of confusion in the market. But at the same time, we're seeing some clarity coming forth through the market as we start getting some of these stronger numbers or more solid numbers, Oliver.
We're just below 11,000 in the NASDAQ. I'm looking at my chart. It just so happens I've got a line right there, George. I'm not really sure where it goes to. Let me check. Okay. Yeah, this is basically the summer low that we bounced off for the NASDAQ. It kind of intersects the low trading range between about 10.5 and 11.5. So we've been here before, GT, but if we break down instead of up, then we'd be in a fairly new uncharted territory of lows for the past year. So how important is it for this rally to hold, GT?
Well, I think the rally today is based upon the jobs report, which was great in terms of the number. That, again, would be bearish for the overall equity space. But we're seeing deceleration in the jobs growth numbers, which again, at 223,000 is still above a long-term trend, which is actually below 200,000. So with that said,
all right, y'all,
the market is reacting, I think, to the wage numbers, which again are showing not necessarily the expected 5% year-over-year growth. For the full year was at 4.6%. I know it's not much of a difference, but ideally speaking, it's positive for the markets.
Hi, everybody.
Lower wages, higher unemployment, which again are two bad things, are going to be good for profitability. So I think today's reaction in the market is justifiably higher because of what's happening in the jobs report. But at the same time, you have to get a grip on what's happening with the economy. The economy is not in a recession. I suggest it's in a slow growth or a decelerating growth environment, because you can't make the case for a recession when the jobs market is still improving. And so until we see contraction in the jobs market or unemployment closer to 4 or even 5%, in fact, the Fed has a target of 4.6% by the end of the year, we're not going to see much in terms of contraction in the economy overall in a recession. But at the same time, we're not going to see anything change in interest rates. In other words, if market participants are looking for lower rates, we're not going to see them yet. I mean, there are some concerns out there. The yield curve is deeply inverted. If you look at the 3-month treasuries to 10-year, I think it's 90 basis points now. It's extremely inverted, deeply inverted. That suggests that prices are coming down faster than maybe the market expects. But at the same time, you know, earnings. If earnings continue to decelerate, we could see this market continue to drift lower and maybe potentially overthrow the October lows. So that could, you know, from an S&P standpoint, put that range somewhere between 3,200 to the downside, all the way up to 4,200 on the upside. Unfortunately, it's a wide range, but that's what we can get from the information that the market and the economy is giving us.
Yeah, the ISM bombing and the employment heading kind of right where you want. It's an interesting combo that seemingly is being well received as we've got bonds rallying, yields down, dollar down. However, those have not been obvious upside catalysts for stocks for the better part of a month or so. So it kind of seems, to your point, Scott, it still could go either way. But one thing does seem pretty clear is that the Fed is having a very real effect, right? I mean, the thing is that so far, a lot of people were worried it was going to be just a purely negative effect. But I don't know. You look at the employment report this morning, you kind of go, keep it coming, Jay. Do you not?
Yeah, well, exactly. You know, the labor market, a resilient labor market like we're seeing right now, it's really a double-edged sword for the Federal Reserve, right? On one side, the scarcity of workers, for example, has driven up wages, and it also threatens to prolong a bout, or the fact that we're in high inflation. And then the Fed also wants the labor market to cool off further to ease upward pressure on prices. However, the strong labor market also offers the best hope for the Fed to deter recession as it jacks up interest rates, like we've been saying, to the highest levels that we've ever seen in years. You know, and back to your point and George's point, you know, we have to go through this process in order for us to get back to at least some semblance of normalcy at some point in the future. And that's just going to take a minute. It's going to continue to take some time. We are dealing with that double-edged sword. You know, we saw James Bullard, president of the St. Louis Federal Reserve, said yesterday that the odds on a so-called soft landing, they've gone up because of a sturdy labor market. But he's recording, you know, he's obviously referring to a soft landing potentially, but, you know, not so fast, because we have that double-edged sword, and both sides of those swords can cut equally deep.
Like that description. It seems like the market has kind of had a double-edged sword as well, where we've sold off on bad data, we've sold off on good data. Now today we get one good, one bad. I don't know, maybe that's the right combo. We'll find out. Plenty of time here left still. Appreciate it, guys. George Till, Scott Durfee, nice combo and look at the macro puzzle for the Federal Reserve. Trading 360 with Nicole Petalides is up next. Join me for the closing bell later this afternoon.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange new location with access to the biggest newsmakers in Wall Street, bringing you in-depth market coverage and real-time trade ideas. Do not miss our exclusive interviews with CEOs, bell ringers, traders, and stock pickers, keeping you informed as you navigate your investments. Don't miss Trading 360 at 11 a.m. Eastern and the watch list at 2 p.m. Eastern, live from the New York Stock Exchange, only on the TD Ameritrade Network.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Good Friday morning. We are 90 minutes into the trading day. Welcome to Trading 360. I'm Nicole Petalides, live on the floor of the New York Stock Exchange. We've had a big day today. We had our monthly jobs report. Right now, markets are higher. You can see that the Dow's up over 500 points. So for the week, stocks are lower. The S&P and NASDAQ down for the fifth week in a row. The Dow down 4 and 5 weeks. Here's a look right now, though. Maybe we could change these numbers. 523 points higher for the Dow, 33,450. The S&P's up 60 points. That's 1.5% at 3868. The NASDAQ right now is at up 169 points, and the Russell is up 2%. Also, let's check out some of our futures products. The gold has its first 4-week win since August. We are seeing gold higher at $18.67 a troy ounce, gaining $27, and oil at $74.96 the barrel, up $1.30. I mean, oil had its worst week since December 9th, so we are seeing some pressure on commodities. Bitcoin at $16,840 and the dollar 104. But the dollar index has had its best week since September. So we're watching these into the close. For a look at some of the top moving stocks today, I'm joined by Jenny Horn, markets correspondent here on the TD Ameritrade Network. She's following closely the big story of Southwest Airlines, expecting now a net loss after all those cancellations last month. Jenny, it's good to see you.
You too, Nicole, and I do feel like we were just waiting for this shoe to drop to finally get a company update from Southwest because, of course, they did cancel just over 16,000 flights over the holiday season amid a systems-wide failure that could result in, like you said, hundreds of millions lost in operational costs and revenue. The company actually disclosed in a statement they're estimating now for the fourth quarter they could lose between the range of 725 to 825 million. In a statement, they said a significant portion of this impact is from a revenue loss ranging between 400 and 425 million. They did also report preliminary fourth quarter capacity. They're expecting to be down 6% versus the fourth quarter of 2019. Now, this total revenue loss could equal as much as the company made in the first 9 months of the year. So it's fairly significant, of course, for Southwest. The crisis was really a result of the fact that Southwest was underinvesting in crew scheduling processes, which failed to keep up with flight cancellations and reassigning different crew flight members. The company has already declared it's issuing about 25,000 rewards points to those that were affected. It's worth around $300 in value, but still they've apologized now numerous times. It's just a absolute PR nightmare, but now to actually get numbers to match this nightmare, Nicole, I think is what we were sort of looking for. However, not really seeing much of a reaction in the stock today or this week. Shares are still expected to close out the week up 1%. And this name has fallen about 32% from its 52-week high, but all things considered, it's fared this week quite well.
Right, very interesting. I mean, when we look at it year to date, it's up 1% after 17,000 cancellations or whatever that wild number was. Surprised, it's nowhere near that $30 low that it had, right? It's at 34. So let's talk about Costco. Some good numbers for sales.
Costco having a great day, actually pacing for one of its best days since March of 2020 after reporting their December numbers. And they said they saw for the 18 weeks that ended January 1st, net sales total just over $82 billion, which was an increase of 7.6% year over year. Same-store sales for the period did rise, while e-commerce sales, on the other hand, declined, which has been a pretty consistent theme for each of their months, really, since we've seen normalization of the retailer and the economy reopening. Now, the company's total same-store sales rose 5.5% for the month and 6.1% for the 18 weeks that ended January 1st. And we saw that e-commerce sales number decline 6.4%. So nothing major, and clearly the street is brushing that off, given the fact that they saw for December their overall sales increase about 7% to $23.8 billion. And we also saw UBS in reaction raise its price target on Costco to $600 a share from $565 with a buy rating. And of the analyst community, most do still lean into a bullish rating. An average price target goes as high as $650. So there's still a lot of optimism to be had in Costco, at least from the street.
All right. Thank you for both of those stories. Jenny Horn, good to see you, markets correspondent. Thank you. Let's get some insights on the news shaping the markets. And for that, we welcome in Jeffrey Cleveland, Principal Chief Economist, Payden and Regal. Good to see you, Jeffrey. Happy New Year to you. So
Happy New
you
Year,
said
Nicole.
this is what a soft landing could look like. We're getting the jobs. We're seeing that wage print coming down, a revision of the prior month as well. What's your reaction here?
Well, I'm a bond market economist, Nicole, as you know, and pretty much every bond person I talk to says that, the Fed is wrong to keep hiking, that the economy is going to be in a downturn soon, if it's not already in a downturn, and that's going to force the Fed to cut rates as soon as middle of the year. And, I think that is the consensus view from the bond world. But that's not what we see in this jobs report. 200,000 jobs is an excellent. We only need about 100,000 jobs per month to keep downward pressure on the unemployment rate. 200,000 plus is enough to push the unemployment rate, as you saw this morning, down to the cycle low, 3.5%. So that's not a recession, Nicole. That is much more consistent with the soft landing. And I suppose adding to the soft landing narrative is a little bit softer wage growth, because as you know, the Fed is concerned that stronger wage growth leads to more inflation pressure. So if you're having cool down in wage growth, but the unemployment rates are remaining low, that is your soft landing. So I think that's what's driving financial markets today.
Right. And, we're showing some of the other parts and components within the report. For example, the average work week and labor force participation rate. There was good news for the labor force participation rate. The average work week, 34.3. What are some of the other components within the report that you were watching closely, and what did they say to you?
Well, the economic bears have been hammering me last few months with the household survey employment growth. Household survey was negative, I believe, in March and in June, and then negative back to back in October and November. And so a lot of people were saying, hey, that's the real employment situation. Well, Nicole, this morning, I was happy to see the household survey employment piece was up 717,000 for the month of December. Yes, 717,000. So erasing much of the weakness we've seen in the last couple months. So again, if you're building your investment view that we're in a recession or about to fall into one, I don't see that in this report, Nicole. There's no evidence of that. In fact, it's quite the opposite. The labor market remains really solid and resilient here.
Yeah, tell me a little bit about other prints and other things you've been watching. For example, I saw the December ISM was less than 50. We look at the services prints that we've been getting. What are some other pieces of data that you've been watching?
We just
And that you can
watching.
share with us what your opinion
QQQ's cutting up today. Frank got in and got out and got money. I closed out.
Pessimistic or bearish. I think
Calls
the yield curve being
with a little change, and Johnny's been checking in and out. I'm not sure who else is doing what, so we're just waiting, just watching, just looking.
So I think that makes you cautious. The ISM survey data that you're pointing to, showing signs of weakness, all of that. I would say in real time,
trading chickens
as a
here.
forecaster trying to sense what's going on in the economy, I still always come back to the payroll report today, the jobs report being the best. So if you had to pick one, you have to look at that. Why is that? Well, so much of the economy is the consumer and spending. And if you have a 3.5% unemployment rate and you have pretty good nominal wage growth, you're going to have consumer spending. So that's the bottom line here.
Market Watch is looking really good.
Always reasons for caution, but this is the gold standard in real-time business cycle analysis is the payroll report. And it looks pretty good. It looks pretty solid to me through December. Yeah.
So this is what it's looking like today. So I safely say you could be in a call maybe. So we're going to see. QQQ is up 1.75, up 1.7%. Everybody's up. Costco is killing the game. So everybody's up. Even poor Tesla's trying to come up. So I think we're going to hold tight. I got one little call left. And so we'll see if it stays profitable.
Wage growth cools a little
I
bit.
don't know.
Inflation
We'll see.
cools a little bit. In that
If
scenario,
anything happens,
is the Fed
y'all will be the
cutting
first
in
to know.
2023?
Let's see, it's up
I still say no. In
455.
that
As
scenario,
long as QQQ
you're
keeps
still going to
going
have,
up.
I mean, even if we see a cool down in
262.
inflation,
I need her to stay above
Nicole, I still think you're going to
266.
see inflation
Period.
well
Just stay
above
above
the Fed's target
266.
by year end. You're going to see wage growth.
So we'll
I would
see.
say actually wage growth right now, even if it's 4.6% year on year, that's roughly double what we saw pre-COVID in terms of wage growth. So wage growth is still pretty elevated. So if you're the Fed, I still think you're going to be unsatisfied on the inflation side of things. That is going to maybe
And that's what
lead the
it's
Fed
looking
to
like on
pause
the
and go on hold
15.
for the balance of 23. But I think the bar for cutting is still very,
That was a
very
good
high.
run anyway, period. I wish I had gotten in earlier. But, I wasn't trying to be risky. So this, once it cuts through those SMAs and it goes floating, we'll take the ride. We'll take the ride.
Are some of those jolts, and there's a lot of talk about fake jobs and that there really aren't jobs. What say you?
I think the data is, it's possible that there's more job. It's easier to post a job listing now than ever before. So I hear that a lot from clients who say, oh, these are fake jobs. It's not really a job that's available. I think you can compare the JOLTS data to other measures of job openings, which are also still pretty elevated. So there's some private sector measures that you can look at, which still show pretty solid labor demand. But for me, Nicole, but where the rubber meets the road is probably on the wage growth front. So if there really is this mismatch between labor supply and labor demand, you should be seeing that in wage growth. It looks like we are in the average hourly earnings, although it slowed a little bit in December. Other measures of wage growth that we like to look at, there's the Atlanta Fed median wage growth tracker. That is showing 5 to 6% year-on-year wage growth. So we can quibble about, I guess, the job openings data, but it's going to show up in wages if there's a mismatch. And I think you are seeing that in the data.
Right. I mean, we're seeing wage growth now of 4.6. We're going basically back to the lows of August of 2021. So, and you had the revision of last month. The growth was not as aggressive as previously thought, right? It was the print was 0.6, but now it's been revised to 0.4 higher. Last but not least, just the big picture on the market, where when you look at the stock market and how, I know you're not a stock market, you talk about economy a lot, but what are you thinking here? We have the China story. We've had, right now we have every single sector higher. I have to sort of rub my eyes because I can't believe it, but because we're generally been under pressure.
Yeah, but you think about what's been looming over markets, so much commentary. It's probably the most forecasted recession ever, certainly in my career, but I think on record. Everyone expects a recession. The Economist magazine said a recession is inevitable, and then lo and behold, you get a job report like we saw today, which is completely counter to that narrative. So I think that's what's affecting markets. Now, it's possible, Nicole, it's too soon. The impact of the Fed hikes haven't played out yet. That will slow growth. The housing data is very weak. That will slow growth. So maybe we're just premature here in saying that the soft landing has been achieved. So that's something to keep in mind. But if the jobs data holds up and we see some signs of cooling that forces the Fed to go on pause, that's a positive for the equity market. That would justify a continuation of these trends that we're seeing here this morning. So we'll have to see.
All right, Jeffrey Cleveland. Yeah, we'll wait and see. Looking forward to plenty of chats in 2023. Thank you, Jeffrey Cleveland, Payton and Regal. Nice to see you. Thank you. Plenty more to come right here on Trading 360. We're watching Tesla in our 360 spotlight. We have a notable Tesla bear. Gordon Johnson will join us to discuss the stock's big sell-off we've seen recently and what his outlook is for 2023. First Solar is today's disruptor after an upgrade over at Wells Fargo. George Sills has all the details and an example trade, and we'll discuss what's next for Apple with our panel in the 360 round. But up next, the big three. 3 stocks, 3 charts, 3 trades. Ben Lichtenstein goes to the technicals. Kenny Polcari from Slate Stone Wealth takes us through the trades for Newmont Mining, Lithium Americas, and Marathon Oil. Next on Trading 360.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our portfolio management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience that pushes you to be even better. It just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Oh, yeah, I'm going to take off.
You downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set.
Choose the app that fits your investing style.
I'm Nicole Petalides, live on the floor of the New York Stock Exchange, empowering investors every single market day. Tune in to the TD Ameritrade Network. Welcome back to Trading 360. I'm Nicole Petalides, live in New York City. Thanks for being with us. Time for the big three stocks, 3 charts, 3 trades. Ben Lichtenstein will take us through the charts. Here to take us through the trades, Kenny Volcari, senior market strategist, Slate Stone Wealth. Happy New Year to you both. Haven't seen you yet this new year. And today we have all green. Every single sector is green. And Kenny, I know you're taking a look at gold, which has had first 4-week win since August. I see it's still running. Your thoughts on a name like Newmont Mining and these precious metals?
So listen, it starts with the fact that I think gold is the underlying story, right? I think gold is going to do better this year. And then with that, along with a lot of other precious metals, but with that, you have to look at some of the gold mining stocks. So Newmont is the choice that I gave you today. You see it's up better than 3%. And I didn't even know that one was right this year yesterday. So I think that's perfect, right? If you look at it on the chart, and Ben can go through it, but you see it almost mimics the gold chart, right? As gold kind of came under some pressure, Newmont and the other barracks would do the same thing. They all get the similar chart where they came down and they've kind of bottomed out there. They traded at a very tight range for 3 or 4 months, and now they're starting to lift their head. They broke up through 2 trend line, it's 50 and it's 100-day, and now it's just about to kiss the long-term 200-day average. And I think once it does, it's going to give it the energy to push up and through, following gold, which I think is going to go, I think gold's going to test 1,900, but I think it's going to be 2,100 by the end of this year.
Thank you, Johnny.
Right? You still see that upside.
Because you see, I'm deep in study. Thank you so much. I am really studying these charts, I'm telling you.
And Kenny, good to see you. Happy New Year as
So
well.
if you got some secret sauce, bring it, because I definitely need it.
We discussed the big rally we'd seen off the November lows. I think that was around 37 up to the $50 level into the end of last year. We talked about how it's a textbook example of the 2 phases of price development, exactly what we look for as traders. We have a really well-defined trend environment to the upside off the November lows, but we also have a very well-defined example here of that horizontal phase and that vertical phase. Let's begin with what we talked about into the end of December. We had an area consolidation that formed in November around 41, then at 44, 45, 47. And here you can see again the high conviction to the upside, the horizontal development where the market accepts the new area of value. And you see the transition from the 2 phases pretty well defined here. And then look what's happened since we talked about this into the end of December. This pattern is actually continued. So we talked about this, right? Continuation more likely than change. change. Look what's happening here right now, supportive of Kenny's narrative. We're in a vertical phase, out of balance to the upside, high conviction breakout to 53. We'll see if we can get some consolidation at this new upper level. That'd be coming in the form of acceptance. Let's move away from this hourly chart. I wanted to look at the daily time frame and show you what we're seeing here. Daily shows how this move we just looked at, 37 back to the $53 level, has us back to that high conviction selling we saw in the end of the summer of last year, July and into August. You can see again how we have recovered, and you can also see where this sort of puts us in terms of the bigger picture. Now, as I look at this, I just want to point out, let's get a little bit more time on this daily chart, because this move back to 55 looks where it has us, right to these lows that we saw, this area where we kind of consolidated. Hold on, let me get this so I can show you this area where we kind of consolidated around, and again, this is around 53, 55. So we're just kind of retesting that area right now. Kenny, you mentioned the 200-day moving average. Let's check in on that and see where
Thank you, Johnny. I'm going to check my email in a minute. I'm just watching this. I'm fascinated by what happens at the SMAs. Does it bounce? Does it cut through? It's just, I don't know. I must be some kind of crazy person. I just like watching it, just trying to watch the behavior. It's so much learning for me and just watching these things unfold, because it can only do one or a few things once it gets near a price level. Either it's going to react some way, and so just watching the reaction and how all of it ties together, how volume plays into it. What's the position of the RSI when it's doing what it's doing? It's just fascinating. I don't know.
Also think helps support the call in Newmont.
So thank you for anything that helps me make all of this, make it make sense, and makes it more enjoyable the more I know, and the more I can really fully participate. So thank you to the community for keeping me afloat.
That you use silver a lot of industrial uses. And if we get this global economy that starts to come back, I know everyone's calling it a recession, but not a recession. Your previous guest said he doesn't see a recession in his mind. So therefore, you're going to get you'll get all these precious metals that will participate in kind of a global rebound. So I'm bullish on that sector, and Newmont or Barrick Gold would be another way that I would play that sector.
Yeah, and Ben, before I get to the next one, Ben, quick on the dollar. I see the dollar here at 104 and change. I read this morning that the dollar index had its best week since September. Where does the dollar factor in for some of these commodities?
Well, that's what's interesting, Nicole. I actually pulled up copper while Kenny was talking about that, because copper here just recently tested the 50-day moving average, but seeing strength in these commodities comes with a decent little run-up that we've seen in the U.S. dollar. If we could just take a look here, because we actually did fall off the 114 high from the dollar down to around 103, but we're inching our way back up here. Now, coming off a little bit today, as you'd expect to see with the indices rallying back here, that dollar is weakening a little bit, but I think the dollar has been supportive of what we've seen in terms of the commodities, especially the metals.
Okay, thank you for that. Let's move on to the world of lithium. Kenny, you have your eyes on Lithium America. What are your thoughts behind that one?
So Lithium America is just that, right? They mine lithium, and lithium is used in all kinds of batteries, specifically electric vehicles. So instead of somebody trying to pick, I mean, look what's happened at Tesla. It's got absolutely destroyed, right? But instead of somebody trying to pick a particular winner in the space of electric vehicles, whether it's Ford or General Motors or Tesla or Rivian or some other, why don't you go for what all these electric vehicle car makers need, and that is lithium. And so no matter what each one of those individual companies do, they're going to there's going to be constantly this need for lithium. And if electric vehicles continue to grow at the pace that they're going to grow.
Oh, I guess I should clean my screen, huh, y'all? I think that would help.
And I suggest that they will, right? Everybody wants a cleaner world. And so we will get there. I think lithium is one of those places that you can look at in terms of
future opportunity. Now, if you look at the chart, it certainly doesn't look pretty. It's down from its most recent highs, but it appears to be getting to a level where it wants to kind of churn, or at least it feels like it wants to churn to me. And so that's why I'm starting to take a look at it. It's below all three trend lines, which I think gives it an opportunity to advance. It may hit resistance when it gets to the trend line, but there's plenty of room between now and then, right? There's about 10 or 15% to go before it gets there. And so I think that's my thesis behind why I like lithium and why I'm starting to keep my eyes on it.
Right, understood. What are you thinking about Lithium Americas, Ben?
Well, Kenny, you're right. It's not a pretty chart. I mean, for the most part, when you look at it, I noticed first and foremost the 60-minute time frame. We've seen some selling. We're talking about going all the way back to the August highs here and a bit of a triple top that formed up around the $33 level. And to begin the year, we traded all the way down to 17. So you can see on the way down a series of lower highs. You can see a high conviction trade here through the 22
All right, Johnny,
level.
see you when you
Just a bit
get
of
back.
Consolidation forming at this lower level here right now. But as I looked at the daily time frame, this is what really stood out to me. I mentioned that triple top, right? You can see that. That's pretty well defined right here. You've got three really well-defined upper extremes around that 32, 33 level. But then I also wanted to bring to your attention the fact that I noticed, well, we've got a pretty nice little triple bottom down here as well that formed. So as you can see, some support around this area that we're testing right now, 18, some resistance up around the 33 level. So pretty well-defined area to keep an eye on right now. And you can see, again, attempting this lower extreme here right now. Let's take a step away from this look here at the daily. And just check in on the 50-day. The 200-day moving average, because I wanted to show you we're below both, you can see. And then the other thing I noticed is, look, this move that we're seeing in RSI is somewhat supportive of what we're seeing. We're taking out the lows from October. We're seeing some follow through, some good momentum to the downside. Keep an eye on this one if it continues here, again taking out recent lows here. So definitely seeing some momentum to the downside, possibly trying to bottom here, but I'm going to watch this one as we have seen selling again off those August September highs.
Right. So I would, to your point, but to your point, that's exactly right. I would be watching it at the moment, but it is a name that I'm starting to look at, and because look, it's in a sector that we all agree is probably going to continue to grow, right? The electric vehicle world.
Yeah, I mean, you were watching this one last year, Kenny, weren't you? Didn't you come on and talk about this at some point?
I don't think I talked about this. Maybe I did. I don't think so.
I don't know if you did.
No,
Honestly, I remember having it in my notebook somewhere. I don't know if it was you that spoke of it. But, you know, it's definitely one to watch here. And as you guys both noted about the charts, last but not least, we move our attention to energy. As I mentioned, we've seen oil coming back this week with the worst week since December. I think oil's down about 7% this week, but it's still a great trade. Many say you still get the dividends. Marathon Oil.
Marathon Oil. So look, again, it's a commodity play, right? So today I was kind of had my head wrapped around commodities, whether they're precious metals, whether they're energy, because I'm in the camp that energy is going higher. I don't care what you say. I think there's a built-in floor here that Joe Biden has got to buy oil to replace the SPR. The Saudis and OPEC are always ready to cut production if oil falls. If it's close to 70, suddenly they run with the headline, well, we're ready to cut production in order to maintain price. And then you got the whole China story. One day it's China destruction, and then the next day, oh, China's reopened, it's going to be massive demand, which is exactly what we saw happen this week. right? We were trading at $80 in oil. Then they came up with those negative stories, traded down to 72. Saudis came out and said, well, they came with the headline that the Saudis stand ready to cut, and what did oil do? And today they're talking about China reopening, and what's oil doing, right? It's going higher again. So we're stuck in this, in my mind, the 70 kind of 90 trading range in oil. And if you look at Marathon Oil, it has pulled back as oil has pulled back. It's hugging right now down around the long-term trend line. Look, it's not a huge dividend payer. They pay about 1.4%, but they have been growing their dividend over the last 3 years by 16% a year. And the forecast is they're going to grow by 19% a year for the next 3 years, which continues to be a positive sign in my mind. They generate a lot of cash. They're reinvesting it. And since I like oil and I like the energy sector, it's another name that I think deserves a look.
Okay, Marathon Oil. What do you think, Ben?
Well, it's off the mid-November highs we saw. That was up around 33, briefly down below 25 this week. As I look at the charts here, I see a couple things. First of all, we've got a series of lower highs playing out here, right? You can see it on the way down, pretty well defined. And then as I look at this chart, not only do we see that well-defined trend environment to the downside, top left corner to bottom right corner, lower highs playing out, but I also see a series of, let me just show you a couple balance areas that are also developing here. You've got two really well-defined, 1 and 2, and we're attempting to break out, possibly forming a third in this area, but we're going to keep an eye on this. At this level here right now, 25, 26, 27, a very pivotal area. Let me show you exactly why. And in order to do that, I'm going to show you the daily time frame. You can see that the move we just looked at from 33 down to this 25 area, counter trend to what we had been seeing. We also kind of have a bit of a double top here around that 33 level, but that 33 level does provide us with a pretty well-defined upper extreme. You can see trending higher here again. So you've got areas of balance that are forming at higher levels, 1, 2, 3, the one we're in right now. And the reason I say that 25, 26 level is kind of pivotal is because it's right in the middle of the range we've been establishing basically since January, February of last year, 19 to 33. So I always say above this with energy opens up a door for a retest of the upper extreme, break down here, and well, you could test the lower extreme. Let me just give you one more chart here that I got prepared for us to take a look at, and that's the 50-day, the 200-day moving average on the daily time frame. You can see we're kind of teetering around the 200, holding below the 50-day. Here's that range that we talked about, the pivotal area we're in right now. Not much of a lean one way or the other from the RSI. It's starting to inch its way up here, but we're seeing a little bit of a price RSI divergence. Look, as we posted a new low here down to 25, you can see the RSI didn't participate. It didn't take out the lows from earlier in December. So that was a bit of a divergence that seems to be resolving to the upside here right now.
But
Yeah,
Ben, if
any
you go
final
back
thoughts? That's good.
Yeah, Ben, if you go back and look at the prior chart, you'll see you talked about lower highs. If you go back, you look at the higher lows starting in July, and then look at the point in September, and now look at the point in January. You can see that those lows are higher lows, right? So it seems to be consolidating to me, which puts us in this range. Like you said, we're hugging the 200-day moving average. It appears as if we want to push higher. And I think that if oil continues to go high, which I think it's going to, then Marathon Oil is going to follow. And I think to your point, I think it goes, 35 is the upper end where it's going to test.
Okay, a great big three today. Much appreciated. Kenny Polcari, Sleetstone Wealth, and our own Ben Lichtenstein. Thank you both very much. China and Japan and South Korea. What are you watching here when it comes?
Yeah, definitely. We saw that move to the downside, really starting in December of last year. But we are seeing a reversal today. We did see the stock down over 6%, but it is almost flat at this point in time. Now, Tesla is cutting their prices for their Model 3 and Model Y cars that are sold in China after their deliveries really slumped in December. Now, we are looking at the Model 3 prices are being reduced at around 13%, and they're now starting at $32,700. And the Model Y is being reduced by about 6%, starting now at $37,000. Now, Nicole, what's very interesting, I just looked it up. The Model Y in the US is still going for $65,990. So it's about 40% cheaper in China. So maybe you just get a container ship and maybe you can save a little bit of money here, but they are trying to do this to be able to spark a little bit of demand growth here in China because of their competitor, BYD company. They are actually selling a lot more cars than Tesla, about 28% more cars, and at a cheaper price. So they're trying to spark a little bit of demand here. We did see that stock obviously move to the downside earlier in the session, but we are seeing some buyers coming in. A technical level to look out for right now from a trading standpoint is at about $110.40. If we can break through that, you might see continued momentum to the upside.
Yeah, is there anything you would ask Kevin that you would ask Gordon Johnson? I'm about to interview him, and I feel like I've got all my notes ready. Is there anything that you want to know?
I would ask him what is a fair multiple for the stock compared to other automakers. I'm probably sure that his answer is going to be a multiple of 0. But what would be a fair multiple as we continue to try to shift through the EV market and we start seeing some of the major auto manufacturers starting to come online with their EV cars starting in 2023, especially some of the popular makers like Ford and GM.
I know he's been cutting his prices, his targets. Kevin Green, thank you. Appreciate it. We will continue our spotlight now on Tesla. Joining me, Gordon Johnson, CEO, founder, GLJ Research. Good to see you, Gordon Johnson. Thanks for being on with us. And I love when you're on with us because it really shows that we are not always touting Tesla and that we like to give the other side. Where do you know, Kevin was just saying, what are the fair value? Where do you really see the valuations of a name like Tesla, where it should be versus other automakers? Let's start with the price targets and where you stand now.
Yeah, thanks for having me. Great to see you. Happy New Year. So if you think about Tesla, right, 1.3 million cars sold in 2022. I think their closest comps are Mercedes, and BMW. Mercedes valued at about 75 billion, BMW valued at about 55 billion. Mercedes sells about 2.7 million cars a year. BMW sells about 2.5 million cars a year. Both of them have higher margins than Tesla. Both of them have great service. They've been around for decades. So if you assume Tesla is valued as such, you're talking about a $19 to $22 stock. Our price target year in 2023, $24.33. That's where we think it's headed. And there's a couple of other things we want to talk about if we have time.
Yeah, no, we have plenty to talk about. So $19 to $22 roughly. Your price target is around there. You just said just slightly higher. It's at $100. How quickly does the price go from $100 to $22?
There's no way to tell that, Nicole, but I think it's going to happen this year. Look, first let's talk fundamentals, right? You're looking at a company that is just a car company that can't sell its existing capacity.
You're talking about, and your last guest, he missed something. We missed it this morning. We corrected it. The price cuts for their Model 3 and Model Y variants in China, their highest selling, were 17% and 13%. You have to adjust for the subsidy that went away in 12/31. Massive price cuts. So think about this. Tesla, the past 3 quarters, has produced more cars than it's sold. If you look at last quarter, they worked down backlog significantly, meaning their organic orders were around 250,000 cars. That's down quarter over quarter and year over year. They went X growth. You look at China's sales in December, wholesale sales are down year over year, X growth, and their largest and only profitable market. Despite all of that, their Texas and Berlin plants are running at 20% capacity, so they can't even sell what they're currently making, yet, they're enacting all these price cuts. In Shanghai, keep in mind, the price cuts there are much worse than people think. Shanghai was only, they cut capacity by 30% in December. The first 14 days of 2023, the plant is shut down, which they have never done. 2021, 2020, they didn't shut it down in January. And all of the cars that have been produced are being exported. Despite all those facts, they're cutting prices. This is a disaster, but this is what happens when you overbuild capacity. And I want to talk about another dynamic. I want to talk about a qualitative factor if I have time.
Okay, I want to get to that, and I will not forget your qualitative factor. I just want to talk about the fact that we are in a time, we're bordering recession. We have a slowdown. So everybody's seeing slowdown. Auto sales are coming down. There are a lot of good things that happen for Tesla. For example, the factories, more factories, not only in China, but moving elsewhere. They filed for making boats, airplanes, and other things. They can increase the battery supply. They made that deal with Piedmont Lithium to have that factor. And I know there's still unpaid bills at Twitter and there's still some uncertainty, but maybe there's a little more clarity on the Twitter wildcard when it comes to Elon Musk. I mean, there are plenty of good things that are happening for Tesla, and it has been the market leader. I mean, you could just say it's a tough time just for overall for autos. It's not like any of the others are doubling their sales.
Yeah, Nicole, you've done your homework, but I think some of those things are actually negatives. Again, if you can't sell your existing production, which they haven't done 3 quarters in a row, you don't want to be adding plant, number one. Number two, with respect to batteries, all of the promises they made at Battery Days, for all intents and purposes, were lied. They didn't do anode, they didn't go to NMC. They haven't done that. In fact, the recent teardown of their 4680 battery shows it's less efficient than their prior generation battery. And with respect to their battery suppliers, it's like saying, I make widgets and I signed a deal with a tree manufacturer. Anybody can buy the same batteries from the manufacturers that Tesla buys from, Panasonic, CATL, LG. So I don't think that things look good. And I want to talk about that qualitative factor. Listen, everybody talks about Tesla's financial. I want to talk about 3 instances where we believe that Tesla has committed fraud. You're talking about the Paint It Black video that's still on their website from 2016 that says the car is driving itself. The person in the seat is only there for legal purposes. We later found out, and we now know, that video was shot over multiple hours, multiple interventions. That's just a lie. Number 2, when Elon Musk held up the solar panel to sell the Solar City deal, those panels were fake. They never said they weren't. They told people at the presentation they were real, and that's just wrong. Number 3, Elon Musk filed a 13G associated with Twitter versus when he should have filed a 13D. When you're going to be a director of a company, you're supposed to file a 13D. These are all clear, cookie cutter, in our view, black and white frauds. And if they're doing this, how do we trust their financials? Last thing I'll say, when Elon Musk sold stock December 14th, Elon Musk gets daily reports of Tesla sales. Right after he sold stock, they cut prices in the US and then they cut prices again in China. I don't know if he knew anything, but that needs to be looked into. So with all of those things happening, my question to you is, how do we trust their financial?
Okay, well, you know what? I know you, by the way, Gordon Johnson was the first one to talk about that 13G, and then it had to be changed over. You were on that one, Gordon. Glad you were able to join us. Gordon Johnson, GLJ Research. Thank you, Gordon. Coming up next, the disruptors. George Sillis is standing by, and he has all the details on First Solar. There was an upgrade over at Wells Fargo. We want to hear all the details from George, and he has an example trade for us as well. That's next on Trading 360.
Let's walk through how to analyze a company's financials on thinkorswim. To get started, go to the Analyze tab and select Fundamentals. Enter a symbol, then select Enter. To download detailed analyst reports, select Download. By the Numbers provides balance sheet information and other fundamental data. Company Details provides summary takeaways on key metrics and what drives the stock. Takes a more numeric look at similar information. If you find any of the information particularly helpful, you can print it out or take a screenshot. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
Today, 2 p.m. Eastern Time for the Watch List, live on the floor of the New York Stock Exchange with plenty of reaction to today's job report and what the Fed could do in response at the next meeting. Also take a look at some big tech stocks you can keep your eye on, and we will dive into the world space exploration and what lies ahead for space in 2023. Next on the Watch List today, 2 p.m., so make sure you join us. And welcome back to Trading 360. It's time for the disruptors, and George Sillis is taking a look at First Solar, an upgrade over at Wells Fargo to an overweight. Tell us about all the details. Hi there, George.
Hi, Nicole. Good to see you again. Well, First Solar has been on a run this entire year, and it has to do with some fiscal tailwinds. We've talked about a lot of these alternative energy plays, like Enphase is one of the examples we've covered in this particular segment. Wells Fargo sees these catalysts, which include high manufacturing tax credits associated with the Tax and Climate Bill law that was passed by Congress as part of the Inflation Reduction Act back in July. And since July, the stock's been on a run. And I think it has to do with the fact that they're getting a lot of these tax credits, which are moving the needle from a loss last year of about $1.65 for First Solar. They're expected to actually earn nearly $4 in adjusted profit for the fiscal year 2023. So with that said, the tailwinds from that those manufacturing tax credits are really offsetting some of the challenges a lot of the technology-based companies. Now we have to consider first, solar companies, their technologies. They utilize semiconductors and panel production and inverter technologies, as well as software is again, part and parcel of technology industry space. But Wells Fargo sees these catalysts that I mentioned continuing for the company going forward, at least in the near to potentially longer term, if they continue to receive these tax credits to help them achieve scalability of their economics. And their price target now has moved from 146 to 188. And this actually comes on the back of a recent upgrade from Goldman Sachs, which I believe made their target or put their target around $230 with an outperform rating on the stock.
I'm looking at that target, they are over 200 at Goldman, 146 to 188. I mean, that's pretty sizable move. I mean, they say overweight, but they really are showing their conviction here with raising the target, not $5, not $10, but going all the way up to 188. How would you go about trading this one?
Yeah. And the reason is, I'll just quickly go back for a sec here, Nicole, but one of the reasons why you see such a big move in the price targets is you actually have a company that was not making any profits last year in the last few years and now is turning a profit. So anytime you move from losses to profitability, you do see a pretty magnanimous move in a stock. Now, with that said, if you look at the stock price itself, at least if you're going back to the 3-year weekly averages, it's been trending higher. It's trending above its 21-week moving average. So we can find support right around the 142 area, which it bounced off of on a weekly basis. And it looks like it's a bull flag pattern trend continuation. So we've got the catalysts, we have the upgrades. And again, we have price action, which actually fits the bill as well. So what we can do in this case is look at buying a bull call spread in February. So what we're going to do is go out and buy an at the money 155 call option and then simultaneously sell the 160 call. Now altogether, this is going to cost us $2.50 a share or $250 a contract. So the whole objective here is for the stock to just continue its primary upward trend. As I mentioned, it's trading still above its 21-week moving average. And the objective is, again, to have the stock achieve that 160 target between now and expiration in 42 days. So we're basically betting $2.50 to make $2.50. So it's a one-to-one risk to return based trade. And again, it's a play on the trend continuation.
Okay. Thank you for all of that. George Sillis, great to see you. Happy New Year. Thank you.
You too. Likewise, Nicole, you too.
Thanks. Coming up next, thank you, George. Coming up next, 360 round. We're taking a look at Apple. It's had a recent sell-off. Now what? Is now the time to get in and buy that mega cap tech leader? Our panel will weigh in.
When traders tell us how to make Thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade. It's a 13-hour flight. That's not a weekend trip.
15 minutes to report.
I'm going to take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Thanks.
We'll see you. They're getting so smart.
Choose the app that fits your investing style.
Welcome back to Trading 360. It's time for the 360 round. Today, we must focus on Apple, a name that is in everyone's 401ks. It's in so many of the indices. And so we have pro team here, Angelo Zeno, senior equity analyst at CFRA Research, and Logan Gillen, analyst at Jewel Financial. Thank you both for being with us, and Happy New Year to you both. So, Angelo, I was just going through your notes. I saw your 165 target. You have a lot of positive notes. There were some concerns about product launches, longer extended times for the hardware replacement cycles, and maybe some regulatory scrutiny. But the big picture, you think the path is up?
Yeah, we do. I mean, ultimately we do. I mean, it's extremely difficult to be bullish right now in terms of any of these large cap tech names, right? I mean, unfavorable sentiment. Technicals are definitely unfavorable in the near term out there, and you also have to understand we're likely going to have to see estimates probably come down and reset as we go through into Q4 earnings season. So, some of that negative sentiment makes a lot of sense for us. But that being said, we've told investors to use this opportunity, this downturn as an opportunity to get more bullish for the long term in terms of Apple. I mean, we continue to believe that Apple is the best compounder in terms of all the stocks out there. They've got the best management team out there. They're the best free cash flow generator out there. We think they continue to generate free cash flow north of $100 billion a year. And when you kind of look at where the kind of the $1 trillion lost in terms of market cap here over the last year takes the stock right now, they're essentially at a $90 billion annual buyback. You're talking about 4.5% of their shares being bought back annually, plus the 0.7% dividend yield. That gets you essentially north of 5% of the cash getting returned in terms of their existing market cap. So it's extremely enticing in our view at the current levels.
Okay, and so I know you have a 165 target. It's sitting around 127 today, and the stock has dropped. You're saying this is an opportunity. It's dropped 10% in the last 1 month. Logan, what are you feeling? Because we'll have upcoming earnings too.
Yeah, I mean, Apple's got some things going against it. It has the forward PE ratio of about 18. EPS growth expected over the next 5 years is about 8 or 9%. So that's going against it. I mean, it does have an amazing cash flow. I mean, it's a cash machine, obviously, but there's some significant debt on the balance sheet as well. I think overall, though, when we're evaluating Apple and looking at it, it's a chicken and the egg situation with the market. If you are bullish on the market, which we are, then I think you're bullish on Apple. And looking at the overall outlook for 2023, I think the first quarter could be an issue based on Fed action and what they're going to come out and say. But in Q2, Q3, and moving into the end of the year, I really think that Apple could perform well and should do well if the Fed starts making the pivot that we expect. I mean, we're seeing it today in the jobs number that's coming out, that any slight data that is helpful has helped Apple and will continue to help Apple if we get that Fed pivot.
So you're not saying to wait, because you said if you're bullish on the market, you could be bullish on Apple. And when the Fed starts to really take its foot off the gas, that would be a good thing. But you're not saying wait to get into Apple, right, Logan? Are you saying maybe do some now and it's some in a little bit?
Right. Yeah, I don't think you wait here necessarily. You could do, like you're saying, do some now and kind of evaluate over the next few months. I think anytime that there's going to be a pivot in the Fed, the market's going to move significantly, and Apple just the same, and probably with a little bit of beta on it. So I think getting in now is a good opportunity, especially with the stock down so significantly. And we know that Apple's going to be a leader. I don't think our iPhones or anything are going away anytime soon.
Right. And Angelo, I think about all these tech stocks and competition. And I mean, there are plenty of people that I meet that don't have iPhones. I mean, there's still competition. The 14 was delayed. I don't know what the demand is there. And you did note the concern for the product launches and maybe they wouldn't be received with love, etc. What are some of the other big picture stories when it comes to tech or Apple that you're watching?
Yeah, I mean, listen, I think as far as Apple is concerned here, I mean, we're not necessarily, what we told investors actually back in August was, we thought the September quarter numbers were going to be good. And we actually thought that at the time that December numbers were going to be fine because of the ASP mix verse would offset a lot of concerns on the unit side of things. And then as you kind of got longer in the tooth in terms of the iPhone 14 cycle, things would get more challenging because of the macro factors out there, specifically in Europe and China. And that's what I think you kind of see as we go into the March quarter here, as you see that guide there, and even into the June quarter. I'd also note, though, as you kind of look back into 2019 with Apple, they corrected late 2018 into early 2019 by north of 40%. And subsequently, you saw 4 consecutive quarters of year-over-year declines for iPhones. And the stock just absolutely had one of its most impressive rallies ever. So essentially, the stock had essentially kind of baked in a lot of those concerns early on. And we think that's happening again here in this case. But as far as the rest of tech is concerned here, we continue to be big believers that semis are probably the area you want to be more so than any other area within tech right now. And I think we've previously highlighted that it's been the best performer since the October lows within the tech space. And a lot of that has to do because of the fact that it is more cyclical in nature. And we do think a lot of the kind of the revisions have been done here. We do see another leg down in terms of revisions in Q4. But we think most of that has kind of been complete at this point in time. And, again, they are a very profitable area of the market. And I think you'll start seeing that in the second half of the year.
Thank you both very much, Logan and Angelo. Logan Gillen of Joule Financial, Angelo Zeno, CFRA Research. Thank you both. And thanks for being with me, friends. I always love seeing you. Have a great weekend. But first, I'm going to see you later at 2 p.m. That's going to do it for us here at Trading 360. I'm Nicole Petalides. Fast Market is next.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our Active Trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcast and start learning today.
I'm Nicole Petalides coming to you live from the New York Stock Exchange every single market day from the opening to closing bells. Tune in to the TD Ameritrade Network.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Good afternoon, traders, and welcome to Fast Market. I'm Tom White. We've got a great show lineup for you today, including discussions and option strategies in Boeing, which has shot higher by about 70% over the last 3 months. And also, we're going to talk Lululemon, which was upgraded this morning. And like Folio, we'll break down consumer sentiment data on Dick's Sporting Goods, which hit a 52-week high today. Now, 2.5 hours into the trading day, stocks are sharply higher as investors assessed a jobs report that showed continued resilience in hiring, but a slowdown in wage gains that could aid the Federal Reserve in its inflation battle. Hiring exceeded estimates again in December, and the unemployment rate at 3.5% fell to the lowest levels since the 1960s. A weaker dollar and falling yields have also supported stocks. Now, let's take a look at the 4 major indices, which are all just near session highs as we speak. The S&P 500, that benchmark up 1.83%. Dow Jones Industrial Average up over 600 points. And the NASDAQ up nearly 2%. And the Russell 2000, the small caps up 2.25% to lead to the upside. To help me break down this bullish action here today, let's bring in my co-host, and that's Kevin Hanks. Kevin, you know,
holy meltdown, man.
maybe it's a couple things because if you looked at the headline numbers, jobs added was above estimates, right? That hasn't been good for the Fed.
Strong economy,
right? And then
there's the top half of the bracket.
Yeah, unemployment rate goes down,
right?
But on the other side, labor participation rate goes up.
Now that's the key measurement there, because normally when the labor force participation rate goes up, you expect unemployment maybe to tick up or stay neutral, and it goes down. That's the double positive right there.
Yeah, but then if you look, I think what everybody parsed through was the wage gains.
Yes.
Up 0.3% versus 0.4%.
The year-over-year wage gains.
Yeah, and that's maybe deflationary a little bit.
That was a shocking number on the year-over-year wage gains, down to 4.6. And not only that, not only was the number good, and I talked about Oliver Rennick with this, it was an unlikely good. It was good in almost every metric, Tom. And here's the thing, the revisions were all good too.
Right.
They revised everything better last month as well. So this is, you know what words come into play here? Soft landing.
Yeah.
If you can get, remember, now we have CPI data next Thursday. But Tom, if they get this inflation to come down while keeping jobs and unemployment low, then it's the soft landing that you're talking about. And where are the numbers? Leisure and hospitality, 67,000 jobs, healthcare, 55,000 jobs.
Yeah, I've heard that perk up a little bit since this report came out, that soft landing, and you had some commentary from Fed President Bostic this morning, also saying he still thinks that his terminal rate's going to go between 5 and 5.25%, but he's seeing some decent signs here on weakening inflation.
But every Fed member that has come out and maintained their hawkish stance, every one of them looked at this number and has softened. Maybe not verbally, but in their mind they have.
Yeah, definitely. I looked at the headline. I said, oh boy, we're going to go down today again. And then parse through some of the underlying numbers, which the market's taking a hold on. But one of the stocks that was down at basically 2-year lows today was Tesla. More price cuts overseas in China. Let's bring in Caroline Wood, senior markets correspondent, to join us. Caroline, the stock was down at those 2-year lows. Gordon Johnson was just on Nicole's show prior to this. He's a big bear on this stock, but now we're positive, so it doesn't matter, right?
I know. Speaking of bullish action, Tesla is now up 1.5% today after selling off in a big way earlier this morning. It's still obviously, of course, down in 2023, almost 10%. But yeah, quite a reversal. And speaking of inflation, one thing not inflating are prices of its EVs in China, because it's cutting prices on those EVs in China once again, this time by about 6 to 13%. Comes, of course, after deliveries fell sharply in December to 55,800 from more than 100,000 in November. Of course, Q4 global deliveries hit a record. We did see that, 405,000, but still fell short of estimates. So Tesla got punished for that as well. But going back to China, a Model 3 is now priced at about $33,000. That's a 13% price cut. That's in US dollars, of course. It's about 30% cheaper than the same car in the US, according to the website. The Model Y has been reduced by about 6% to just under 38,000 US dollars. In a post on a Chinese social media platform, a Tesla executive said the discounts were the result of engineering innovations and calls from Beijing to boost economic development. But of course, there are a lot of concerns that this is a demand problem. Of course, there are macro headwinds, but also a lot of competition. And speaking of competition, we're seeing, despite the fact that Tesla's higher, we're seeing some of its competitors, NIO off 7%, XPeng off 14%, BYD off about 2%. So a lot of weakness in the EV space today, but not for Tesla anymore. We are seeing analysts on both sides of the spectrum weigh in. You mentioned Gordon Johnson on Nicole's show. So the GLJ analyst, who's a bear, has a sell rating on the shares and a $73 price target, said Tesla's price cuts in China are much worse than you think. Points out that the bulk of those EVs are exported, but in China, Tesla's largest market, he speculates it seems new orders are close to zero. Says as such, Tesla will go down as the single greatest stock short of all time. But of course, on the other side of the spectrum is Dan Ives, who did recently lower his price target, but maintains an outperform rating. Says, I continue to strongly believe Tesla has more EV growth opportunity in front of it than behind it. Price cuts are all part of this EV cycle and a softer macro with competition increasing in China. So still bullish. Analysts are always mixed on this name, but at least right now, investors are finally giving Tesla a break. Shares up more than 1%.
Caroline, a couple things. Tesla already has pretty high margins on the cars that they sell. So if they were to discount those margins slightly, like they just did, to get more cars out the doors, which is, let's face it, the number one metric that this company is graded on is how many cars out the door. They keep working their price points lower. If the numbers go up because of giving up small amounts of margin, like I said, which they already have big, I'm not sure this is as negative. Believe me, the stock activity pre-open was negative, was harshly negative, and it looked like it wanted to go into the double digits here when the day started. But then the overall economy got better, and the news on the overall economy getting better. Caroline, are these small drops in margins, right, because of the prices? Isn't it better to get more cars out the door?
Well, you could definitely look at it from that perspective. Obviously, people are going to be paying very close attention to Tesla's earnings report later this month to really see what these numbers and what the guidance looks like. I did see an analyst over at New Street say that his analysis shows that Tesla can afford to lower its average selling price by about 8% without denting margins. He points out that the ramp in Berlin and Austin will improve unit costs. He says at the end, shipping from China to Europe will improve supply and input costs. Also talking about how here in the US, Tesla will benefit from those EV subsidies. So doesn't seem to be as concerned about margins on that front, and does think that the price reduction then can help the company increase its total addressable market by 50%. So, it could get people who maybe were on the sidelines thinking, oh, maybe they're a bit too expensive to actually buy. I think it would be pretty disappointing if you just bought one and they went on sale, but that's kind of the way it goes. But, that might be why we're seeing a pop in shares today, because it might mean sales actually increase and margins might not be as dented. And as you said, they're typically pretty high as is. But Tesla reports on January 25th. So safe to say we'll be talking about Tesla a lot between now and then, but we'll really be looking with an eagle eye at those figures.
Yeah, definitely going to be discussing that. And I think Tesla shareholders should be thanking the overall market right now, because I think that's true. That's the only reason this stock is up on today's data and news. All right, thanks to Caroline Woods.
Maybe selling fatigue. Come on. I mean, Tesla off what? 69% over the past year.
Yeah, cutting prices, though. That's never a good thing. All right, Caroline Woods, senior markets correspondent here, breaking down the Tesla news. But now let's bring in Joe Mazzola, Director of Trading and Education at Charles Schwab, to join us. Joe, what was your takeaway from this jobs report? And then we also got a weaker services number. ISM services fell into negative contractionary territory for the first time since May of 2020.
I think you hit the nail on the head when you talked about the slowing wage growth and the labor force participation rate. I think those are the two key takeaways. And, did the market digest that and say smooth sailing ahead and that, a soft landing is in the cards? I don't know. I also look at this market as kind of range bound as well, too. I look at it, the market's pulled back to 3,800. It's held it again. You're seeing some bottoming forming, and you're seeing a little bit of support down there. You're seeing some divergence in terms of positive divergence in terms of the RSI. So, you're seeing a market that is digesting the data. But, Tom, you mentioned this. I don't necessarily look at the economic data, especially the ISM data, and say that that's the showing of a strong economy. I look at an economy that's slowing dramatically. You're starting to see contraction, as you mentioned, for the first time in a couple of years in the service data. And remember, it's the service data right now that's providing the majority of the inflation, right? That goods inflation is already kind of in the rearview mirror. And I think the Fed is going to be turning their attention this year away from inflation and more towards, away from goods and services inflation and more towards the wage inflation, controlling the labor force wage increases, doing what they can to manage that, while at the same time recognizing that the economy is probably heading in towards a soft patch. And we're going to find out a lot more in terms of the next couple of weeks once earnings start. Let's not forget about that. Earnings are basically kicking off next week. And I think that's going to be really what the market's going to be shifting to.
Yeah. And Joe, real quick here, the caveat here and the case for maybe a soft landing. When you look at the unemployment rate at 3.5%, some of those inflationary pressures going down, is that the caveat that we haven't talked enough about, is the fact that, hey, even if the unemployment rate ticks up to 4%, 4.2%, that's still at historical low levels at this point. So maybe that soft landing could be in the cards?
Still 1 million jobs, though, Tommy. I mean, think about that. That's still 1 million jobs. And when you look at what's happening, in terms of the tech sector. We are now, 150,000 job cut announcements within the last, 6 weeks or so. It's going to make its way into the system. I think what's been healthy for employment is that a lot of those people have been able to find other jobs. But there's another key takeaway too from that report we haven't talked about, and that's hours worked. Hours worked are going down. Right. That means that what are companies doing? Companies are finding different ways to kind of cut costs a little bit on employment without having to let people go, because of the fact that it was so hard for them to initially find these workers. So they're finding different creative ways to kind of lower those costs. It's starting in the tech sector now. It's already started. More than likely going to make its way into other sectors as well too. It's just, I think, where that cross current is occurring is it's difficult for them to find the labor that they need to fill those positions.
Yeah, definitely. And Joe mentioned, Kev, earnings season starts next week with the big banks and financials next Friday. Think about this, Kev. We've gotten 4 downgrades out of major banks here in the last week. JP Morgan and Bank of America today. Is that a warning sign for the economy? Because those are the same CEOs that are predicting a recession and are saying that the economy is going to weaken more than the market's actually pricing in.
Remember, one thing during this environment that the banks and financials have been able to lean on is net interest income.
Right.
And with rates, yields peaking, right, that isn't going to appreciate more. It may level off. Right. It may stay consistent, and rates may stay longer for a while. But if that starts, you need the other parts of these banks to start picking up some of the slack, because net interest income that has buoyed them for a while is probably going to plateau here.
Yeah, investment banking, they took a big hit last quarter.
Trading will have to pick up again if volatility starts to come down.
Yeah, and Joe, to that point, when you look at the earnings, and I don't think the market's fully priced in a lot of the revisions that are coming down the pipeline. What's your outlook here for earnings season? Is that going to be the next shoe to drop, where that those levels that a lot of economists and analysts are picking down to 3,200 or 3,000, the S&P 500 might be there?
Yeah, I mean, look, that's a real risk. I don't think we've seen the revisions yet. I mean, look, the companies are telling us, get ready for this. They have, and we just haven't seen the analysts really kind of price that in. We're starting to see it more and more. But I think the big difference is when they go back and look at what happened in 21 and 22, they were lowballing all that. And so they're trying to get a little bit more in line. They'll get a little bit more data next week. But when you have bank CEOs who really do have some insights into what's going on with the overall economy, they see what's happening with business loans, they see what's happening with consumer loans. The cost of borrowing is so much higher now that you look at sectors like housing, which have basically come at a standstill. And these are big sources of revenue for a lot of these banks. Wells Fargo in particular, because of their lending and their mortgage business. These are companies that are going to have to find different ways to produce this revenue. You mentioned trading, you mentioned investment banking. Those have kind of slowed down a little bit. And so we're going to get a better gauge within the next couple of weeks of what's happening with the overall economy. And I do think, more and more of these downward revisions are going to occur.
Yeah. Kev, you got
You'll know what the banks think about the overall economy, Tom, when you look at loan loss provisions. If those go up, their view of the economy is getting poorer.
Yeah, that's right. And those went up pretty significantly last quarter, even though
that's what to watch in the banks.
Their balance sheets, they've been shoring those up since the financial crisis. They're at some of the best levels that they've ever been at. So that will be a key point. A good one there, Kev. But coming up after break, we're going to take a quick one here. We're going to discuss Boeing, which has flown higher by over 70% since the beginning of October. This one, some news out on the defense side of this business also that was just released. Fast Markets coming right back.
Let's walk through charts, one of the most commonly used features on thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select time frame to adjust time intervals or to favorite a time frame. Select style to change the appearance of the chart. You can add drawings by selecting drawings, drawing tools, and then type of drawing. For symbol comparisons, select Studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
When traders tell us how to make Thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade. It's a 13-hour flight. That's not a weekend trip.
15 minutes away. Wow, take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Thanks.
We'll see you. They're getting so smart.
Choose the app that fits your investing style.
Welcome back to Fast Market here on the TD Ameritrade Network. Stocks just off all session highs here today as we're seeing a broad-based risk-on rally. But let's bring in George Tillis, senior markets correspondent here on the network, to help us break down Boeing, another stock. And I picked this one today, George, just because the parabolic move that we've seen over the last 3 months. It seems like 2020, 2021 was all bad news for Boeing. Kind of plateaued a little bit in 2022, but now we've seen this massive rally. What's behind it?
Well, it's a good question, Tom. There are a lot of things behind it that we have to go back about 5 years to kind of get a gauge of what's been happening with the company. I mean, first off, sales are down to about $60 billion in 2022 from 2018, where it was around $100 billion. So we know that there's been idiosyncratic or company-specific risks associated with the 787 program, which really put a damper on sales for all their jets. But now we're starting to see things really turn around for the company. I mean, if you consider the nice move we've had since October, the October quarter when they reported on the 28th was really bad. They actually took an impairment loss of about $3.3 billion to their aircraft fueling program. And since October, we know, as you noted, the stock has been on a tear. It's almost doubled. It was trading around $115 back in the early part of October, and it just continued to the upside. So I think the catalysts right now are a few things. One, in early October, you can see the dollar peak, and we know that Boeing is a multinational corporation, so that's helped. The second thing is if you consider the aspects of deliveries. The delivery numbers, if you look at Q2, were around 122 jets. In Q4, they denoted 151. And that's an improvement relative to the previous couple of quarters, but also an improvement over year basis. And then if you look at the financial metrics, they're also improving. Now, we talk about this with all of our and overlooked stocks for companies that are starting to move before they're profitable on a consistent basis. You look for free cash flow. Boeing has about $2 billion in free cash flow, full year free cash flow. That's the first time since 2018, and that's again in 2022 full year free cash flow. They're expecting to continue a full year free cash flow number between $3 and $5 billion for 2023, forgive me. But at the same time, what's another interesting factoid is they're also expecting consistent profitability, and I think this is very important for the entire fiscal year of 2023. And that hasn't happened since 2018. And so this may be justifiable move for the stock because of the financial fundamentals, which are improving, not to mention the 4,500 or so jet backlog, including recent monumental orders from an airline, United Airlines, of 100 jets with 100 option going forward into 2028. But also you have to think about the international sales. Air India is put in an order for about 220 jets as well. So their backlog is improving, financials are improving, dollar weakness, and you can all see these catalysts pushing forward. The last thing, I know I said the last thing, but it's a Dow component. And so we know the Dow has been preferred right now, especially the industrial space, and maybe there's another reason the stock is higher as well.
Yeah, definitely. Commercial airlines. And then you also forget the defense side of their business. You also forget the global services side of their business. They've got some different pipelines, but working through that and just parabolic move to the upside. All right. Thanks to George Tillis, senior markets correspondent here, breaking down Boeing for us. But now let's bring back Joe Mazzola. Joe, your take on this one. When I look at a stock move the way that it has, yes, it's had good news on the stock. The United Airlines big order, Air India's order. But at the same time, when I see moves like this in big names, let's start getting scared a little bit. Like, hey, maybe too far, too fast. And Boeing's notorious for doing that.
That's the trader in us, Tommy. I mean, we look at it and we say, what's the other side of that trade? I mean, look. Expectations for next year's fiscal earnings are not exceedingly high by any means, right? I mean, we're looking at 35 cents in terms of EPS. That's up 100% from year over year. For next quarter's earnings. But yet we're trading at about a 75 forward PE. So what are we looking at here? We're looking at a lot of that bearish sentiment, that we saw back in October. A lot of that has already dissolved, and just, this move has already taken into consideration, at least in my mind, some of that new order activity that George was mentioning. Free cash flow. That's always been one reason that you look at Boeing and you look at companies within this sector. Now, $2 billion in cash generated. That's fantastic for 22. 3 to 5 billion in 23 is expected, and then 10 billion in 25 to 26. Here's the difference with this market and then markets we've seen in the past. So, George, going back to 2018, we are in a market now where we are looking at what we consider short duration. People you're looking at a market where investors are having a harder and harder time justifying paying for cash flows that are out 3 years as opposed to cash flows that are current. Why? Because the valuations are demanding that. And when you look at, what you're seeing in Boeing, it's trading well above its peers in terms of price to cash flow, well above its peers in terms of price to earnings, and even in PEG ratio in terms of where you take into expected growth over the next 3 to 5 years. Doesn't mean by any means that it's a bad stock. It just means that it might have gone a little too far too quickly. And as you talked about, it's been soaring. When you get a move this quickly, sometimes I think it just makes sense to say, let it breathe a little bit and see what happens and see if this comes back down a little bit, especially knowing that we've got earnings on the 25th, and how can we set that up? So that's kind of what my trade is looking at. Is it's not necessarily saying there's anything wrong with this move. It's just that the move has occurred so quickly and priced in, these valuations that maybe letting the stock breathe a little bit, seeing what happens, seeing if it comes back down to earth a little bit makes sense. So what we're looking at in this example is what we call a put calendar. It's the 200 strike. We're looking at the Jan 13s, which those expire next week, versus the Jan 27s, which, by the way, will take into consideration that earnings event on the 25th. So you actually are long at the earnings fall. It's not looking for a huge move by any means. We're trading around 210 or so, so it's only about a couple percent move to the downside. But when I look at some of the factors from a technical standpoint, RSI 75, that's traditionally what we might consider a little bit overbought. A little bit of a pullback, maybe back towards that 200 level could be in order.
Yeah, definitely. Let's break this example trade down. Buying the Jan 27th weekly 200 strike put out of the money by about $10 to the downside. And that's got about 3 weeks until expiration. It does capture that earnings event, Kev. So you've got some higher implied volatility, which should or potentially remain firm into those results. And then selling next week's January 13th weekly 200 put. So it's basically a 2-week wide put calendar. You're paying roughly about a 310 debit for that, Kev. That's going to be your risk on it. Break even's about 192.5 and all the way up to 208.60, so just below the current share price. So this is taking advantage of a grind lower. Your thoughts here on this trade and Boeing?
2-week calendar spread, what Joe talked about with the RSI any trader looking at an RSI of 75, it's going to chip away at your confidence directionally, right? You look at that and like, well, look at the chart and look at the overbought area, and everyone. Does it mean it's going down? No, it doesn't at all. You know, RSI can be a frustrating number. It can stay up there for a long time, but you can't ignore that number and the chart on this name. And by the way, I listened to an interview with their CEO, and I don't know if he slipped. I don't know what he said, but he ended the conversation with, this is going to be a tough year, and then we should be clear going forward. And that, all I heard was, this is going to be a tough year. So even I have paused, and I've been trading Boeing for quite a while, as you know.
Yeah, and Joe, I like this, the idea of a calendar in a low volatility environment. You know, you mentioned that you're buying that earnings event series in that January 27th. But at the same time, Joe, when you look at this, maybe the implied volatility being at or near 52-week lows in there going into this, it's not a bad idea. And then if the stock does pull back, maybe implied volatility goes higher also, which also expands the price of this calendar.
Yeah, no, I agree. And the hard thing was, I was looking at that 220 to 225 range as kind of some resistance on the stock. And selling vertical spreads when vol is this low, it's hard to get a lot of bang for your buck, right? So owning that implied volatility by using some type of a time spread, it tends to improve your odds a little bit because you're owning that vol, which tends to expand as you head towards that event, that earnings event. That's the way I set this up.
Yeah, speaking my language, improves your probabilities.
Most bang for your buck. I mean, remember, it's once you have the idea of what the direction on the stock is, you've got to get the right strategy. Right. And what Joe basically said is with vol this low, the short call vertical is a strategy that may work, but the risk reward, you have to get paid for your risk.
Right. Yeah. And this is low cost entry point. What you pay is your risk. You do have some assignment risk on that short 200 strike put. You do have the ability to roll that, also creating credit. Right now, guys, the at the money put roll on the 210 strike, $3.40. So with just one roll, you could potentially pay for that entire calendar spread that's 2 weeks wide. If the market's open, liquidity is provided. All right, great stuff. As always, Joe, appreciate it. It's Joe Mazzola, Director of Trading and Education at Charles Schwab, joining us, breaking down markets and Boeing. But coming up after the break, Andy Swan from Lightfolio is going to join us to discuss Dick's Sporting Goods, which hit a
overall. Dick's performing pretty well. The company guided, that same store sales may slip a little bit, 1.5 to 3% down. And we're actually seeing that play out almost exactly in Lightfolio consumer demand data. We're seeing consumer demand for Dick's Sporting Goods down 3% year over year. So really very much in line with what the company expected. The cool thing about this, though, for Dick's is that this is significantly better than the drops that we're seeing in some competitors like Hibbett's and Foot Locker. which are seeing much more dramatic year-over-year declines. And so I think that expectations are for a slight decline. That's what we think DICK'S is going to continue to come in at. The one thing that's giving us a little bit of concern when it comes to DICK'S Sporting Goods is that consumers are expressing some frustration with the online shopping experience, the e-commerce shopping experience, not living up to expectations at DICK'S. And on a positive note, I think that what's really giving this entire sector a nice buoyancy, especially as we go into a potential recession, is that there's a real resurgence in youth sports, especially spring and summer sports. We're seeing that that across the board, across all kinds of youth sports. I think what happened during the pandemic is, there's a lot of buildup and there's a lot of appreciation that built up for these activities for young people, and people aren't taking that for granted anymore. And they're willing to spend the money to make those experiences great and to make sure little Johnny gets out there in his equipment. And DICK'S Sporting Goods is a prime recipient of that. So I think that the long-term view for DICK'S is very strong because they're in a really nice tailwind situation with youth sports really pushing them forward as we head into the spring and summer of 2023. I expect that will continue and accelerate.
Yeah, Andy, I got caught in a DICK'S Sporting Goods about 2 miles from my house over Christmas. The lines were insane around Christmas. So I think it did real well on the Nike news, a nice surprise out of Nike when their earnings came out. I think it was on the 21st of December. This chart is really impressive, especially in a bumpy market like we've been, Andy. But if we hit a recession, if, like the bank CEOs have been saying, if the consumer is weakening, is it going to touch this stock? Because this has a pretty good environment already baked in, Andy. But you're right that, if it's the least bad in a bad sector, I don't know if that gives me a lot of confidence to buy it here, especially when it's breaking all-time highs.
Yeah, it's the least bad in a bad sector. Well, it's the least bad, I would say, actually, in a decent sector. And in a decent sector is pretty good considering all the sectors. So that's kind of where we're at right now. I think the one thing that we're seeing just quantitatively and qualitatively is that, whether or not, the wallet gets a little tight or people start to have to pinch some pennies because of inflation or, some recessionary pressures, they still spend money on their kids' activities and sports. And that's a big driver of what's driving the growth at DICK'S Sporting Goods. And I think will continue. So I like when I see kind of recession-proof tailwinds as the primary driver of growth for a company. And that's the case with DICK'S.
Yeah, and we mentioned that their last earnings report in November was pretty solid here, Andy, and you've got the seasonality chart up there where it typically dips in the winter months and then picks back up as spring baseball kind of hits and some of the other sports. But Andy, you guys talk about happiness quite a bit in a lot of your data, and that matters a lot, right?
Yep.
What people are saying about these brand names. DICK'S Sporting Goods has lost a lot of competitors across the board, and e-commerce sales. Maybe they're waning a little bit, but when you look at foot traffic, Kevin mentioned his DICK'S Sporting Goods by his house being full. Is the happiness level still there for a name like DICK'S Sporting Goods?
Yeah, it's starting to slip, and that's one thing that gives me a little bit of pause about DICK'S, especially with the stock so close to all-time highs. We are starting to see a consumer happiness slip. Now, whether that's just a dip or a trend that accelerates into what's really going to matter for this company is that consumer sentiment as we head into those spring and summer months that drive so much of this company's foot traffic, web traffic, and revenue. So it's wait and see, but for right now, there is reason for a little bit of concern that they're not doing a great job of making all of those new customers completely happy when they walk into the store or log in online.
Now, here's a real quick question for you here, Andy, before we wrap this up. When you look at, I've been seeing a lot of retailers, a lot of brand names being downgraded recently, although Lululemon did get an upgrade today. Are we seeing that where maybe that inflationary pressure and that exhaustion, wages were, on the low end today during the jobs number, where people just might kind of just push away from spending altogether and all, stocks get taken down in that area? Because I've seen a lot of downgrades, price target cuts in the apparel and the retail and the brand space lately.
Yeah, I see good diversification though. If you walk through a Dick's, there's a lot of different ways that people can spend money. You can buy, there may not be as many people buying golf clubs, but there may be more buying football pads or baseball bats or athletic wear or shoes for their own workouts. So I think Dick's has a nice, it is a niche in some regards, but in others, they have a nice diversification of potential revenue streams. And I think that they will continue to benefit from this massive resurgence in youth sports. I wouldn't bet against them. I do think that this is a stock we look for more on dips than at current prices.
Yeah, if you had an earnings score now, we've got earnings about a month and a half. What would it be?
Completely neutral. We think the stock is pretty much priced right at this point.
Right, at 52-week highs. Good assessment there. Appreciate it, Andy. Have a great weekend.
You too. Thanks.
All right, that's Andy Swan, co-founder of Likefolio, breaking down more good data from Likefolio once again here, Kev. The stuff that they give us on happiness levels, consumer sentiment numbers, as far as these stocks is pretty valuable stuff. Now, how do you want to look at this from a potential example trade?
March 7th is the earnings date on Dick's Sporting Goods. A lot of the talk, if you look at the chart on Dick's Sporting Goods, you see the move up, but you also see the volatility low. Much really like low. We were talking about in Boeing with Joe Mazzola, you have to pay attention to where the volatility levels are. Why? I'll show you, right? If I tried to do a 2-week call vertical, right? I've got the 3-week call vertical up now. Watch, Tom. If I move this to a January 17th, if I go to the January 20th, right? Look at how much we get on a $5 call vertical that's not that far out of the money, only 77 cents. Why? Volatility is low, Tom.
Right.
So you got to do one of two things. You either got to not do it, right? Because that's not a good risk reward, or you got to move your date out further. That's why I went out to the January 27th to sell any type of a call vertical that gives me over $1. Now, but that brings in the expected move. But the 2-week, same dates as Joe Mazzola in Boeing, Jan 27th, Jan 13th, put vertical around 120.
Put calendar.
Put calendar, sorry.
Yeah.
Put calendar around 120, trading for 145. Now, that seems much more of an affordable trade. Doesn't mean it's going to work. You still need it to move towards 120.
Yeah.
But the call vertical combined will cost you about 45 cents. Both might make money. Both might lose money. But remember, if you're trading implied volatility, it's low, and the call vertical is a sell of volatility.
Yeah. So let's break down that call vertical first. Going out to January 27th, the weekly series, that's 21 days till expiration, selling the 135 strike call, buying the 140, short $5 wide, neutral to bearish call vertical. You're collecting roughly just over $1 credit, so you've got nearly $400 in risk on just that vertical spread on that one. Your break even on that one, 136 basically to the upside on that. Now let's look at the call or the put calendar on this one. Kevin, and you got some assignment risk on that short 135 into expiration over the next 21 days. Keep that in mind, but that's a neutral to bearish trade. Now let's look at the other bearish trade, but with a range, buying the January 27th, the weekly 120 put, selling the January 13th weekly 120 put, paying about $1.45 debit on it. That's going to be your risk on that one, $145 per spread. But your break evens on that one, Kev, about 113 on the downside and about 128 on the upside. So you still have a range while you want it to go towards 120, which would mean both trades would be profitable on that type of example. But you do have some assignment risk on that short 120 put. But this is playing for maybe a consolidation, maybe a grind lower on this. Now, if you combine them, Kev.
Short delta, long Vega on the calendar spread. If you combine the two, But you've chipped away at your long Vega because the short call vertically short Vega, and you've basically doubled your delta.
Yeah, and your break evens on this, if you combine both of these positions, would be about 128.30 to the upside and about 107.80 on the downside. So, or just under 108. So you've got a wide range in there, but what these strategies take advantage of, the short call vertical takes advantage of a higher implied volatility where you don't think it's going to grind up that much more, but you got a cushion to the upside. And then the put calendar, which is partly financed by that short call vertical, takes advantage of a grind lower in that over the next 3 weeks on those two trades. But a good look at two different trades. You can do one or the other. You can combine them both. If you're more bullish, maybe you do a call calendar and sell a put vertical. So there's different ways to do these strategies based on what your assumption is. All right, Kev, coming up after the break, we're going to take a look at moves in Lululemon, which was upgraded this morning. Fast Market's coming right back after this short break.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcast.
It's quiet today. How are you? I was wondering where you were this morning.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience with innovation that lets you customize interfaces.
So I'm still watching QQQ. Frank bought puts or calls this morning. He made money. He got out. Johnny went off. He said he'd be back. I'm not sure what he did. And I'm not sure what Miss Vice did today. And I got out on a call or put. I cannot remember. So everybody made a little bit of money. Un poquito dinero today. I'm so glad you made it. Let me peek over here and see. QQQ shot up this morning, so I'm expecting it to maybe do that little parabola thing that it does, where it goes all the way up and then goes all the way back down in the exact same way. So I'm just watching to see what it's going to do after this. I don't know. Is it going to continue on? Or is it going to try to meet this 50-day moving average and then just head on down? So that's what I'm hoping for, because I'd like to see a nice put play for this afternoon. And that's it. That's all I'm doing is sitting here watching. Oh, I was going to ask if you and Elle wanted me to show you how to do or how to place an order. Since it was so quiet, it had been quiet for whatever this resting period was. So maybe immediately after the bell, I can just show you guys how to place an order. And then that way you don't have to wait. And we can do it together and do it slowly. It's so good to be flexible. You have the flexibility to do that. Okay, let me see what she's doing. 2, 6, 6, 4, 5. Yeah. Yep. Okay, so that's all we're going to be doing. Who is supposed to be coming back? Frank will probably poke his head in. I think everybody's just watching to see. There's some announcements or something that are going to be made. So everybody's trying to see if the news is going to impact price.
Equities at this point, Ben, has been that dollar. We hit a 1 month high.
So I think that's what
earlier
they're
on in the
talking about
session.
now.
It's cratered along with yields.
Yeah, Tom, the dollar's been a big mover this week, to say the least.
And I'm looking
I
for
noticed,
QQQ to
a move
come
in the
on
dollar.
down.
Recently, it was
If it gets under
last week's low, we saw it down around
266, maybe,
103.14.
just maybe,
This
that'll
week, we traded all the way
signify
up to 105.50,
she's
and
gonna
then we've
come
come
down,
back
but
off
we'll
here
see.
now down to 103.80, and you can see down about a 1% move lower here today, but still holding up above that low from last week. So let's keep an eye on that. If we see some continuation in terms of the weakness in the U.S. dollar, if stocks continue to rally, if the yen and some of the other foreign currencies that have really started to firm up as of recent continue, that's definitely going to be a product to watch next week. In terms of the U.S. dollar, I noticed looks like we're going to end up
Microsoft
here
and Google
higher
are
only
red
3
now.
times of the last 12 weeks. If you look at the weekly candles here off that high, up around mid 114 handle mid-October, Tom, we've come off with conviction, to say the least. That's, again, a reflection of what we've seen in terms of rates.
Definitely, helping, support that risk on theme that we're seeing today. All right, great stuff. Ben Lichtenstein, host of the Future Show here on the network. All right, Kev, let's get into a discussion. Lululemon having a great day today. Stock was
Good
down
for
about 18%
Lululemon. That's because everybody was at home in their yoga
I looked
pants.
at the earnings that
So
they had.
Lululemon is
And that
up.
was at the beginning of December.
And shout out to
The
my
inventory
friend
rise that they saw.
Latifa.
Ugh, I mean, it was bad.
She
Stock
works
sold
with
off
Lululemon.
significantly on
She's
that
a
earnings
yoga
event.
Rallied a
instructor.
bit on Nike's earnings.
Empower
a
Fit
little
Chick.
bit
I believe
better
that's
news
her
there,
Instagram.
but,
Let me find out.
this is still a
I'm
company
pretty sure that's it.
that has remained
So shout
sticky
outs.
in terms of
Look
its
at
ability to
Lululemon.
keep customers coming in. They are a premium brand that is still highly coveted, and it's popular with women.
She's Empower
It's getting
Fit
more and more
Chick.
popular with men.
Shout out
So there's a lot
Latifa.
going on here, and the
She's
growth
a
that is
world-class
slowing
yoga
in the US
instructor.
is picking up in Asia and Europe, Tom.
Yeah, and that's probably going to be a headwind
Okie doke.
overseas, right?
We'll
Shouldn't
be
it be
here.
for Lululemon? At
Marilyn,
least
you
for
know
at
I'm
least
not
a
going
couple quarters.
anywhere.
China
I'm just
basically shut
watching.
down.
I'm
Nobody's shopping
looking
there.
for
And then
her
Europe,
to make a move
they're in a recession right now,
under
most likely.
You have to
266
think that any
or
recession
definitely hit
will dampen
cross under
some of the
this
demand. But
50 day.
Lululemon has been pretty resilient
We'll see.
against
We'll
soft
see.
and
I don't
strong
know.
economies,
I
but
don't
the
know what
stock
to
moves, Tom.
expect.
Yeah.
This is a big
So
mover.
let me go check all of these time
trading at
frames.
these levels.
That might give me some
It's rallied,
insight.
almost filled that gap from the downturn that we saw after that earnings event. But their inventory rose 85% in Q3, and I think that was why. We saw those inventory
she's
shots
just
at Target
resting.
and Walmart and some of the other retailers finally hit Lululemon, but they've got the margins to support their valuations, and that's what a lot of people why they like the stock, because of those margins. But I wanted to look at an example trade here.
Resting.
A lot of people go, well, like the stock popped today, now I can't get into it. How do I play this in a name that maybe I was looking to buy, but maybe I was looking to buy it lower, or at least do something bullish. So I wanted to look at a strategy that takes advantage of that, Kev. So we went out to the February 3rd weekly series.
I have a single
about
call
1 month until
just in
expiration,
case
28
she
days.
decides to
And I just sold it out of the money put
regroup
vertical to take advantage of a
and bounce
neutral to
off of
bullish
these
stance. If you think, hey, I missed the move, but I
SMAs and
still
go
want to
even
get
higher.
pulled up in this, or I want to take a bullish position over the next month. Selling the 320 strike put.
So I think I'm
buying
poised.
the 310
If she goes
strike
up, if
put.
she goes
It's
down.
$10
That's
wide.
the wonderful thing,
You're
I guess,
roughly
about options.
collecting about a
Is that you can
$3
make
credit
money
on this one.
if the
Kev, your
market goes
thoughts on
up
it?
or
Short
if the
put
market
vertical
goes
that
down.
gives you a cushion to the
So let me
downside.
turn that
A
down.
4-week short put vertical that gives you about
So that's
9 deltas on this trade, collecting about $2 in theta. That'll pick up as you get closer to expiration. But yeah, this is an out of the money, high probability short put vertical that the most you can make is what you collect, but you're collecting $3.30. Why? Because you moved your duration out. And this is not a small premium name, Tom. The premiums in these
She wants
options
to come
pretty
down, I'm
chunky.
telling you.
That's made
Look
for
at the
selling.
RSI
Now,
pointing down.
your risk below about
And no volume at all.
317,
She's tired.
316.70, something right
She's
around there.
exhausted.
So there's your risk. If you don't like that break even,
She ran a good race.
Yeah, and that's a good point, because the break even.
Now we
if you're
need you to
collecting
just come
330,
on
as you mentioned,
down.
threes,
Let's see.
316.70 on that. The
Yeah.
probability of finishing out of the money just for that break even is about 60%. Now, when you look at those,
a little more aggressive.
Yeah, a little bit more aggressive, but it did get the upgrade today. You've got a month in it, so you've got some time. You've got some
Buyers are
on that
fighting
short option
today.
there going in to expiration also over the next 28 days. So you have to keep that in mind. But this is what you can only make
6,
what you collect on a
22.
short vertical, whether it's a put or a call, Kev.
But you don't need movement. There's always a trade-off, right? And you don't need movement to be profitable.
Right, and I think that's a good key to point out. When you're selling out of the money verticals like this, you can potentially profit in 3 out of 4 scenarios.
It's always the trade-off, right? That options is always dealing with trade-offs, and the trade-off here is selling a put vertical out of the money. You don't need movement to be profitable. If it stays right here, you're 100% profitable.
Yeah.
So, or until you cover, right? But all you can make is what you collect on that.
Yeah, and think about this, Kev. So you've got that cushion to the downside, right?
That sounds so
You've got a
interesting.
worse risk reward ratio than maybe buying an at the money call vertical.
This is why I like TD Ameritrade, because they tell you the whole play and they explain it. I like that.
Right. It's just tomato, right? How would you prefer to make money on anticipating movement or playing the opposite and playing probabilities on a daily basis?
Yeah, that's kind of the key that I'm looking for there, is you've got a better probability of success in selling an out of the money call vertical. Kev, your take real quick here in the markets. We're off of session highs, weakening a little bit, but that lower dollar, lower yields, still supportive.
What I told Oliver this morning is this market had a black cloud over it, and it needed something to make a tone change. I think today was a tone change. How long it lasts? Well, we get CPI next Thursday. It could last till then, but right now there's a tone change in the market. I think shorts are on the run here.
Yeah, and shorts are on the run. Does it last more than a day or 2 or 3? We'll have to wait and see on that. We've got some data and earnings season kicking off next week. All right, that's going to do it for Kevin and I today here on Fast Market. Stick around, though, right here on the TD Ameritrade Network. Next Gen Investing is coming up next. Have a great weekend.
QQQ, I think, is about to take an afternoon dive, and so I'm going to prepare one put. Yeah, I think it's time. I'm going to see, and I'll set my stop.
Many
That's
traders
what's
may
going
be
to
willing
help
to take
me.
on additional
So let
risk
me get in
in
here
pursuit of
and do that.
aggressive growth in
That's
their
what I'm
portfolio.
doing.
More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences.
It's time.
You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the Income Investing course and a whole lot more.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com to all your favorite streaming services.
You can also take us on the go with our
If she bounces off of this 50, oh my gosh.
audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. CNE Group, where risk meets opportunity.
The internet's been strong all day today. That's surprising. That's very surprising. I haven't had any interruptions. Usually something will happen, so look at that. How wonderful. That's a blessing. Something simple. The internet is stable. And the weather's beautiful. You know, it had been so rainy around Christmas time. The weather's been really nice, so I'm grateful for that too. I'm grateful for that as well. Why is my computer moving so funny? Hmm. I need to check something. I don't know what happened to Trader TV. Oh, did I just say something about the internet being okay and now the internet isn't? It is. It is. Yeah, Lululemon is on top today. But I think, wait a minute, I think I'm stalled over here. What? Okay, hold on. Let me get back over here to QQQ. Of course. What is going on? That is so frustrating. I just said something really nice about the doggone internet. Okay, let's see. Okay, I've got to disconnect for just a second. I've got to disconnect my Thinkorswim. So I'll be distracted for about 30 seconds or more. Get this going. Maryland, it is pleasant. How is the weather where you are? Please don't tell me it's snowy. Okay. The weather okay where you are? Oh my goodness, look at this thing. Let's see what's happening on this chart.
tone for a lot of these analysts, especially when it comes to retail, that they shortcomings of these companies. But I have to say that I think yesterday, was in a Lululemon returning something, and it was packed. The line was like wrapped around the store. So I was like, what is a consumer slowdown? I mean, it was absolutely packed, which I guess is a good sign for a company that needs some good signs right now. But our next name, also having a nice day, that is Costco. After releasing their December quarterly numbers, they reported net sales of around $23.8 billion. This was an increase of 7% from last year. Now, for the 18 weeks that ended January 1st, the company reported sales of just over $82 billion, which marked an increase of over 7.5% year over year. And now we saw same-store sales grow for both of these periods, rose 5.5% for the month, 6.1% for the 18 weeks that ended January 1st. E-commerce sales, though, on the other hand, were one of the weakest spots of their update, actually declining 6.4% for the month and 4.8% for the 18 months ending January 1st, respectively. Now, additionally, we got news that UBS, in reaction to this news, actually raised its price target on Costco to $600 a share from $565, also maintaining a buy rating in this name. I also did check with Street's coverage, also leans heavily bullish. Price targets go up to $650, which would imply a great deal of upside from its current price tag of exactly $480.
Yeah, this is a company that's executed really nicely over the last few years, took advantage of some of the catalysts that they had to get more people in their doors. Obviously, the stocking up and sort of hoarding activity we saw around the pandemic and trying to limit the amount of times people were going to stores, bulking up on things. Wholesale is obviously a great way to do that. But then also with the energy prices soaring in 2021, a lot of people taking advantage of those slight discounts that you can get by buying even gasoline at the wholesale prices at a place like Costco through their membership program. So certainly taking advantage of that. And then when you have that membership program, as long as people enjoy their experience, they're more than likely to actually shop at your store. But what's fun about this too is that we've talked about this too. It's sort of a company that has, because of these monthly numbers, and you see these kind of reactions, almost like 12 mini earnings announcements as opposed to the 4 major quarterly ones. And so this is just what that is. It kind of highlights why earnings in particular aren't as dramatic for a name like Costco. But going to say down vote, news out, the reaction is being had, and we'll see where things go from here.
Yeah, Costco is always an interesting company, the way they release, like you said, and the way we get updates constantly, which almost is nice then, because the earnings event, there's not typically this fear surrounding it. We kind of already know what's priced in. Now, our next name is Warner Brothers Discovery, and the company's CFO said at a Citibank conference, this will be a year of relaunching and rebuilding for them. He said they will take time to make sure they handle it properly, and they've been working on their ability to do so in the last year. For some of their titles, also said it was very important for them to use this
the internet. My internet
as well
is
as
so
initial
jinky.
strategy changes, and to be
It does whatever
transparent
it
about
wants
their
to do.
restructuring estimates. Now, to put a number to some of their
70.
restructuring estimates, back in 2022, the company did raise its forecast for the cost of restructuring.
That's 62 degrees Fahrenheit. That's not as bad as it could be, because in Chicago, oh my gosh, I know it's cold. Okay, let me watch. 266, 67. So I was saying, if you want, after the bell rings today, I think Elle wanted to see how to place an order too. If you want, I can do it today while we're here. We can do it together, or we could do a little Zoom, a quick Zoom, whatever it takes, so you guys can see how it goes, because it's really easy. Or I could show you. Yeah, I could show you right here. I can show you in paper trading. So yeah, okay, I'm just gonna sit here and watch QQQ. I learned a new screen. It just doesn't show up for you guys. Those pop-up windows don't show up for you. So there's a way for me to watch QQQ. Hold on, let me see if I close this. Do I keep this window? No, that's not how that works. Okay, but Well, we'll see. 266.58. Don't know. This is interesting to watch. If she's got some more steam, let me save that and go over here and look at Market Watch. Okay. Yeah, I know. My internet, I think when I'm trying to share a screen, it's just like too much. It's just, it can't bear to do it. So I have to keep it simple so you can see the whole thing. I have to keep it simple. So I don't know. Does she have enough steam to keep going? That's a pretty steep, pretty strong candle there after a nice little bit of rest. We're going to see some volume oversold. Look like this is waning a bit. Don't know. That was the move for the day, this big piece. I got in on a little bit of it. And I think Frank got in on the drop right here. I got in on this and I got out too soon. I should have stayed to here, but I was happy. We have decided that base hits are good. We're taking small wins. Okay, so we'll do it afterwards because then I can just pull up paper trading. And then you can always watch the replay. Yeah, that's how we'll do it. That way, you don't even have to go into the drive. You can just go to the video to see it. That makes perfect sense. Okay. It looks like we're stalling at 266.50. Okay. Well, we'll see. Man, I wish I had something. I'm telling you, I've been wanting Jell-O. That's some fruit.
Merger between Warner Media and through 2024 versus forecast around 4.3 billion. When that news was announced, the stock just naturally slid in reaction. But they're also grappling a weakened ad market and, of course, ongoing stiff competition within the streaming space. So a lot of negative catalysts have faced this company over the last year, which, no surprise, they're down 65% from their yearly high, up about 25% from their lows. So definitely well off their lows here, and also having a stellar week, up about 17% for the first week of the year.
Yeah, one to keep your eye on, obviously working through that more dark period, kind of hoping to come out the other side and see where things ultimately end up. Whenever the word restructuring is being used, you're talking about realigning and getting things in order from an accounting standpoint. You're not talking about a company that's firing on all cylinders. And so obviously, as you talked about, a lot of negativity that they've been working through, making positive steps in that direction. The market agreeing with that today with a nice little pop here alongside the overall market. Going to say downvote, though. To me, this is a long-term story that is unfolding sort of in real time. It's not particularly a very time-sensitive situation. And so for that, maybe more of a story that's more impactful for someone who's investing in this stock, not necessarily someone who's looking at things from a short-term trade horizon.
Yeah, that's a really good point. And our last name is a name I want to say is one of the most resilient names of the week. That is Southwest, which is higher today, despite the fact that they gave an update regarding, of course, their holiday fiasco when they canceled just over 16,000 flights. Now they have to deal with reimbursement and also millions of dollars of lost revenue. As a result of these operational disruptions, the company disclosed they currently expect to report a net loss in the fourth quarter, driven by a preliminary estimated fourth quarter 2022 adjusted negative impact ranging between 725 and 825 million. They said this significant portion of those losses will be in their revenue ranging between 400 to 425 million. They did also report their preliminary fourth quarter capacity is expected to be down about 6% versus 2019 pre-pandemic levels. But this total revenue loss could equal as much as the company made in the first 9 months of the year. So it is
I think
no
maybe she's
small
going to continue
figure.
to go
This
up.
was a result of Southwest saying they basically
If she goes
underinvested
over
in their
to
crew scheduling process,
67,
which failed to then keep up with flight
we might
cancellations
take
as
a
well as
peek.
crew members' schedules during that peak holiday season. They've already declared they are issuing rewards points to those affected worth of about 25,000 points or about $300. But I know you're a Southwest guy, Alex, so I'm curious, like the thought process here, because I kind of tend to think I will fly whatever airline gets me there for the cheapest. Maybe that's just my own rationale. I don't necessarily think a headline like this is going to make me not fly Southwest.
Yeah, if Southwest is the style of experience that you like, I think that they're likely to see many of those customers remain loyal. But this is the first major slip up from a company like Southwest that it hasn't had similar from its peers. Southwest was clearly the company that was most impacted and canceling the most flights over this period most recently, and they're standing alone under the spotlight of scrutiny. When many of their peers have had that spotlight on them over the past few years since the COVID disruptions in travel, Southwest has executed very strongly and navigated those waters in many ways and arguably better than many of its peers. It's the first time the spotlight's on them for a different reason. And we'll see how this
I know. But see, I said it, Marilyn, but I don't know how to make it. It has to ding to my phone. I can set the alert. Yep, I remember how to do that. But even when I said it, it just clicks off. It doesn't click to my phone because I think I turned off the notifications to my phone. I need. You are so right. Y'all make me better every day.
I was flying over that peak holiday season, and American Airlines had
Maryland, that's exactly what I need to do. And I need to go ahead and set the alert.
Smaller scale,
and I have to remember, where do you set the alert?
Degrees, but I guess Southwest had their own set of issues. But we'll dive into our upvotes coming up next with our chart master. Those being
I want to say it's in
Lululemon as well as
trade.
Southwest Airlines. Stick around. Next Gen Investing. We'll be right back.
I think if we do something like this. Wait a minute. Somewhere there's a drop-down menu that says set alert.
Whether you're an experienced
I wonder
investor
if it's
or
on the
just getting
chart.
started, TD Ameritrade
So let's say
offers
we
a
click on the
webcast
chart.
that's right for you. The platform demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD
Create
Ameritrade.
alert.
You'll
There
learn
you
tips
go.
and tricks to help navigate
Okay, so QQQ. I want an alert if it goes above 267. Thank you. So you can't see this pop-up window, but a window pops up. And so what I'm going to do is create an alert so that if the price goes above 267, I'm just going to type it in. If it goes above 267, then I'll get the alert. Then I have to go into my phone and enable those alerts. Okay. Okay. So I just created an alert. Hold on, I'm going to create it, and it should pop up. It'll pop up on the. It'll pop up on the chart, and so now I'm going to go on my phone and make sure that I enable these alerts. So can you see it now, Marilyn? So I did set the alert. I'll show you again what I did to set it. But you just tap somewhere on the chart. I did it like this. You right click on the chart, and then this little pop-up menu comes up. But I don't know if you can see it. If you can see the pop-up menu that comes up. Oh, wait. Okay, so then you can see this menu. Then you slide down to where it says create alert and tap that, and then a box opens. That's the one thing you can't see, that box that opens, but it's really straightforward. Let me see. I think maybe I might be able to share this box. Hold on. Let's see. I might. I'm going to try it. I'm going for it. I'm going to see if I can share it.
And love, that is Southwest Airlines. Two companies that are, more or less, I think, have their following.
Oh, this is it. I think this is
a little
it.
bit more confident, I think, in their brand than the other right now.
So I think I'm sharing
We talked about how busy the stores are.
the alert menu now so that you'll be able to see. Okay, so yeah. Oh my goodness, man, am I learning? Okay, so here's where you change the price. So I want, if it gets at or above 270. So I'm just going to put 270. And at or above, and I'm going to leave. Yeah, that's the stock price. I want to know if the stock price gets there. Let's see. I don't know if I should do last or March. I'm going to say last because that's the last price. And then you hit create down here, and then it creates the alert, which was the same alert that I created. So that's probably why it's yellow or whatever it did, because I just created the same alert. So yeah, we are learning every day. Yep. Okay, so that's how we do.
Many other stocks that we've talked about here, but
yeah, did you see it? Okay, that's how we do create an alert. And let me get the chart back in.
Still, that would be this blue dashed line right here, right near
our
previous highs.
And then I'll show you, we'll go over before we leave each other today how to place an order.
Was a rising wedge type shape, typically a more bearish pattern where we have a steep
I'm going to move this over so y'all can see.
And a more shallow trend line going across the highs.
Because this is the good stuff.
Is that then it would break downward. Obviously, not a guarantee. It's not going to happen that way every time. It did happen in this case, though. After earnings, we had a dramatic downward fall.
And earnings are coming, so it's going to be a lot of volatility. Well, potentially volatility in the market.
Dashed line here. But now we're in the thick of our three moving averages, our yellow 21-day, our orange 63-day, and our purple 252-day exponential moving averages. So we haven't really managed to break above those. We were peaking above them for a little bit today, but we were smacked back down below them. So it'll be interesting to see if we can at least get above our 21-day EMA. We are above that point still here. But momentum, the RSI, right around the midline here. Recovered a bit from those lows, but really not making much progress into bullish territory. Kind of not really pointing one way or the other right at this particular piece of time. One thing that really concerns me about this chart, though, is that we had this big drop downward, then we're having this modest rise upward. It really looks like this could be a bear flag type pattern here, where we have this brief period of rising prices amid a downtrend that simply is oftentimes the next precursor to the continuation of the downtrend here. We have people closing out positions or taking some profits on prices that causes a little bit of a rally. So something to consider. Once again, is this a guarantee? No, of course not. But this is a type of pattern that can often play out, and it's good to be aware of it in case it does start to happen, so you don't get swept in and take some damage in your portfolio here. Resistance, our moving averages to the upside near about 326 to 330 or so. That would be the area to watch. To the downside, as I said, the 307 level would be a place to look for some potential support or the doorway to further declines.
All right, so basically don't give too much gravity to the recent run-up we're seeing, Rick, as momentum is waning. We still are seeing things somewhat break down overall, despite the fact it has had a nice week, of course, up about 3%, but up today. But considering the overall market, I do think this is a name that does have that risk. You know, anytime we hear something about the consumer or spending, this is a name that could be impacted. So really interesting chart for Lululemon. And Alex, with that mindset and the fact that we had this analyst today that's saying all these negatives on Lululemon, yet upgrading the shares, walk us through an example trade that then leads more neutral to bullish in conviction.
Yeah, I think this is a fun one because the technicals say one thing, the commentary says sort of the same thing, yet the conviction and the price target and the rating suggest another. So I kind of wanted to split the game here and do a little bit of a neutral to bullish strategy, but it's also somewhat omnidirectional. As you'll see, the best case scenario is actually a lower price on this one. We're looking at a skewed put butterfly. If you go into the February options in Lulu,
butterfly.
On
That's
the put
a
side,
first.
they're $10 wide strikes.
I never heard
so,
that.
Not
A
that
skewed.
simple to get this down to a relatively small trade. And so I wanted to do something that does its best to limit the risk, but also creates an interesting risk reward profile. Looking at buying one of the 320 puts, selling two of the 310s, and then defining the risk by buying the $20 wide 290 put to create that $20 wide put credit spread that converges with the $10 wide put debit spread. This is done for a credit of $1.25. So if all of these options expire worthless, aka the stock is above 320, that'd be your most likely scenario for that to happen. This keeps the credit received. So 125 would be the best case scenario in that case, net or not net of any of the transaction fees. So next, what gets interesting though is as you see, looking at the risk profile, levels off, then it spikes up and it peaks out before turning sour as the stock price moves lower. It peaks out at that 310 mark. The reason being, you're buying one 320 put, you're selling two of the 310s, and then you're buying the 290. So where those spreads converge at that 310 mark is the best case scenario. Reason being, the debit spread goes close to full value, credit spread works its way towards no value, then it can expand, you keep the credit as well, 1125, theoretically that max profit. Not the likeliest of scenarios, but it does correspond a little bit, Jenny, with the level that Rick had highlighted around 307. It's actually the closest strike to that that we could have used. And so kind of coming together here, it then turns sour after that with a break even at 298.75 before losing max value below that mark of 290, in which it does have a full 875 at risk. So we'll be looking at this one just basically stabilize, but in the event that it eases lower, this one could stand to really gain from that.
Right, and of course, we are risk defined here in both case scenarios. But now our next name, I don't really know the tie-in to Lululemon and Love other than that the tickers start with the same letter here. But Southwest, to me, this is a complete mystery. We see all these negative headlines. They disclose these fourth quarter preliminary numbers that don't look great given the fiasco that happened over the holiday. And Rick, they're still up 1% for this week. They're still well off their 52-week highs. And I will say there was one single stock that I checked while I was on vacation last week, and it was Southwest. And it didn't look too pretty last week, but this week, all things considered, they're doing quite all right.
Not only are we up today, we're forming a type of bullish candle pattern. We've got a bullish engulfing candle where the real body of today's candle completely encompasses the previous day's candle. So this is typically regarded as a more bullish signal here. So I got to admit, I was scratching my head a little bit as well, given the large amount of bad news today, but you know, the stock is showing some resiliency here. And this is an interesting one because even though the broader trend still looks like it's mostly down overall, we did kind of squeak out some higher highs. See, we had this previous high here, and our recent rally off of those yearly lows did wind up making a higher high, and we made a higher low here as well. So it's looking like you could make the argument we're in a very wide upward sloping channel here.
Thinkorswim by TD Ameritrade is more than a
Keep
trading
going all
platform.
the way up,
It's an
Lord.
entire trading experience that pushes you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Oh, yeah, I'm going to take off.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position?
You two are all set.
Choose the app that fits your investing style.
I'm Nicole Petalides, live on the floor of the New York Stock Exchange, empowering investors every single market day. Tune in to the TD Ameritrade Network.
QQQ is killing it. Mhm.
The news cycle continues to beat down on Tesla. Welcome back to Next in Investing. Jenny, let's talk some Tesla. Daily appearance on the show, but looking at the candle today, you would think that there was positive news.
Right. And actually, I think this is my first time talking Tesla all day, which is something I haven't been able to say really throughout the rest of the week. Not positive news, cutting the price of its Model 3 and Model Y in China, which is China seems to be right now this looming issue for the company. But here to tell us more on the news today and why we're seeing a move higher, I'd like to welcome in Caroline Wood, Senior Markets Correspondent. So Caroline, it's been a brutal, I don't even want to say brutal week. It's been a brutal 3 months for Tesla, but shares are down around 10% week to date now at this point. But further bad news today, and I almost think this is more important than any of the other sort of drama surrounding Elon Musk, because fact of the matter is they are trimming their prices to account for softening demand.
Hey there, Jenny. Yes, you know, it's not my first time talking about Tesla today. I've been talking about it all day, and it looked as if on this news of Tesla cutting prices in China that shares were going to sell off sharply. In the pre-market, shares were down as much as 7-8%. Now we're looking at Tesla shares up about 1.3%. So taking part in today's rally, not sure if it's seller fatigue or, you know, maybe people are thinking that lower prices will actually boost demand. But let's actually go through these figures. Tesla is cutting prices on its EVs in China by about 6 to 13%. This, of course, comes after deliveries fell sharply.
This was a perfect afternoon. If somebody had gotten in early in the morning, all that up, that was great, great, great. Unfortunately, I've been sitting on the sidelines just kind of moving, just watching. We got a little bit. I think everybody got a little bit, but not that long play.
So a Model 3 is now priced at
And
about
that was a good one too. It's still going.
That's
I'm gonna
13%
research
lower
this
than
thing.
previous, and about 30% cheaper than the same car here in the U.S. The Model Y is just under $38,000 US. That's the 6% price cut. You talk about softening demand. Obviously, that's the key concern here amid all of these macro issues, as well as, of course, the competition that continues to heat up. But there was a post on a Chinese social media platform where a Tesla executive said that discounts were the result of engineering innovations and calls from Beijing to boost economic developments. So I guess that sort of goes against that demand issue, but I think it's safe to say demand is obviously still very much a concern. I did also see reports that people in China were flocking Tesla stores, crowding the stores after these price targets were released. But Electric is reporting that it's actually because they were protesting the price cuts. Nothing worse than buying something and then it going on sale soon after. So it appears to be some disappointed Tesla customers there. Doesn't appear to be weighing on the stock, though, up about 1.2% today.
Yeah, you know, Tesla hurts my brain, Caroline. I try so hard to look at this stock and be excited about the headlines, but they're never ending. But we're talking about a stock, I think Jenny said it's down like 70 or so percent, let's say, from its all-time high, somewhere in that vicinity, okay?
71.
It's still $350 billion. It's still gone 500% higher over the last 5 years. It's 10x off of its lows over the last 5 years. And we know that there's no more polarized stock. You got the $5 price targets and you got like the $7 million price targets from some. And it's been like this giant tug of war battle that one side gets the momentum and just relentlessly pulls. But the bears got back up. They dusted themselves off, and they've made this a game again. But I got no idea. This is no man's land. No one knows what's going to happen next with this one.
I'm looking for the $7 million price target here, Alex. Let's see here. I can't quite see that one, but Oppenheimer's at 436, so that's pretty high, especially compared to where it is. But yeah, we've seen analysts on both sides of the spectrum really weighing in today. Gordon Johnson was on Nicole's show. He's a big Tesla bear. He has a $73 price target, so Tesla's currently trading around a little more than 111. So obviously he has a sell rating. He said that these price targets in China are worse than you think. He points that the bulk of China's factory production currently is being exported, but in China, Tesla's biggest market, he speculates it seems orders are close to zero. As such, says Tesla will go down as the single greatest stock short of all time. Meanwhile, of course, Dan Ives over at Wedbush, who we talk about on the program, who comes on the network quite often, he was tweeting today saying, I continue to strongly believe Tesla has more EV growth opportunity in front of it than behind it. Price cuts, all part of this EV cycle in a softer macro with competition increasing in China. So obviously he's on the bull side, did lower his price target, but still sees quite a bit of upside. I also saw an analyst over at New Street talk about what these price targets, or I'm sorry, these price cuts could mean for margins, because we know that they could weigh on margins for Tesla, which typically are quite high. He says his analysis shows that Tesla can afford to lower its average selling price by about 8% without denting margins, talking about the ramp up in Berlin and Austin, improving unit costs, also saying the end of shipping from China to Europe will actually improve supply and input costs, and pointing out that Tesla will benefit from some of the EV incentives here in the US. So that actually seems like it could be positive news and help Tesla achieve that addressable 50% market. So could be why we're seeing a bit of a boost here for Tesla. But as we've said, it's down 70% over the past year, 71% from its all-time high.
People are brand loyal. I'm sorry, because Southwest didn't do anything to hurt my feelings. I'm still flying Southwest. But I told y'all earlier, I tried to book a flight and I couldn't get it. I couldn't pull it up. I mean, like, they weren't even scheduling any flights. At least I couldn't get one. So I don't know. I do not know.
Regardless of the hype or some of the negative headlines, being in a Tesla, I
don't
still completely fangirl. But
I thought that was pretty odd.
Caroline Woods, New Markets correspondent. Have a wonderful weekend. And now coming up next to end the show, we're looking at WWE, higher on the return of Vince McMahon, up over 18%.
Look at that little afternoon bump at 1 o'clock. I was wondering what was it going to do. Was it going to go down, and it continued? I'm sure there's some data in there with those candles that should have let me know that was going to be a continuation pattern. Well, all that green was a clue.
Personalized education to expand your perspective, and a dedicated trade desk of expert level support that will push you to be even better and just might change how you trade.
This was the perfect day to just buy a call at 10 o'clock and just let it do its thing all day long. That would have been such an easy day. I didn't have an easy day. I jumped in and jumped out.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Well, but Johnny and I were talking about a sell-off at the end of the day because all these people will be taking their profits. So we'll see. Or some of these people will be taking profits.
Time for Under 30. Let's talk some wrestling. WWE. Never been a fan.
Me either. And this is one of those things I'm okay not knowing a whole lot about, but I do know that Vince McMahon is very important to this company, and they're perhaps, right now talking about the idea of a potential sale. The street clearly likes this move, Alex, and that's one thing that I know that we both can understand. So here to tell us more now on this move today is George Tillis, Senior Markets correspondent. So George, I'm curious if you're a wrestling fan, first of all, but also the return of Vince McMahon. We could see a potential sale of the company. I mean, there's a lot of headlines today with WWE, but a nice move.
The only thing I know about WWE is through producer Rob. He's a big fan of the program. But look, this has been an interesting story for a stock that's up, 75% or so this year. It's World Wrestling Entertainment, again, for those who don't really know the company, but you have to think about it, not just a sports entertainment company, it's a full-fledged media entertainment company with media and live events, but also consumer products. The merchandise sales are also a big portion of their sales, and it's a really mixed story, but effectively looks like Vince McMahon retired or was partially retired back in July 2022. There's been a huge question of whether or not the company is going to be operating without him on the board of directors or not, and now he wants to reinstate himself on the board of directors, and even now potentially, because he has the majority voting rights of Class B shares, to sell the company outright. There has been outside of the drama that's going on with Vince McMahon and the company. I'm just looking at it from a financial standpoint. There was a catalyst earlier this year in which the TV content rights. Now WWE used to basically run their own network, and they actually sold the content rights to that network to Peacock, which is a subsidiary of NBC. So that in and of itself is a huge cost reduction, and also a way to generate huge upfront revenues from, again, spinning off their TV content business. The other thing is they have TV content deals with Fox, and these deals are actually up for renewal in 2023. So this is a situation where maybe, some bigger player, this is the speculation.
Yeah, I don't know what happened, but people forgive,
picks up the brand
I forgive them because I've never had a bad experience. So I hope I don't, knock on wood, because as soon as I said the internet was great, what happened? So, but knock on wood. So I'm hopeful. I'm going to try, I'd still fly them. I don't know what happened. Maybe it was a fluke, the weather, and maybe a whole bunch of things at once.
Sales, 1.4 billion this year. So the company's been growing. It's profitable. It has a net income margin of 14%.
God
It's grown
bless.
its operating cash in the last year 28%. And all these are really good financial metrics to kind of justify the price action. But I think if you also consider the other sort of canary in the coal mine here for potentially why the price is going higher, not lower, is short interest. The short interest on the stock is, as a percent of free float, is close to 20%. So I think the drama behind the founder and CEO,
That's not hard to see. That was a good day. That was a good day for a call.
and potentially valuation concerns, and we may be seeing a partial or the start of a short squeeze here as well. So I'm just bringing this up as a possibility of why the stock is moving very aggressively, double digits, especially in the last 2 days.
George, I had you pegged as a wrestling guy. I feel like that's going to cost me some money in our friendly wager here. But all jokes aside, George, Vince McMahon is one of this exact situation, a particular person and the company that they used to run coming back. There's really not that many examples that you can think of that will have this type of an effect. I mean, this particular guy is so important to the WWE. Like he built it into what it was. I mean, this is like Steve Jobs coming back, some situation like that. Like you can't really say it's Bob Iger going back to Disney, because Disney's its brand portfolio. That's just the execution on this.
It's one of the better airlines,
this guy,
yes.
The character is part of the WWE.
Yeah, he is. I mean, at the end of the day, he was a full-fledged character in the ongoing operations.
Oh, you work
of the
for their
business.
competitor.
Again, he's a
Yeah.
founding,
Well, see,
founder of the business.
I'll fly anybody.
CEO of the business
I think
for
I like
quite
that.
some
Whoever
time.
has the best price. That's who I'm flying. But there's some I won't fly. Because the truth is, I am, and I promise you, I am in no way any kind of snob of any way, but I will not fly Spirit. I just haven't. I won't say I won't. I just haven't, and I haven't flown Frontier. It's just the paying the extra for the bags and all that other stuff that just never mind. Let me just pay what the price is. I just want to know. Tell me up front what the price is I'll pay. So any major airlines, I'll fly them. Whoever, United, Delta, American. I prefer American. Oh, can I say that? Anyway, any of those, Southwest, all of those, they all work for me.
As well known.
But I won't do the real budget ones because that would aggravate me. I'm just gonna be aggravated. I hope that's not the one you work for. Yes,
I can see why the stock is higher
it's
this
some
year.
not so good ones too. Yeah, Spirit. I get it.
I wouldn't even go as far as to
I
say
get
Bob,
it,
he
but
bought
I
higher
just don't
to
want to
Disney.
do
I
it.
almost think
I
he's
just don't
Walt
want that
Disney
tiny.
to
I don't want a
to
small
Disney.
seat. I will
But,
pay
you know,
extra
Vince
to
McMahon
get
is at
a
age of
window
83,
seat.
so
I will pay
obviously
extra to
well
be at the
received by
front of the
street today,
plane.
perhaps well received that we
I'll pay
completed the
extra.
sale of the company. But we'll leave it there. George
I
Schultz,
don't
have
know
a
what they're
wonderful weekend. Thank you
saying.
for all of your thoughts
We're
all
having
week
trouble
long.
Guys, thanks.
streaming.
Thanks, George. And that also does it for Alex and myself for Next Gen Investing for the week. Thanks for tuning in. Coming up next, we have the watch list with Nicole Petalides.
Yeah, American's my favorite. I'm sorry, and then Delta and United. I mean, because those are the ones I fly most often. And then some foreign carriers. But yeah, I'm sorry, but really, anyway, put me on a plane. I love a plane as long as it's clean and it's updated and safety record checks out. I'm in. I'm there. Okay, what you doing, lady?
And other fundamental data. Company details provide summary takeaways on key metrics and what drives the stock. Takes a more numeric look at similar information.
267.
If you find any of the information particularly helpful,
I guess
you can
she's
print
just
it
gonna
out
keep right
or
on
take a
going.
screenshot. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
26769.
We empower those who act, those who see the correlation between upswings and downswings, those who manage risk by meeting each obstacle with a perfectly executed strategy, a measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange new location with access to the biggest newsmakers in Wall Street, bringing you in-depth market coverage and real-time trade ideas. Do not miss our exclusive interviews with CEOs, bell ringers, traders, and stock pickers, keeping you informed as you navigate your investment. Don't miss Trading 360 at 11 a.m. Eastern and the watch list at 2 p.m. Eastern, live from the New York Stock Exchange, only on the TD Ameritrade Network. Good afternoon. Welcome to the Watch List. I'm Nicole Petalides. It's 2 p.m. Eastern Time. We're coming to you live from the New York Stock Exchange. Thanks for being with us. It's an up day across all four indices that you're seeing, but of course it's been down weeks. We're seeing the S&P and the NASDAQ down, for example, for the fifth negative week in a row. Here's a look at the S&P, 3880 right now, 72 points higher, up 1.9%. The Dow up 584 points, 1.7% higher there at 33,514. The NASDAQ is gaining 2.3%, 10,989, and the Russell 1789 gaining 2%. Now, for some of the biggest stories in the markets, of course, we're going to be covering the jobs report today. But Kevin Green is with us, senior markets correspondent here on the TD Ameritrade Network, to take a look at the story of Costco. Some good December sales helping the stock today. Tell us all about it. So we're taking a look at Costco right now, which had some good numbers for December. Seen it earlier, up about 7% at this point. It's at 480 and change. And this really is an indication that some of these names, some of these retailers are doing well, right? They had the holiday sales gain, online sales receded, but they did see some good numbers there overall. So that was a good sign, at least for one name, and that was Costco, which over 3 months is down fractionally, but today a big move higher. Let's go right now and continue our show and get a look at the big picture. Matt Miskin's with us, co-chief investment strategist at John Hancock Investment Management. Today, we got the jobs report, and I said that at the top of the show. Obviously, the big top story today, the wage growth story within it shows inflation is coming off the highs. That's one thing people are talking about. What stood out to you? Tell me more.
I think you're right, Nicole. I think the wage growth dampening here into the final month of the year was the best sign of the jobs report. I think the overall number was okay, not bad, not great. But the wage growth coming down, the Fed is really focused on that. And that could be something that drives inflation over time is wage growth. If that can come down into 2023, that will really help bring inflation down. And if that happens, the Fed can slow down. It was interesting, though, the jobs report, in terms of the market reaction, there wasn't much going on this morning at 8:30 a.m. It was around 10 a.m. where things got interesting, and we could certainly talk about that.
Yeah, and we've gotten in the ISM print and some other things. I mean, we saw that under 50, and I think that was a crucial part of it as well. But just the fact that the markets have managed to turn around in a big way on this Friday tells us a story as well. What else are you watching?
Yeah, I mean, today overall, you can make up your own narrative on what's happening because almost everything's up. I mean, other than the dollar. The dollar got whacked today at 10 a.m. with that weak ISM report that you were talking about, Nicole. And as soon as that happened, dollar down, risk assets up. You saw, U.S. stocks, non-U.S. stocks. You saw bonds rally. But it's really interesting right now because you're seeing all sides of the spectrum really rallying. From higher risk assets like materials are leading all equities today. They're up about 3%. And then you've got treasury bonds rallying today. Treasuries and materials are two very inversely correlated assets over time. Materials are playing real, the economy booming and accelerating. Treasury bonds are playing a recession. So I get the treasury bonds rallying as it relates to that weak ISM report. Materials, on the other hand, it could be looking at the China reopening story and still playing that narrative.
Right. So when you look at the different ways that things could go, we had Bostic talking about 525. Do you think that the Fed may start to step off the gas? Because we'll have, obviously, a rate hike probably on February 1st. But then what?
Yeah, we think that, one more in March very well could happen here because of this jobs report and because the labor market just hasn't shown much signs of weakness. But after that, we think that they're going to be on pause and that actually they're going to be cutting more aggressively in the back half of 2023. Right now, the bond market's pricing in about one rate cut of 25 basis points. I mean, if you look at the ISM services data now, the manufacturing data, the housing data, you look at, a lot the leading economic indicators, the yield curve inversion, it's all telling you the same story that a recession is likely happening in the midpoint of this year. And yet the bond market, in terms of the pricing in of rate cuts, hasn't really reacted to that too much yet. So we think that's going to be a big development. That is going to help bonds rally, actually, in the back half, high quality bonds, that is. And that's one of the biggest allocations or views that we have in terms of our outlook is actually high quality bonds. Boring bonds could be of the best performers here in 2023 after a really tough 2022.
Yeah, and when we talk about inversion of the yield curve, and we're looking at the 10-year and the 3-month, that spread is the most inverted on record. What are people saying about that? What is that? How do they interpret that?
Yeah, I mean, every time this happens, there seems to be a myth buster. So, they're like, a lot of strategists or investors think it's different this time. It's not real this time. There could be other things like quantitative tightening, although actually it would mean that the yield curve inversion would actually be more legitimate because right now they're selling 10-year treasury bonds, and in essence, it's still going more inverted. But we stay disciplined and say, look, it's telling you that the Fed funds rate and the Fed are acting very restrictive relative to what the market is pricing in growth and inflation in the 10-year longer term bonds. And if anything, the data continues to suggest weakening growth, weakening inflation based on this wage data. And the Fed is still hawkish coming into this. And so that is why the yield curve is inverted. We still think it's a very relevant signal of a late cycle. And when that actually starts to steepen, when the short end comes down and the longer end stays down, but actually comes down with it a bit, that steepening would be actually, kind of the Fed pivot. But it's actually bullish for bonds because it'd be a bull steepener, which would be beneficial for across the curve overall.
Yeah, and what's your outlook for 2023? I mean, can we do the soft landing?
It's hard. It's a really narrow path, and we think it's probably unlikely. I'd rather position for a more of a hard landing than a soft landing here. And I think it's interesting because the markets are not pricing this in. Industrial sector is crushing it right now. It's had an amazing run. Materials, energy, financials are coming out of the gate so strong into 2023 here, and the markets are not pricing in a recession. And
well, I'm just waiting.
Positioning and
this new tablet is fast. My old one is slow. Good. I mean, it'll make a difference too.
Parts of the technology sector, even some utilities. If you're going to play value, we'd have quality.
Maryland.
There.
Well,
to us,
my family.
We like fixed income and income more broadly, and you got to be selective in the equity market.
They know.
Yeah, without a doubt. So where do you find value? You want to be selective.
Some.
How do you find the value? What would signify value today to you?
Yeah,
but I'm glad your tablet is fast. I'm trying to keep my eye on and see if QQQ is going to do a dump because it went straight to the sky. So it has gone from one end of the RSI all the way up from the bottom to the top. So generally when it does one of those bottom to tops like that, it's got to come down too. So I'm just being patient to see how this thing comes down. If it's going to come down in the last 2 hours or excuse me, is it going to just keep going up? I mean, who knows?
Staples look a little expensive here to us.
I don't know. RSI, but my MACD is,
And what about some things that are related to
We're going to see.
I had a guest on today who likes.
I would love for it to just come on back down now and give back those same $6 and catch it on a put. Because Lord knows I watched it this morning. Hey, Johnny, look at this. Did you see this?
I go to bed.
QQQ cut up today.
Saying that China's reopening. And
I'll do it on the 15th.
In terms of the industrial commodities like copper,
but yeah,
on fire as a result.
And I can't tell if she's gonna stop or keep going, but she is awfully
really hard here on this.
Oversold.
To fully put that exposure on. In terms
but I've
of
seen her be
views,
oversold like that for a long time.
A recession,
so 2, 6, 7, 9, 8. I'm trying to see if she stays. If she gets up to 268, I don't know, Johnny. Are you done for the day?
I think that's a really important thing to consider here. If the U.S. goes into a recession, it's very likely it's a global recession. There's been periods where the U.S. has managed to not go into a recession, the rest of the world did, but it's never been inverse. When the U.S. went into a recession, the rest of the world didn't. And so I would be, in our view, is we would actually be less exposed to that commodity trade, but it has been on fire in terms of the stocks over the last 3 or 3 or 4 months. We would trim some of that strength, that recent relative strength, and put it in more defensive equities.
Right, understood. Matt, it's great to see you. Matt Miskin, thank you very much. Happy New Year. John Hancock Investment Management. Thank you, Matt. Later this hour, we are ready to focus on the utility sector. What can we expect from utility stocks for 2023? We have that detailed for you. And how about space? The space sector, we're looking at what's on the horizon there and how it all fits into a global economy. And our panel is ready to talk about all things in that jobs report and what it could mean for the Fed going forward. Up next, take a look at some potential opportunities in the first half of the year. Our next guest has his eye on some big tech names that you know very well. You'll want to hear all about it. The watch list. We'll be right back.
Let's walk through charts, one of the most commonly used features on Thinkorswim. Start by going to the Charts tab and entering a ticker symbol.
What does it say?
Select time frame to adjust time intervals or to favorite a time frame. Select style to change the appearance of the chart.
Okay.
You can add drawings by selecting drawings, drawing tools, and then type of drawing. For symbol comparisons, select studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab.
Pretty well,
Just
not
right-click anywhere
bad.
on the chart and select either buy or sell.
Hey
For
L,
more
Q,
demos on
shut up.
Thinkorswim, head to
But
the
if you
Education
guys,
Center
I
on
know L,
TDAmeritrade.com.
you and Marilyn wanted to see how to place an order. If you guys want to just wait till after the bell rings, after the closing bell, then I can do it, and we can practice it together. Do both of you guys have your Think or Swim loaded onto something that you can use? It's a little overbought at the moment. Yeah, Johnny. But the S&P down, Russell have finally broken out of the 14-day range. Really, NASDAQ is lagging behind a little, but it's close to breaking out as well. Okay, Johnny, when it breaks out, can I jump in? Is that jump in time?
We'll see it. They're getting so smart.
Choose the app that fits your investing
I'm
style.
pretty good for today though, because something, I don't know, every time I go to try to buy a contract, my thing goes stink. So I don't know what's going on. So I'm sitting on the sidelines watching all the action take place. So I got to call TD Ameritrade and see. Okay, that'll be cool. Yep, just get your stuff and then we'll go through it together. And then that way it'll just be at the end of this video too. I'll share my screen. It'll be at the end of this video and you don't have to go to the Google Drive to get it. You can just watch the video. Easy breezy capeasy. Next week, I'll be more focused. I know. On longs, still take shorts. But if the breakout holds, it should trend up for a while. Caution is that the CPI numbers come out next Thursday. I know, maybe we can get something in before Thursday. I'll be ready too. I'll be ready starting, I don't know, we'll see. I have to sign into, okay, Marilyn, yes, perfect. You two ladies, we can get that, we can knock it out. I'll sign out of, okay, so be on the lookout for CHOP. Will do.
We have some movers for you to take a look at. Lululemon. Lululemon is higher today after Wells Fargo upgrading the stock to overweight, boosting the price.
Oh my goodness, okay. There we go. All righty. So let me keep peeking over here and see.
Heading into 2023.
26841.
The stock was boosted to overweight from equal weight, raising the price target there to 188 from 146. The analyst there turning positive on clean energy sector for 2023 and says the fundamental regulatory backdrop is, quote, much improved in 2023. JP Morgan higher today, despite a downgrade over at Deutsche Bank ahead of the earnings next week. The analyst believes that the new lows seem like for U.S. bank stocks that assumes that they will trade below their historical 60% to 80% range. WWE hitting 3.5-year highs after former CEO, majority shareholder Vince McMahon returning to the board. In a statement, McMahon saying that he's looking into the sale of the company ahead of the media rights negotiations that are quickly approaching. And Vince McMahon retired from WWE last year following an investigation into payments made regarding alleged sexual misconduct. So he's rejoining this board. It's a pretty interesting story there. Last but not least, 16,870 is where Bitcoin stands today. time to welcome in our next guest. Jeffrey Small is with us, President Arbor Financial. I look forward to talking about some of these big tech names that people might be able to nibble on once again. But first, let's just talk about the big picture. I mean, you know, with today's move, right, you know, we're saying a negative week, but you know what? If we can hold these gains until the end of the day, it's a winning week. Winning week for the S&P Dow and the NASDAQ if we can hold on to some of these gains just for the next few hours. What are you seeing here?
Well, I think so far, Nicole, every rally we've had so far has been a bear market rally. And no market's really ever bottomed before the recession happens. And with the street expecting that recession to happen mid-year 2023, which means this summer, everyone's just kind of buying the dips and selling the rips. And that's just the environment that we've been in since January of last year.
Right. So that's the whole thing, is that, you know, they buy the dip, sell the rip. So bear market rallies. And when does that theme change? Are there too many headwinds for stocks to really take off?
Well, I haven't got the invitation in the mail yet that the Fed is lowering rates or they're topping rates off, but I think the mood of the markets will change dramatically. And I think what investors have to remember is that the greatest bull market in history from 82 to 2000, we had rates at the current level we're at today. So this interest rate environment that we're in really is going to be the new normal for the next couple of years. I see the Fed topping off rates here shortly within the next 30 to 90 days. And when that happens, we will see a rally in tech, because that same technology sector exploded when rates were still at 7.5%, 8%, even 9 or 10% during the 90s. And so that's a temporary reprieve for now, but it's a gift to the investors and it's a gift to the financial advisors that can reposition assets.
This is still going up.
Very slowly into tech over the next 3 to 6 months.
Which tech, which names, and why?
Well, that's a great question. So obviously, I love the ones that have been beaten up the most, but they're the perennials in their space. I mean, they're the best of the best. And so I'm going to go offshore for the first one because it's been beaten up the most, but that's Alibaba. I think everyone's got to have a portion of that. Even Warren Buffett's got some Alibaba in their portfolio. You can buy it at an IPO price of 2014 today. And with the reopening, and hopefully the virus over there will sustain itself and eventually get herd immunity like we have here in the United States, and there won't be a mutation involved, that stock will definitely reap the rewards. I also like Meta as well. They're down 66% from their peak. We know all the reasons why.
Did y'all hear that? Meta's down 60-some%.
Become a reality? I'm not sure yet. Probably not, at least in the short term. However, all they've got to do is make a couple of nice moves on their balance sheet, reduce their expenses, and their profit goes way up. And so they're trading at a multiple of 11 times earnings. Who would have thought that's ever possible for such a cash flow rich business as Meta/Facebook? I also like Microsoft, which is down 31%. And of course, Apple. And if you notice, I'm staying in best of breed, but these are gift oriented prices for folks for us to start reinvesting before that rate hike or that rate stifling occurs. And the Fed says maybe 3 magic words.
No, I think I had one call. I played pretty small today. I know. I had one call and maybe one put that didn't work out and I cashed out. So no, I didn't do anything. I know that big old move and I was just sitting here basically.
Year or so, compare to some of the other names. Meta, people are wondering about the metaverse and whether or not.
Yeah, I said it out too, Johnny. I felt like I didn't catch it this morning. And to be honest with you, it's kind of good for me to not overtrade. I have come to some conclusions. I need to wait. Like that was a good setup. And I didn't catch it this morning. And I caught a little bit and I jumped out too soon and I learned something there too. Because had I checked back and just not been afraid, had I checked back on the larger time frames, it said stay in the position. But you know, I have this conversation in my head, small base hits, you know, swing for the fences, small base hits. So I took the base hit. And I did, because I only bought, you know, I bought smaller numbers today. I didn't have a runner. So that's the downside of not, when you buy 3 contracts, you know, you get 2, you let them do whatever they do, and then you leave a runner. But I don't know. I felt so much more at ease today, only buying 1 contract. So I brought a couple this morning, but then I switched over to just 1. I know it was a big move, but I know that there will be other big moves. QQQ is always moving like that. So, but that was a good one. And she's still just chugging away. Just chugging right on out off the map. I was hoping maybe she did like a little sell-off at the end of the day because these people would be wanting to take profits. So we'll see. But at any rate, I'm not getting back in either way. I'm gonna let the weekend just take care of itself. Have a good weekend. Nah. As a matter of fact, let me go open this door. There's some fresh air inside.
But for now, we're stuck in a mode of non-growth until the Fed either pauses or decides to re-stimulate. But they won't do that until the economy actually physically starts to go through some difficult times. And we see unemployment factor maybe back up over 4.8 to 5.2. Once we see unemployment,
I know, it's always another day.
Yeah, and with the earnings, the expectations.
Yeah. I took my little base hit today and just sat the rest of it out. Frank and I were just talking about that the other day, that base hits, they add up, and I think that's going to be my new philosophy. And I'm getting better at gauging my stops. So that was something I was working on today too, looking at how comfortable I was with the percentage of my, my stop loss. So it was a good day. I learned. I got a chance to watch and see some more. Every day that I watch QQQ is more information for me. Every day I watch, you already understand. It's learning. It's pure learning. Oh, me and the ladies are going to have to do I'm going to have to show them how to do that because I have something to do right afterwards. And since I'm not going to get back in another trade, I might as well show them now. Elle, are you and Marilyn ready? I can show you. I'm going to switch this thing off and go over to my paper trading account, since I'm not going to take any more trades today. And then I'll show you how to place an order. Okay. You guys, I'm going to pull this screen out, and then I will load up paper trading. So can you guys get your computers ready? Because right at 4 o'clock, I have to get out of here. So I'd rather show it to you guys sometime today. Yeah, we've got an hour and a half. So take your time, get your computers, and let me know when you're ready, and I will queue up paper trading. All right, Johnny, thanks for everything. Thank you, thank you, thank you. I'll be right back, y'all. Okay. Let me know when you and Marilyn are ready, and I will go ahead and start getting this other stuff together. Let me get Thinkorswim up. Oh boy. Oh. This would be a good day to just be sleeping in the park under a tree somewhere. Or better yet, at the beach, next to the pool. I gave y'all a full. Okay, we got paper trading up. Charts. Oh, I could paper trade it. Let's see what happens if I jump in now. Trade. Options chain. To call. Oh, shoot. Let's do some puts. Same thing. Okay, Elle, you're ready. Marilyn, you are ready too? Okay, I'm going to share my screen. Can you guys hear me okay? Okay. So let me get something over here so I can see what you guys see. Okay. So you guys can see my screen. You can see me. You can hear me, right? Okay. So you can see, you can hear. Perfect. Okay. So the first thing we're going to do, if you want to place, oh, wait, I'm going to put you all on my phone too, so I can at least see the comments. Let me join here on my phone. Okay, perfect. I can communicate with you all through my phone. Okay. So the first thing you're going to do is go to the trade tab, hit trade, and make sure that it has all products. And once you get to all products, hit it, and it should come up like this. You'll see where it says underlying options and then options chain. If you get to this page, drop a thumbs up or just okay. Just give me an okay in the comment to let me know that you were able to get to this screen where you see an options chain. Perfect, Marilyn. Yay. Elle, if you need me to go back, just let me know you need me to go back. Okay, Elle, I'm waiting to hear from you. If you have it, let's see. Can you continue? My laptop is slow. No, we'll wait for you. We have nothing else to do. While we're waiting, I can be talking and letting you know what we're looking at. So you let us know once your screen catches up. And Marilyn, while we're waiting, I can be telling you what we're looking at. So this is our options chain. The underlying means the actual stock or the actual instrument. And as a matter of fact, I'm going to change this out so it makes a little more sense. I'm going to change this to Apple. So Apple is AAPL. Can you change yours to Apple as well, please? So you'll put the ticker right here under where it says all product, AAPL, and then just hit enter. And then the options chain will open up, the Apple's options chain will open up. So Marilyn, can you let me know once you get the Apple options chain open? Just give me a K. Okay. Are you in there? All right. So Marilyn, you have it. And we'll just be waiting for you to let us know once your computer is on this screen. So you're going to go to the Apple options chain. Are you okay, so good. Everybody's there. So Marilyn, by underlying, they mean the actual Apple stock. And what this is the price, the bid, and the ask. But since we aren't buying stock, I usually don't look at it. I usually close it because here's the stock price right here too. So I don't need to see it there. So I usually close this tab, but by underlying, they mean the actual Apple stock. And then below, you'll see the word that says options chain and spread. I usually keep this set to single because you can set it to all of these, really complicated things, but we aren't doing those. So I usually keep this tab set to single. And then right here across the top is the layout. And there are certain things that I like to see on my options chain. I like to see the delta, the theta, and the open interest for sure. Delta is the amount that it's price sensitive. So if the underlying stock goes up $1, your options contracts are going to increase by this much. So let's say if Apple stock goes up $1, if I purchase this contract, these contracts will go up by 89 cents. So that's pretty good. You want a very high delta, you want a low theta. Theta is what you pay if you hold these overnight. So theta is your time decay. You definitely want to know what you're paying because you're going to be paying your premium. But in addition to your premium, you're also paying this time decay. So that's why we don't want to hold options for a long time. So over here, that's the column with my delta. You want your delta to be high because that is how you're getting paid. Of course, you want to make more money, not less. And your theta is what you're actually paying to hold that contract overnight, and you pay that daily. And it's not exact, but it's roughly that. And if you'll notice, it increases, your delta increases as you go up the options chain, and your theta decreases on this one anyway, decreases. So you're making more and it looks like you're paying less, but the contracts are more expensive. You can clearly see that. They get really pricey. You're almost dollar for dollar at this point. So, excuse me, I'm an old lady. I need my kindergarten nap. All right, Marilyn, did you have any questions about what we talked about so far? Do I need to update or optimize my layout? I can't see your layout. Are you on the desktop or are you on the web version? Because the web version, I'm sure, looks different. I don't know the web version. And remember, I am in paper trading. You're in the desktop. Are you in real money or paper trading? You'll know it's paper trading because it'll say simulated trading. And it'll have that orange like rim around it. Okay, you're in paper trading. Yours doesn't have to look exactly like mine. I'm on a Mac. What are you on? Because they can look different. The versions can be different. Nope. Yours, it functions. If you have all of these little boxes and stuff that I'm pointing to, then you're in good shape. Do you have the thing across the top? Because if I hit that little triangle in the corner, I can customize this. I can change that. Okay, no worries. And we can actually customize it and put exactly what we want. And that's exactly what I did. So I'm going to go back to it where it says layout. If you tap this triangle right there in the corner, you'll get this drop down menu. And I prefer to just go to customize. Okay, so let's customize it while we're here, and then you'll know how to customize it later. So I'm going to go back, and we're going to do it one more time where it says layout, so you can see. I'm going to hit this little triangle in the corner. I'm going to come down to customize. And this is where I'm going to pick things from over here to put them up there. But I never put too many things up there because it crowds out the fields and then you can't see the values, the numbers that are in there. So of course you have to have delta because you got to know how much you're getting paid. You got to have theta because you've got to know how much you're paying. And open interest, you want to make sure that lots of people have purchased those contracts because you need to have someone to sell them back to when you're done. So you want to make sure that you have a healthy amount of open interest. You certainly wouldn't want to buy a contract and there are only 4 people in there because when it comes time to sell it, that's going to be a hard sell. So always check your open interest delta. And people check other things like implied volatility. I like implied volatility too because, and let me show you how to find those. You could go down the list. These are in alphabetical order. Or you can type, like I want implied volatility. So I'm just going to start typing it and there it'll pop up. Then I highlight it and add it to the other side. So these are the 4 things that I think, that you should have these minimally. Delta, how much you get paid. This is directly correlated to every dollar that the underlying stock increases its price by. Your delta will increase by whatever your delta is. And your theta is what you pay. That's time decay. That's what you pay if you hold this overnight. So you want to know that. Open interest again is how many people actually have contracts that are open. They're holding them. We want to have a lot of people because you want to have somebody to sell to. And implied volatility has to do with how much volume. Don't quote me on implied volatility, but it's good to know because you don't want IV crush, which is if so much volume that it begins to work against you. Here's where I plant the seed and tell you that you need to know more. So check out implied volatility, but it's one to consider. So once I have these things over here in the set where it says current set, I'm going to hit OK. And then you'll see all 4 of those things now appear in the columns. I've got delta, theta, open interest, and implied volatility. And you can adjust these fields too. So I think you can. But at any rate, so those are the 4 things that you need to consider minimally when you're looking to purchase a contract. Can you guys give me some feedback? Are you okay so far? Do I need to go back over anything or are you okay? Elle, did you get caught up with us? Yeah, this might work better as a Zoom. Okay. Yes, you can add them individually. I'll go back, Marilyn. We can hit this again. And we're going to hit customize. And yep, you can clear it out because there's a remove items down there too. There's a button where you can remove everything to clear it out. Or you can type in the beginning of the word like Delta, DEL, and Delta will pop up. And once that pops up, just hit add item, and then you'll see it jumps over here on this side, but I'm going to take that off because I already have Delta. So then if you want to add theta, just type in THET, and then highlight it and hit add. You got it? Okay, and I'm going to take that out. So before you leave, your current set should have delta, theta, open interest, and implied volatility. And once you have those, Marilyn, those 4 things in your current set, could you give me an okay? And then we're going to hit okay, that little green okay down in that box. And you'll see that's what shows up in your options chain. So let me know if your options chain has delta, theta, open interest, implied volatility, and bid and ask should have probably already been there. Bid and ask will be there. So your chain should look like this. Let me know if it does. And then we'll get in the business. Yeah, it has something to do with like implied volatility would be an example around earnings. You know how everybody might be trading Tesla on a stock split and it's so much trading volume that it has a negative impact on the contract in some way. So yeah, I don't know how they make the sausage behind the scenes, but I know implied volatility is not our friend. High implied volatility, we want to steer away from. You want lower implied volatility. That much I know. You don't want to be in high because then you'll experience something called IV crush, or you're more likely to experience IV crush. Should I remove last? Yeah, you can take last out. If you've got bid and ask, yeah, because after a while it'll get too crowded and you won't be able to see. So the only things I would say you need right now are delta, theta, open interest, implied volatility, bid and ask. That's plenty. Because you can always see what the last price was because it's right up there where the underlying is. Where it says apple.com and it says 129. That's the current price. It's flashing. And while that's flashing, let me just see what QQQ is doing. Oh, man. Just out of curiosity. Okay. You're going back. Okay. So also remove net change. Yeah, that's going to be too much. It's going to be too much stuff and it'll crowd out. So make sure you only have delta, theta, open interest, implied volatility, bid and ask. Anything else, you can always go back and customize it to the way you like. But for now, just include those things. You got it? Okay. So let's scroll down. I'm going to close these all up. And you know how to close these up. You have these little, you see these little triangles? They're like half open. I don't know what you call those. Pointers. We're going to call those pointers. If you close all of them up, you'll see a list of dates. So can you go ahead and close? This is how you open one, you tap it. If you hit it this way, you'll close them. So can you close all of those up? Because we're going to look at those dates. And once you have these all closed up, Marilyn, just give me a yes. If you've got these all closed up, so all we see are dates. We don't want to see any options just yet. And what you'll notice is they're the dates, and they are from the closest to the furthest out. Most times we trade relatively close in, but you can buy what are called leaps that can be as far out. Look, this is in 2025, 2024, so they can be a year and beyond. Those are called leaps to my understanding, but we are concerned with those. But this is the date. These numbers that are in parentheses tell you how many days until expiration. So just because I'm a novice, I usually go somewhere between 7 and 14 days. And it depends really too on when I'm purchasing it. Like I would probably never buy a contract to hold overnight on a Friday, but somewhere between 7 and 14 days is what I'm comfortable with. And so I would just, these are weeklies, and I'm not sure the difference. I think these are dailies and weeklies. I'm not sure the difference, but that's something you guys might want to find out because I need to know, because I want to know if they pay differently. So I'm going to go with the 14th. The further out you pick from the options chain, the more expensive those contracts will be as well. So that's one reason why traders may pick closer dates, because the contracts are less expensive. So let's just go with the 14th. We're going to hit that little caret thing, and voila, out pops the options chain. Now, yours may not look like this. If you only see a few, come right here to the middle where it says strike. I have this box where it says all. You know, you could opt to see only 6 at a time. For me, that's not enough. You could opt to see 12 at a time. I don't like that either. I want to see all the choices. I want to see all the choices. So right up the middle where it says strike and all, hit that all box, Marilyn, and that will show you the entire options chain. So we've come across this. We talked about this as the underlying. This is the actual Apple stock, but we don't need to see it because we have the price there. So I usually close that for the underlying. We talked about how to change the values in this field. And now we're talking about right here where it says strike and all, how to unlock all of the strike prices in the options chain. And so we do that by hitting this all button. All righty, so now we've exposed all of the calls, because you can see on this side you've got calls. On this side we have puts. We've exposed all of our puts. The ones that are in this blue or purplish color are in the money. The ones that are black are out of the money. And the same is true over here. It's just opposite for your puts. These are out of the money. These are in the money. In the money contracts are more likely to expire profitable. They have better odds. So I personally always buy in the money contracts, and I personally shimmy up, quite a bit up the options chain, only because the further up you go, the better your chances are of, your contracts expiring in the money. Not that we want to hold them to expiration, but I buy the security of it. And some people, you should definitely talk to somebody. Oh, good, Elle, you're in. Good. And we're right on the first page. Let me know if you need help getting to this point. Just hit the trade tab and then come down to where it says options chain. Oh, you all, please forgive me. Oh, I'm sleepy. Okay. So we talked about all of the layout. We talked about how to show all of the things. We know that this is our delta. I hope yours are in the same order. I'm not sure if they are, but it doesn't matter. But across here, you have delta, theta, open interest, implied volatility, the bid and the ask. And here's another important thing. You always want your bid and ask to be as close as possible. You want it to be tight because you don't want too much wiggle room in there. So here's a bid ask spread that's only 5 cents. That's good. Well, now it's 20 cents. So if it's something like $1, you don't want that. And you should look up why you don't want that. But I know it has something to do with slippage and some other things. Nasty things happen to your options contract when you have a wide bid ask. So do not, I repeat, the way I was taught was that you want to have a tight bid ask spread. You know, the tighter the better. For me, I pay attention to that. So here's one, and everything here kind of looks pretty good to me. The bid ask spread is 5 cents. Whoops, I didn't mean to touch it like that, but anyway, the bid ask. I'm looking at, which one was I looking at? It's 10 cents now. I'm coming down the options chain. Oh, that's a good one. Whoa, no, this is where I was. If you'll notice, I'm right here at the strike price. Oh, and here's the word strike. Here's the strike price. And strike price is basically like the stock price. At the money is right like the stock currently is trading at $129.81. So $129, this would be considered at the money. I'm coming up the options chain because I want to buy a little time and a little security. And I'm going over to the 124 strike price. You'll see the 124 strike. And if I come over here, this bid ask spread is now a dime. I'm still okay with that. I can hunt around to see now it's 5 cents. I like that. I'm okay with that. Another thing I like is that there's a lot of open interest, 20,000. That's a lot of people in there that I could sell these contracts back to. The theta is pretty low, 0.11, and the delta is 0.75. So all of that looks, you know, in my estimation, pretty good. Could you buy a more expensive contract? Probably. Could you get a high delta? Yeah. But this one, we're going to roll with it. And so if you notice, I'm on a Mac. If I hover over these, one says buy, one says sell. Well, we want to buy. So I'm going to hover over the buy, and then I'm going to click on it. And then this menu pops open, but you won't be able to see it because it doesn't pop up it doesn't show up on YouTube. But once you hit that, I'm going to do it one more time. Oh, shucks. I'm going to take it, and then when I hover over it, it says buy. We're looking at the 124 strike price, and I'm going to double tap it, and it's going to say buy, and I'm going to, oh, it did pop open. I'm going to buy a single. But the truth is, you know what? I'm going to buy custom. I might as well show you guys how to do it, and we'll do it the right way. So we're going to buy custom, and we're going to buy an OCO bracket. Tell me if you've gotten that far. And I won't go any further because I need you guys to get that far. Marilyn, have you gotten that far where yours looks like this? Buy custom with an OCO bracket. And Elle, I need to know where you are too. Y'all got to talk to me. Oh my goodness. Okay, Elle, you're there. Marilyn, okay, do I need to go back? I'll go back. So okay, I'm going back. So we're going to go to the January 20th. I had to add open interest and implied volatility, but now I think I'm caught up. Okay. Marilyn, are you ready? So we're going to go right back to this date, January 20th, 2023. And we're going to come down to the 124 strike price. And we're going to go over to and hover right over the ask. And you'll see it fluctuates between 5 cents and 10 cents apart. And that's okay. We just want a nice tight bid ask. So once you get over it, when you see the word buy is lit up, just double tap it. And then this menu will pop open. Y'all, I just want y'all to know QQQ is cutting up. QQQ is cutting up officially. 269.43. Ooh. Okay. All right. So Marilyn, have you gotten to where it says buy? And then we're going to go buy, and we want to do custom or buy custom. And once we hit buy custom, we want to go over to OCO bracket. Perfect. So everybody tap OCO bracket, and this is what comes up. This is going to be the template that we're going to use. And so here you get to decide, because this is paper money, you get to decide, are you going to, I always set mine to 3. I set it to 3. So you can use these plus or minus toggles here to make them all say 3. Because what you're saying is I'm going to buy 3, but I also want to sell 3 in case 2 things happen. This first one, I'm telling it I'm going to sell when I get a certain amount of profit. The other one at the bottom, I'm telling them to sell if I start to lose too much. So one is a limit and one is a stop. So set them to whatever you want. I set mine to 3 because generally when I'm trading for real, I don't ever buy more than 3 contracts. And so let me know once you have those numbers set to 3. And then we're going to come over here, and there's some things we need to tend to over here. Give me a thumbs up or an okay to let me know I can go on. Thank you, Marilyn. Can I go on, Elle? Elle, I just need to know if you're with us or if I need to go back. Well, while we're waiting for Elle to chime in, come over to this column where it says day. We're going to make these all say GTC. Can you repeat what each one is? Okay, definitely. You see the green, it says buy, and we're buying 3 contracts. That's what we're purchasing. This sell, this first one, we're saying -3. We're selling 3 and we're going to set the parameters up in a minute. In the event that we make, say, 20% profit, you're going to set your profit limit here. The one at the bottom is going to be your stop loss. That's the one that's going to stop you out in the event that the trade doesn't go your way and you lose, you want to limit the amount that you lose. So one is to stop you out for profits, to when you hit your certain profit target, you may want to sell, or when you hit your profit target. And then this one at the bottom is you want to tell market makers to sell once you have lost so much money. Okay. And then come over here where it says TIF exchange. We're going to change all of these to GTC, which means good to close. So that means we don't want to set these every day. If you don't put good to close at the end of the day, it'll just reset and you'll have to do it again. And we don't want to do that. Okay. And so it depends on how you want to handle this. Sometimes I mark it in, sometimes I limit in, but I think it's probably wiser to limit in. You have more control over how much you pay. When you mark it in, you're just saying, get me into the trade, lickety split fast. I don't care how much it costs. And that may impede your profits and really how quickly you become profitable. So you want to, leave it limit. So I leave this one limit. Now I'm going to come down here. And if you look right under that limit, next to limit, there's a lock. I don't want that. Underneath that lock, there is a little toggle switch. And if you hit it, it will unlock this toggle over here, which is the one that we want. We want to toggle it to %. So I'll do it again because you got to do it twice. You got to do it down at the bottom too. There's a link here right next to where it says stop. There's a link right there, right next to where it says limit. You're going to hit that link. And when you hit it, it opens up and it jumps over here. And we want to make both of these percentages. At least that's how I do it, because I want to set a percentage of how much I'm willing to lose, how much I'm, where I want to stop out if I win. So the one at the top, I set it pretty high. I'm just going to say 20%. So I'm telling the system to stop me out at 20%. If I make 20% on this trade, stop me out. Or you can make it 30. To be honest with you, I don't want you to stop me out ever if I'm making money. So stop me out at 35%. I feel like I'm sitting there, but somebody else, you need to make that something realistic though, because not only it should coincide with like your support and resistance, your areas of demand, supply and demand. You really aren't just setting them willy-nilly, but I can set it willy-nilly because I know I'm never leaving my computer and I'll stop myself out. But that limit is important, and you don't want to just set it willy-nilly. You do want that to correlate to something, some market structure, because, that's how we are picking our profit targets. So, but I'll leave it up high. But I'm really particular about my stop because I'm really particular about how much money I'm willing to lose. And I set my stop pretty tight. Sorry, but mine's 6% when I'm dealing with 3 contracts. I'm comfortable with 6%, but you can set these to whatever you like. Let's say you're comfortable losing 15% or risking 15%. You can set that, and that's what these are. That's what you just did. So here's what we just did. We set up an order to purchase 3 contracts and to sell these same 3 contracts in 2 instances. We've sent a notice to sell if we reach a certain profit, and we're sending a notice to sell if we don't make our money and we start to lose. Does it matter if your 20% is in the box? Mine just says it says +35 and a decimal point. There aren't 2 zeros behind mine. Can you see mine? It just says +35 and a decimal point. I don't have zeros behind it, although I do have zeros behind it below because it's a single digit number. So I would imagine, let's see, if we went down to a single digit number, the zeros would probably pop in. Yeah, you see the zeros pop in. So they're there, you just can't see them. And I imagine if we move some of this stuff over, see, there you go. Did you see? I moved that over so you can see it a little better. It gives you some more space. So you can move that column over. Should the stop be a negative number? Yes, the one at the bottom is going to be a negative number. The one at the top is going to be positive. So I'm setting mine back to 30%. Did you see how I was able to slide this column over so that you can see those numbers? So that you can actually see the values. And I'm pretty sure there's some other ways you can, but at any rate, yes. So once you have the percentage on top that you're satisfied with your gains and where you want to stop yourself out at your losses, You are basically done. Yes, my columns are wide. So can you see the whole figure in your wide columns? But you can adjust those columns too. Watch. You see, you can slide them, smush them, or stretch them out so that you can see. Okay, so now before we do anything, we want to save this because this is our template. So right next to the delete button, there is a button that says Save Custom Order Template. You want to hit this button, this Save Custom Order Template. You want to save that because that is saving your order. And now you want to name it. And I call mine 3QQQs. But we can call this 3 Apple or just whatever you want to call it. I'm calling it 3 contracts. So I know what it is. And I always purchase the same, 3 contracts. So 3 contracts and hit save. Yeah, it should, mine is -6 on the bottom. Yep. Can you guys see it? It's -6. And hit this button right next to the delete button. And let me know once you have saved your template. Can you just type the word save in there so I'll know that you have the template saved? Because that's going to save you so much time and so much headache. All right. Everybody, you got it saved? Good. Marilyn, you got it saved too? And so the next thing we're going to do is since we have it saved, we're going to hit confirm and send. And this is where you proof the order before you actually hit send. So you get a second chance to read it over. And I definitely recommend that you read it over 2 or 3 times out loud. Make sure that you're buying 3 Apple contracts. And that 100 tells you you're actually controlling 100 shares of stock. So with 3 contracts, you're actually controlling 300 shares. And that's with an expiration date of January 20th, 2023 on the 124 call. And it tells you that this is good to close. Limit market, it tells you how much you're paying to open. Okay. So, and then the next part tells you that you're selling and it tells you a 30% limit. You got a 6% trigger to stop, blah, 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 blah. And then once you are done with that, you can hit send. And that will place your first order. So let's hit send. You all hit send and tell me if your orders went through. It's 3 o'clock. They might be working, like mine is working. It's a working order. Okay. Or we could do another way where we could mark it in. That's one thing I don't like about doing a limit order is that it might not go and get filled right away. And you have to wait and check, to make sure. So another way to do that is we can do the same thing and this time make it a market order. So I'm going to go back in and buy custom and you'll see my 3 QQQ contracts there. I'm going to change this to market and then I'm going to send it again, you guys. I'm sending it market. What is the deal? Okay, so it just got filled. Did you guys order get filled? Mine just got filled. And the way we check it is we go over here. Let me see. Oh, I'm sorry. Wait a minute. I'm looking at QQQ. 3 calls. Okay, so I'm looking at our Apple. You should be able to find Apple here. Yay, good. And you should be watching it, the money here. So once it gets filled, you can go up to home screen, hit home screen, hit this. Hold on, that's Frank. Frank is just telling me QQQ is up to $270, and I'm telling him I didn't get in. Okay, so we got our orders filled, everybody. Marilyn, did you get your order filled? Yay, Elle, you got your order filled. Yay. Yay, Elle. Good job. Marilyn, did you get your order filled? Oops. Let me get over here and see. All right, ladies, I'm glad. Let me get over here and cry about QQQ for real. Did y'all see how she took off? This is insane. Oh, that's no wonder. $269. All righty. Go back. Okay, what do you mean we gotta go back? I don't know. Okay, Marilyn, you want to do it again? Oh, okay, here. I tell you what, hit home screen. And then when that figure comes up, you're going to tap the triangle next to it. Or you could hit, if you go to the monitor screen, monitor will bring you here. You got to talk to me and tell me, because I can't understand. Go back. Okay, we'll start all over again. Did you get your thing saved after confirmed? Did you get your template saved? Because that's going to make a difference. Okay, I'm not sure what you mean after confirmed. Okay, so the order was sold. Okay, so you got your order placed. Is that right? If you got your order placed, the way that you're going to check it is go to home screen up at the top. It's green. Hit home screen, and then this page will come up. Another way to get here is to hit the monitor. If you hit monitor, it'll take you here and you can see what your profits are. So we can see so far my Apple has made $37. Yes, all was confirmed and send. Perfect. Now go up to the top and hit home screen. Once you hit home screen, then hit this figure here and this will pop up. Or you can just go to the monitor. Let's say just go to the monitor tab and it'll bring this up as well. All right. Okay. I'm exasperated, y'all, because QQQ done flew off the charts and I didn't get any of that afternoon money. I didn't get in on it. I got out too soon and she went to the moon. Wow. Well, what do you know? That was a good day today, man. All right, so did you get it? And don't forget, you guys can always watch this in the replay. Got it. It feel perfect. Do you know how to check it, Marilyn? Go over to the monitor tab. And once you hit the monitor tab, it may come up and it may look like this. It may be collapsed like this. So all you want to do is tap on that thing where it says Apple, and then you'll see all the information for Apple. Elle, what's your Apple doing? My Apple is down $30. So can you see how it's performing? Perfect. Yours is down $45. Let's see. I'm down $52. So it probably just has to do with the time that we hit send. Yeah. The time that we got into the transaction. Marilyn, what does yours say? We bought calls on Apple, and I guess Apple must not be going up. AAPL. Let's see. Okay, it's taking a little downturn, as is QQQ. All right, ladies. I'm glad we were able to get that done. Don't forget, you can always watch this in the replay and pause it and start it as many times as you need. I want to see what this is doing. I'm going to get out of here. It's Friday and I need to get ready. Yeah. I'm about to get out of here. Oh, yeah. Down 75. Let me see. Yeah, I'm down 67. Yep, 67.50 for me. So we're about right. Okay, so you placed your first paper trade, ladies. Congratulations. You all are the best, the best, the best, the best, the best. I'm going to get out of here now. I'm about to sign off and get ready to start my weekend. If you need anything, you know what to do. Y'all know where to find me. Thank you, everybody, for coming. It's been a great week. It's been a wonderful, wonderful week. I'm going to be adjusting my schedule next week because I need some solitary trading days. I think I'm going to trade. I think I may live trade Monday and Tuesday. And then, yeah, Monday and Tuesday. And then the other 3 days, I got to start getting my house together too. I got something to tell y'all. Yes. So I got to get some things in order around here. So thank you, Marilyn. Thank you for always being so encouraging. Thank you, Elle, for always being so supportive. I don't know who else is in here with us, but bless you. Thank you. Thank you for the support. Please don't forget to like, subscribe, and share. And ladies, if you all want to do another like mini tutorial, I don't know what else we could do, but pick a skill. Practice. We could practice getting in and out of trades. If you want to do that, we could do that like at the end of a day. I think it might be better though if we do those in Zooms because I don't like not being able to see you all and not being able to hear from you. So let's make plans to do like little mini lessons like that because I don't mind doing that. Let's make sure we can. So if you guys need something, you want to practice something, we could do that. Marilyn, thank you. Elle, I will see you. I know. Well, you know, some of them is my peeps, my people. All right, y'all. I will talk to y'all Monday morning. See y'all later. Adios, folks. Bye-bye.